Good morning, dear students. Today we are going to start CMA Inter Marathon with respect to financial management. Well, we know that CMA, in particular in financial management question paper, if you observe, it consists, what is it? Fill in the blanks, match the followings, and comprehensive questions. Yes or no? So, for that purpose, in order to clear the financial management paper means, first of all, you must have the conceptual knowledge. Just having just random information, with that random information you cannot clear the paper. You need a conceptuals. Okay, so but in this marathon session I am going to give you all the conceptual clarity with respect to each and every chapter. Okay, first of all we are going to take, what is that in this marathon, I forgot to talk to you, is these are the chapters we are going to cover. So introduction to financial management, time value of money, capital budgeting, cost of capital, capital structure, leverage analysis, working capital management, dividend decision, advanced concept in investment decision, risk and return, funds flow statement, comparative and common size financial statement, and ratio analysis. All these chapters within the day itself we are going to cover, right? Okay, first of all we take a introduction to, what is it? Financial management. Introduction to financial management, maximum you will expect 2 to 3 marks from this area, right? So here the first question generally they ask, what is the financial management? Tell me. Yeah, financial management is a, yeah, here it is. So financial management is, FM is the systematic management of financial activities of the company. Okay, and you should understand what is the difference between money and finance. Here you see money versus finance. So whatever the amount you have, currency and coin, what you have is called, what is that? Money. And how much finance is required to start a business is called, that how much money is required to start a business is called, generally called, what is that? Finance. But in brief, the A to Z, the comprehensive information with respect to money related activity is called, what is it? Money and money related. All the activities comes under the category of, what is it? Finance. That's why in India we have what minister? Finance minister, not money minister. So financial management is nothing but a systematic, what is the FM it indicates? Financial management is nothing but planning, acquiring or raising, and what is it? Utilization. What is it? Utilization. So planning, how much finance is required to start a business, that is a job. Thereafter you have to acquire or raise this finance from various sources, and thereafter what to do? You have to, what to do? Utilize the finance in such a way that, right, you must achieve, what is it? Wealth maximization of the company. Wealth maximization. So this is the basic idea with respect to financial management. It is a combination of two words. What are they? Finance. Another one is management. Finance means money and money related. A to Z information is nothing but finance. Management is the systematic management of financial activities of the company. It includes, what are they? Planning, acquiring, utilization of financial aspect of the company, so that what should be developed? Wealth should be maximized. Okay, another important point they used to ask, so what are the major decisions of financial management? And here one more point I want to say, financial management is a, what is that? Subject of, financial management is a subject of what making? Decision making. What is that? Decision making. Since financial management is a subject of decision making, they may ask you the question, what are the major decisions of financial management? Now tell me, what are the major decisions of the financial management? It is a repeated question. So how many decisions? 3 decisions. So financial management is a subject of decision making. It includes 3 major decisions. One is financing decision, and investment addition. Another one is dividend decision. So financing decision, investment decision. Another one is what is that? Dividend decision. Yeah, financing decision, investment decision. Now, what is the financing decision? There is a question would be asked. Financing decision indicates rising of required funds. What is that? Rising of required funds at a least cost. Least cost. So this is what decision? Financing decision. Then what is the investment decision? Means a company has to raise the finance at a least cost from various sources, and whatever the funds it raises, what it has to do? It has to invest. So utilization you can say, utilization or investment. The company has to investment of the raised funds, investment of raised funds. So whatever funds you raised, right, you must utilize these funds. You should not keep these funds idly with you, okay? But you should raise the funds in such a way that here the cost would be, what is it? Very, very low. Here what you have to do, whatever the finance you raised, right, thus funds should be, what the company has to do? It has to utilize, invest. So what the company do? It has to utilize, it must generate, what is it? Return. That return should be greater than cost. Okay, this is the basic idea. That is the reason only we are learning this concept. And the dividend decision means whatever the profit you made it, what the company has to do, should we declare a dividend or retain it? Dividend means whatever the profit belongs to whom? Equity shareholders, right? That is a profit of whom? Profit of equity, yes or no? Profit of equity, what the company has to do? Should they retain or distribute the dividend? Hello? Dividend. What the company do is called, what is a dividend decision? Dividend decision means whether to give dividend or retain is called, what is it? Dividend decision. But whatever the concept, you can take it, no problem. But the thing is, because of your decision, either retain or dividend pay, what happened? Wealth should be, what is it? Maximized. Okay, this is the point, dear students. Just to have this idea, this would be enough, right? Now tell me, what are the various decisions of the financial management? Financial management is a subject of what making? Decision making. It includes how many decisions? 3. Financing decision, investment decision, dividend decision. Financing means rising of required funds at a least cost. Investment means utilization of these funds and generate the return. Return should be greater than cost. Or what about the dividend decision? This is the profit belongs to equity shareholders. Condition applies. When company makes a profit, then only it will come. That profit means not investors. That is nothing but operating profit. That is a profit belongs to only equity shareholders, right? And what to do the company? Should we retain or reinvest, right? The next one is, what are the major objectives of the company? There is another important point. Financial management is a subject of, it has its own objectives, right? What are the major objectives? Means objectives of the financial management being classified into 2 types. One is profit maximization. Profit maximization objective. Another one is, what is that? Wealth maximization objective. Hello? Profit maximization objective. What is the profit maximization objective means? It is a basic objective. Yes or no? It is a basic objective. Any company, if they want to survive, it has to make, what is it? Profit. So this is the basic objective of the company. But it is not ultimate objective. It is a basic, but not important. Very, very important. Because company has several objectives. Hello? Company has several objectives. One of the objectives is nothing but profit maximization, but it is not an ultimate objective. If the company concentrate only profit means, then automatically it may do some illegal activities, it may do some false trade activities, and indirectly it may exploit employees, it may cheat the customers. But you must have the profit objective. It is a basic objective or prime objective. But one of the issue with respect to this profit maximization objective is, profit means whose point of view profit? Is it EBIT profit? For example, company has a profit. Company has a profit means EBIT is a profit. Hello? Then EAT also profit. EAT is a preference shareholders profit. Hello? EBIT is the profit belongs to debenture holders. Whereas the profit earning availability equity shareholders is equity shareholders profit, right? Whose profit point, the profit you are defining, it's good, right? Whose point of view profit means there is no specification with respect to this profit. But profit maximization is a good, but it is a narrow objective. What is it? Narrow objective, okay? So it has objective. If the company, whatever the activities it has to survive, or the performance of the any company depends upon how effectively it achieved what objective? Profit maximization objective. Another one is, second one is another objective of what is that? Wealth maximization objective. What is that? Wealth maximization. Maximization objective. Wealth maximization is a, wealth means the market price of the company or market value of the company should be increased. Hello? For example, MRF share 10 rupees, but today it is 87,000 rupees. 10 rupees share price went to 87. Try to understand how much wealth it increased, right? So wealth increase means it's nothing but what is that? Value of the company to be increased. What is that? Value of the company. So wealth maximization cannot be achieved within a short run. It is what is it? Long run objective. Hello? But whereas profit maximization objective, it is a nothing but short run. For example, in a year you are generating profit means you never say 10 years profit. Hello? You will say 1 year profit. But wealth should be increased means 10 rupees of the share is increased to how much? 87,000 means it is not a one day show, right? So wealth maximization objective is the long run objective. But sometimes what happens? It is a wider one. Which one? Wealth maximization is a wider, profit maximization is a narrow objective. If you ask me the both in the one of the representation of like a tree, if you see this is oak tree, you know that oak tree, Ashoka Chettu. This is nothing but what objective seems to be? Profit maximization, right? It would be in a narrow mind. But whereas a wealth maximization objective is not like this. This is nothing but like a neem tree. Now see, its roots are very, very strong. Hello? But it is very, very narrow. Both are what is it? Trees only. Which is the delicate one? But this is oak tree, right? You see how it is delicate. If you just any small issue comes, right, it goes out. But what happen if you maintain a company like what is it? Wealth maximization. It seems to be very, very, very strong. So every financial manager has to achieve the two objectives. What are they? Profit maximization, wealth maximization. Profit maximization is short term. Wealth maximization is a long term, which is a narrow, which is wider. Price maximization is a narrow one. Wealth maximization is a wider one. Frankly speaking, profit maximization is a part and parcel of wealth maximization. But wealth maximization not one part of, right. The another question is completed, right. Another thereafter I observed one of the most important point they are expecting. What is the difference between financial management and financial accounting? Both are same. Yes or no? Same, huh? Financial management is different. Financial accounting different. In this financial, in foundation you cleared what is it? Accounts. But you are studying here financial management. So financial accounting, financial management, if you understand the two concepts, you will find little bit surprise. Okay. Financial management, financial accounting. Okay. Financial management is a future oriented one. Which one? Future oriented. So we are going to think about what is that future. If you make investment, if you raise funds, if you declare a dividend, everything it is a future oriented. But accounts is nothing but historical one. Which one? Historical one. Hindustan Unilever Limited has declared a profit, right? This is a future profit. But in capital budgeting, we used to learn, right? If you invest, we will get this much of profit. That is what? Future oriented. Yes or no? Frankly speaking, FM is a guesswork. What work? Guesswork. But it is practical work. What is it? Financial accounting. Financial management is a subject of what is it? Systematic management of business finance. But financial accounting, here you see, FM is what is that? Management of finance, right? But what about this one, man? Which one? Financial accounting is art of, do you remember? Art of recording, then classifying, summarizing, and what is that? Interpreting the results. Yes or no? Interpreting the results. So this is, what is that? Financial accounting. Financial management depends upon several subjects, but financial management depends upon several concepts, conventions, yes or no? Standards. So financial accounting is a historical one. Financial management is, what is it? Future oriented one. Yes or no? So financial management is useful for the managers who are going to take various decisions. But financial accounting is useful for whom? All the stakeholders. Who are they? All the stakeholders. Employees, creditors, debtors, bankers, all the people who been maintaining good relationship with us. It comes under this category. Okay. From the first chapter, Introduction of Financial Management, I understood that if you learn this one among this area, right, you may clear one question compulsory. So what is the financial management? Basic idea is systematic management of business finance. It includes, what are they? A, plan, how much we need it. B, how to rise. 3, how to invest. But planning, rising, investing should keep it in mind what? Wealth of the company should be maximized. So it is a subject of what making? Decision making. What are the major decisions of financial management? Financing decision, investment decision, dividend decision. What are the major objectives of the company? Profit maximization, wealth maximization. What is the difference between financial management and financial? It is a, what is that? Future oriented, historical oriented. Along with this, there is a one point you can say, financial management is an aspect. Two aspects you may ask it. What are the two major aspects which is not in your CMA, but cainter is there? In financial management, you have procurement of funds and utilization of funds. Two basic functions. What are they? Two basic functions. One is procurement and utilization. That point covered in new study material. What are the major decisions of the company? Hello? If the examiner asks what are the, tell me two basic functions, means you can consider, what is it? Procurement of funds, utilization of funds. Right, ma? So this is with respect to our concept this, right? Next. We take next important chapter is, what is that? Time value of money. You got it? You know that 13 chapters we have. I prepared for each and every chapter how much time to be spent. I identified that 2 chapters are dead important. 4 chapters actually. One is capital budgeting. Hello? Even if you start one problem, 1 hour goes out. Total given 8 hours, that too technical problem. Okay? So capital budgeting 1.5 hour. Working capital management at least 2 hours is needed. Even if you try for 1.5 hour. Why? Because working capital estimation, one problem 1 hour takes. Whereas in that 1 hour, I want to explain operating cycle, working capital estimation, everything. 1.5 hour, 1.5 hour, you take it. 3 hours has gone. Remaining 5 hours. How many chapters? 13 means 11. 11 concepts we have to touch, means you must be active. That is the reason I prepared this material. Okay. Now, another chapter is, what is that? Time value of money. Yeah, it is also is there, but I am not going to spend much time. Within a half an hour, we are going to discuss this one. Okay. Time value of money. Question exactly starts. What is the time value of money? Time value of money indicates what? It is a basic principle. What is that, Maji? Basic principle. You see, whatever the financial management you learn, right? All the financial decisions, all the decision functions, everything is depends upon what? Time value of money. So what do you say? It is the, which one? Financial management, not financial management. What is that? Time value of money. Yeah. What do you say? It is the basic principle. Basic principle. So if you don't know time value of money, believe it to be, you don't know FM. Because it is a basic principle in which all the financial management decisions are based on it. What is that? All the financial management decisions are based on it. What is the time value of money? It means the TVM. Hello? Can I write like this here? TVM is the, what is that? Time value of money. TVM is the, what is that? Basic principle. Why, sir? Because in which the all the financial management decisions are what? Based on it. If you don't know time value of money, right. So what this time value of money speaks, that value of rupee today is, see, it speaks that value of, it indicates, simply it indicates, which one? Time value of money says TVM indicates that, indicates, so rupee today, what rupee? Today, whatever the rupee you have, rupee today is more valuable than rupee to be earned in future. Hello? To be earned in future. This is his idea. It means that if you take a timeline, right? You have a rupee today. Let us take that rupee today, whatever you call is called what value? Present value. The rupee what you are going to get it is called what value? Future value, right? If you have a 10 lakhs rupees now, if you deposit any bank, hello? If you deposit any bank, after 10 years, if you go and ask that bank, if the bank gives 10 lakhs, will you take it? Why, sir? You, whatever the 10 lakhs you gave with the briefcase also we kept there, sir. Let us take means, will you take that? No, you should not take. Why? Because you have to, if you take means, you are taking means, try to understand, you don't know what? Time value of money, dear students. You don't know time value of money. So you have to say, sir, I'm sorry, because whatever the money I gave, this is the completely different, right? The whatever the money I gave, it's a present value. Whatever the money you are giving is what? Future value. Sir, present rupee is not equal to rupee to be earning in future, sir. Okay? It's not possible, sir. So that point of identity, time value of money explains. Then the concerned party may ask you, why? How do you say the rupee is more valuable than, what is it? Rupee to be earned. This question maybe they ask. Hello? Tell me. You are saying, rupee today is more valuable than rupee to be earned in future. Tell me the reason, man. Means we have a reasons. Number one, what are the reasons we have? Number one reason is inflation. That is it. Inflation is there, So what we can say, inflation. Can you tell me what is the inflation? How it indicates? See, if I have money, right? If I have money, let us take the 10 lakhs rupees I invested in SBI. After 10 years also, bank gives how much? 10 lakhs means, how could I take? Because this, with this 10 lakh, present 10 lakh, this is the present value, right? With this 10 lakh, how many things, how many commodity I can buy by spending the same amount? What happened? I cannot purchase when? In future. Hello? Because if I want to buy several things, several commodities, right? It is okay. Present rupee don't have what effect? Inflation effect. But if you want to buy, by spending the same amount in 10 lakhs after, at the end of how many years? 10 years means, could you able to buy that many products? No. Because of what impact? Inflation impact. My grandfather used to say that I constructed a house by spending 10 lakhs, man. By taking that spark of spirit, if I plan in Bradipet, right? Would I possible? Even I cannot buy sand also. But my grandfather constructed entire house, right? So what is the difference? That is nothing but what is it? Inflation. That is the reason if you invest in bank 10 lakhs, after 10 years, if the bank gives same amount, will you take? No. Do you have an answer to debate? What answer you have? Time value money concept is there in the form of, you say that inflation. My present rupee is always worthable than rupee to be earned in future, sir. Because what impact? Inflation. Another one is, what is that? Opportunity cost benefit. What is that? Opportunity cost. What do you say, sir? I invested in your bank, sir. Okay. Instead of investing in your bank, if I might have invested outside, I might have got some benefit, sir. So that is the reason we say that the present rupee is always worthable. Opportunity cost benefit. Another one is risk of uncertainty. Yes or no? For example, taking present rupee is, what is it? No need of, what is it? Risk. If I take in future means over the period I have to face what? Risk. Yes or no? So risk of uncertainty has which money? Present money, future money. If I want to take present means I don't have risk. If I want to take future, risk I have to take, right? We know that one of the principle in FM, profit is reward of risk taking. Sir, I am taking risk means how should I take same amount, sir, right? I should expect some return additionally. And another one is, what is that? Personal sacrifice. What is that? Personal sacrifice, or you can say preference of present consumption. What is that? Present. All the people in the world, they want to spend their money and they want to solve their wants. When? Now or in future? Future, yes or no? Whenever I have a money, I have a wants now, right? I have wants now. I will see that what happened. I want to spend that money now itself. Hello? So I want to take the present consumption itself. Now I deposit how much? 10 lakhs in your bank means I am postponing, right? Hello? I have a money. With that money I can spend. I can solve my wants and needs. But instead of using that, I am spending, depositing in your bank means after 10 years if you give the same amount means, will I take? Sir, what is this? This 10 years, right? I might have used these funds for several purpose and several wants to be satisfied, right? But I am depositing in your bank means I am doing, what is it? I done, what is it? Great sacrifice. For the sacrifice purpose, right? I will believe that my present rupee is always worthable than future. That is the reason I never take which money? I never take, what is that? Present money or future money? Present money is worthful. If I deposit the same amount, if whatever you give it, same 10 lakhs, will I take? No. Why? Because I believe that whatever the rupee I gave is always worthable than the what rupee you are giving. I won't take it, but I will take if you give additionally, what is it? TVM, additional certain amount in the form of TVM, that is called, what is that? Interest. So if I deposit in bank, right? Bank, I should expect some additional amount in the form of TVM, what? Interest. If I do business, what should I expect? Profit. Hello? If I do real estate, right? Real estate business, if I do, I should expect, what is that? Growth. Are you getting my point, ma? So wherever you invest, right? Wherever you invest, you should expect a return. Enter this time value of money indirectly, what it conveys. If you supposed to do business, hello? Supposed to do business, from the business you must expect return. Hello? Compulsorily you must expect return. If the return won't, if you return you can't get, right? That business is not at all handling, what is it? Time value of money basic principle. That's why it is not a good. So final point is interest even bank, profit even business, benefit leni, growth leni real estate, benefit leni transaction. You should not do. Can't chapane? Interest even bank, profit even business, growth leni real estate, benefit leni transaction. Cheyadanik veelledu. Who says? Time value of money. Most important point, that is time value of money. Are you getting? So if I deposit in a bank, I should expect interest. Yes or no? Do you have reasons? Inflation, opportunity cost, risk off. If I do business, should I expect profit? Yes, I should expect, man. If I lend money to my daddy, should I expect interest? Oi, చర్లపల్లి జైలు తీసుకెళ్ళి మూసేస్తారు. నువ్వు ఎస్బీఐ బ్యాంక్ మేనేజర్ మీ డాడీ కస్టమర్ ఏం చేస్తారా? తీసుకోవాలా లేదా? డాడీయే వడ్డీయే. హలో, టైమ్ వాల్యూ ఆఫ్ మనీ. ఆఫ్టర్ కలెక్టింగ్ డాడీ టేక్ టు గ్రాండ్ వెంకటేశ్వర. హలో, that is a son and father relationship. But when money is there between you and your daddy, time value money is there. That is the most important point you should understand. Got it, ma? So this is the, now tell me, present rupee worthable, future rupee worthable? Present rupee is more worthable, but we never take same amount in future, but we will take in future. How? For that plus, okay, we will expect, what is that? Some additional amount. Are you getting? Then what is that? In order to, if we deposit in money in our bank, right, we should expect interest. Yes or no? So whatever the money we will deposit, there are certain terminology, you know, how much amount you will deposit is called, what is that? Principal. Hala? What is that, ma? Principal. Do you know this terminology? Principal, what is that? Interest. Another one is, what is that? Amount. So technically principal is called what value? Present value. Very good. Principal is always present value. Amount is in future value. If you deposit money in your bank, right, you will get what? interest. So here you have the interest of simple interest. Here meanwhile, so first what interest is there? Simple interest. Okay. Simple interest indicates what is the simple interest? In your material, the concept is covered, right? In parallel, I'm showing what is that our material concept also, right? So simple interest. What is a simple interest? Very simple. Simply this space, what is it? Interest. This is called what interest? Simple interest. So simple interest formula where interest on interest is not possible. Hello? So generally whatever the earned interest cannot be added to what is it? Principal. Okay, if you are able, interest you will get a principal and interest will remain what is it? Same. If you deposit any money, okay, the principal amount will remain same. So one of the most important point in simple interest what should understand is principal remains what is it? Remains the same. Okay, this is the one point I should keep. Another important point I should keep, since principal interest same means, Balu sir, I earn interest, in such a case what happens? Interest never be added back to principal to generate what? Amount. Thus interest on interest is what is it? Not possible. Hello? Not possible. So basing on this, can you calculate a simple interest formula? Tell me simple interest formula. PNR. Hello? P represents principal, N represents number of years, R represents rate of interest. How do you calculate amount? Principal plus R. Within a formula also you can add it, right? Principal plus simple interest, you will get what? Amount. So we have a problem also here. For this purpose, we have one problem. If you deposit how much? 60,000. You hold it for how many years? 5 years. Can you say how much amount would be? Very simple. Principal amount you invested 60,000. Rate is 6%. Number of years 5 years. So simple interest formula PNR, amount equal to simple interest plus principal. So here is it 18,000, right? Plus interest is 18,000. Principal amount is, so total amount is how much? Okay, this is the one point we can take. What is that? Simple interest. Then the concept is called what is that? Compounding. What is a compounding? The word compounding means what is that? Adding. Hello? So you should understand two values, compounding versus what is that? Discounting. You can also consider, and there is a word, what is that? Discounting. So you see, you have a present rupee today, you have a future rupee in future, right? Now the point is, if interest is, this is the present value, this is the future value. If interest is added to what? If present value, if rate is added, if you find what value? Future value, this mechanism is called what is that? Compounding. Compounding. Whereas in future value means technically there is a two concept. What are they? Principal as well as interest. Yes or no? From this present future value, by making what is it? Discounting. So if you find present value means you are here rate you are adding. Right? Here discounting means rate what you are doing? Subtracting. When you deduct the rate from the future value, you will find what value? Present value. Whereas once you find, if you add, you can find future value. Adding is called what is it? Compounding. Deducting is called discounting. So if you compounding you are doing means what value you are going to find? Future value. Discounting you are doing means present value. Got it? These are the one more concept you should supposed to study. Whereas how do you find the future value of single amount? In our material also is given future value of single amount. Is it there, right? You see, future value of single amount. Future value of single amount. To find the future value of single amount, will you use compounding or discounting? Compounding. Hello? Compounding. Here you try to understand future value of single amount. If you want to find it out, you should understand number one, table number 1. Hello? Table number 1 or cumulative value factor table. So future value is nothing but it is a value of rupee to be earned in future. Hello? So with the support of table number 1, you can find the future value. So whereas future value equal to, what is the formula? Present value into future value factor R percentage n number of years. Sir, where should I find the future value factor, sir? Table number 1. See here future value factor, one more thing is there. You should understand compounding pattern. Hello? Compounding pattern. Compounding pattern may takes place different way. What is that? A, annually. Compounding may be given, what is that? Annually. B, semi-annually. Semi-annually. Another one is, what is that? Quarterly. Quarterly or monthly, right? So future value can be estimated like this. What is that, ma? Future value equal to present value into future value factor, where R represent rate of interest per, not per year, per compounding. Keep it in mind. Rate of interest per compounding. That compounding may takes place, what is that? Annually, what is that? Semi-annually and quarterly. Okay. So R means rate of interest per compounding. Per compounding. Okay. What about the N means? Number of, not years, number of compoundings in a given year. Hello? Number of compoundings in a given year. That is the most important. If 1 year means, okay, no problem. But if the N is given, if the pattern of compounding is not annually, then story differs. So that's why R means, tell me. R means rate of interest per compounding. N means, what is it? Number of compoundings in a given year. Hello? Number of compoundings in a given year. Sir, in such a case, how should we find it out, sir? If compounding takes place annually, semi-annually means, I tell, in order to use the future value factor, if the compounding is annually, it is not a mistake. Okay, ma? If it is a compounding takes place more than 1, means semi-annually, quarterly means R to be divided, N to be multiplied. What is that? R to be divided, N to be multiplied, basing on compounding. So you are identify future value equal to present value into future value factor, right? If R per annum is given, compounding takes place semi-annually means how much? 2, in a year. So in such a case, what happen? R divided by 2, that is a number of compounding. If it is a N, indicates N into 2. Hello? This is the point to be analyzed. R to be divided, N to be multiplied. This 2 is nothing but compounding. Hello? This 2 represents, what is that? Compounding here. That is compounding. Are you getting? This is the way to find it out, the future value. Right? On the basis of the future value of single amount, you have one problem also given, right? Here you see. For example, if you deposit how much? 10,000 in a bank, which pays interest, how much? 12% annually. As 4 years, 8 years, how much it is? For 4 years means, its factor value would be 1.574, that is a 1,575. Whereas for 8 years it is 2.476, means 2,476. It indicates as number of years increases, future value what happen? Increasing. Yes or no? So future value formula, future value equal to present value into future value factor R percentage n number of years. Now tell me, if it is a compounded takes place half yearly basis, means in such a case what to do? What is the rate? 12%, right? If you want to use R to be divided, N to be multiplied. In such a case, 2 semi-annually means 2, right? So here how do we got the 6? 12 divided by 2, 6. N we have to take how much? 4 years. Hello? 4 years means 4 into 2. How many? 8 you have to take. Are you getting? Here 8 means how much it is? 16. So 16%, 6%, 16. That is nothing but 2.540. That is nothing but 2,476. Whereas here 6%, 8 means 1.594. That is a 1,594. From this problem, what we understood? As number of years increases, future value increases, and at the same time, future as compounding increases, future value also what happen? Increases. Are you getting? Number of years increases, future value increases. Pattern of compounding increases, future value increases. So that is the one of the point I made it, right? So with this, we completed future value of single amount estimation. How do you calculate present value? To find the present value, you must have the knowledge of compounding or discounting. Yes, very good. The process of finding what value? Finding PV is known as what? Compounding or discounting? Discounting. So discounting means interest is added or subtraction? Subtraction. So present value, how do you calculate? Present value equal to future value into present value factor R percentage n number of years. Hello? So which table will support you? Present value factor means table number 3. Hello? Table number 3. What is the present value factor? Is nothing but reciprocal of future value factor. That is nothing but 1 divided by future value factor R percentage n number of years. If at all you multiply with what? Future value factor, then you will get what value? Present value. Okay? Present value, which table you need? Table number 2. If table number is not given, then no problem. With the table number 1 also you can do, but only thing is, what is it? Reciprocal. So present value indicates what? How much worth of amount to be deposited now. Hello? So present value indicates amount to be deposited now. So worthful amount to be deposited now, or whatever the money you are going to get its future, what is its present worth? What is that? Now can be learned what with the what value? Present value. Hello? Present value indicates future value worth rupee as on today. If you find the present value, it indicates that how much worth of amount today. So to find it out present value, what is the formula? Future value into present value factor R percentage n number of years. Which table? Table number 3. Right? For this purpose also, we have a small problem to be done. Okay. For example, Mr. X is buy a machine costing of how much? 20 lakhs. After how many years? 3 years. How much money should he set aside? Now the rate of interest is how much it is? 10%. This 20 is what value? Future value. What is the rate? 10%. N is how many years? 3 years. If you want to bring into present means, will you multiply with future value factor? 20,000 into, present value factor. So 20 lakhs into present value factor 0.75. If you multiply it, you will get it. What is it? 15 lakhs 02. What is this 15 lakhs 02? So this is the worthable amount to be deposited as on today. Are you getting? So that is the point we identified here. Present value is nothing but worthful amount to be deposited as on today. Thereafter, we have a concept called, what is it? Annuity. Annuity is nothing but a stream of regular periodic payment amount, right? Here it is stream of, what is this? Annuity indicates it's a stream of regular period amount may be received or deposited. For this purpose, you can say annuity is double S. What is that? Double S. Same amount at the same time period. What is that? Same time period. So this is called, what is that? Annuity. So annuity indicates as a same amount. Okay? Same period. Either it may come or either it may go. Hello? If it is every year it is a coming same amount, then it is called, what is that? Present value of annuity. What is that? Present value of annuity. Present value of annuity. Okay? And the same amount going from you and you are depositing over the period and you are expecting future, then it is called future value of annuity. Are you getting my point, ma? So here they given clearly, it is an annuity. If only one point you should remember, it is a stream of regular payments. It may received or it may be deposited. If you deposit, if it is comes means, what is it? Here it is. Every year the amount goes from you and you want to find the future, then it is called what value? Future value of annuity. Every year you are getting and you want to find it out what is the total present as on today is called, what is it? Present value of annuity. What is the double S? Same amount, same time period. It may be DRR. It may be deposited. It may be received. Okay. If it is a deposited means you are depositing and you want to find what value? Future value. You are receiving and you want to find it out. What is it? Present value. Future you are depositing and you want to find the present is called, what is it? Present, no. You are depositing and you want to find what value? Future value. Are you getting ma? So, and you are receiving how much? Every year you are receiving and you want to find it out. What is it? It's present. That is called, what is it? Present value of annuity. Are you getting? D. D to present osada, future osada. Future. R to present. But amount every year same or changes? Same. How many types of annuities? How many types? 2 types. What are they? Present value of annuity, future value of annuity. Very simple. Future value of annuity means, already I told you, if I deposit year 1, 1 rupee, year 2, 1 rupee, year 3, 1 rupee, year 4, 1 rupee. Now tell me, here every year I am depositing or receiving? If I deposit, at the end of 4th year I want to check this balance, right? At the end of 4th year, then it is called, what is it? Future value of annuity. How do you calculate future value of annuity? Means whatever the amount you deposit every year is called, what is it? Periodic payment. Take periodic payment into, you have a table. What table? Table number 2. What is it? Future value annuity factor table would be available. Table number 2. Table number 2 is there, where you will find the future value factor. Now you take it a future value factor R percentage n number of years. If you multiply, you will get what value? Future value. How much you are going to get it? So future value factor R percentage, at what rate you are deposited, and n, how many number of years you are going to make it. This is point. So future value of annuity depends upon given factors. What are they? Number 1, how much you deposit. Number 2, at what rate you deposit. Number 3, how long you have to consider. That would be the reason future value of annuity equal to periodic payment into future value of annuity factor R percentage n number of years. So what is the advantage of this, sir? Future value of annuity, it enables the systematic saving. What is that? Systematic savings. It identifies that if you want to make any investment systematically, it supposes that it is better to make investment like this. For example, any person retiring or any person constructing house, so it supports in better way. Okay. Thereafter, present value of annuity. Present value of annuity is nothing but, so simply every year you are getting how much? Same amount, right? Year 1, 1 rupee you are getting. Year 2, 1 rupee. Year 3, 1 rupee. Year 4, how much? 1 rupee. This has nothing but what value? Periodic payment, right? The same amount you are receiving now. Previous one, what is it? D or R? This indicates what is it? D. This is nothing but D hai. Okay. This is what is it? R. R means you are receiving. Now the total as on today is called, what is it? Present value of annuity. Present value of annuity, how do you calculate? Present value of annuity equal to periodic payment into present value of annuity factor R percentage n number of years. Hello? So where you will get a present value of annuity factor? Table number 4. Hello? Table number 4 you will get it. So in this way, present value of annuity factor, what it enables? It enables the financial manager, okay, how much to be deposited. What is it? How much to be deposited. Okay. How much worth, the amount what you are going to get it in future, it's worth as on today. How much, that you can learn with what? Present value of annuity. Which table gives ma? Table number 4. Formula is what ma? Periodic payment into future value. Sir, if I learn present value of annuity, what is the benefit I am going to get? You will get a skill, how much to be deposited. Well, sir, if I learn future value of annuity, you will get a skill, how to make systematic saving. Hello? Any business gets collapsed because not knowing systematic savings, at the same time not knowing how much to be invested, right? This is the point to be analyzed. Basing on this, you have some problems also given here. Few problems for the practice. Here you have, we identified what is the present value of annuity. You see it. If Mr. X wants to deposit deposit. You want to deposit now. How much? 25,000, right? At the end of every year, 5 years, nationalized bank 8%. You want to know the maturity value. It is a future value of annuity or present value of annuity. Every year you want to deposit how much? 25,000. 25,000 is called periodic payment. What rate? 8%. How many years? 5 years. So future value of annuity equal to, just now I told you formula. What is that, ma? Future value of annuity equal to periodic payment into future value of annuity factor R percentage n number of years. With the same logic, if you implement here, so 25,000, 8%, 5 years factor value, 5.856. If you multiply, you will get it 1,46,675. What about the present value? Present value, what is the logic? Present value of annuity equal to periodic payment into present value of annuity factor R percentage n number of years. Can you solve this one in a simple way? A nationalized bank here, a nationalized bank agreed to give sum of how much? 25,000 for 5 years at the annual rate of 10%, right? Mr. Jain wishes to know how much should be deposited as on today. Means every year how much they are going to get it? 25,000. How long? 5 years. What rate is going on? 10%. In such a case, present value of annuity. Present value of annuity, periodic payment into present value of annuity factor R percentage n number of years. Where should I find present value of annuity factor table? Table number 4. If I check this table, I will get 3.791. By multiplying this, I got it. What is it? Present value of annuity. Are you getting? So this is the point to be done, right? Another one last concept is, what is that? Perpetuity. Perpetuity is nothing but forever income. What is it? Forever income. If you make a deposit, let us take you made a deposit here. Because of deposit, you are going to get it the cash inflow. How long you are going to get it cash inflow? How long you are going to get it cash inflow is nothing but perpetuity. Simply you can understand perpetuity is endless annuity. What is that? Endless annuity. Annuity means what is it? Already I told you. What is it? SS. SS means same amount, same time period, but it has certain time period is limited. Hello? T is there. S, T is there. But SS, no T. Forever. That is called what? Perpetuity. Puttaparthi group of organization, Tirumala Tirupati Devasthanam, Vatican City, all these things they used to maintain. What is it? Perpetuity. What is a reason to learn perpetuity, sir? When problem is permanent, don't think about stupid temporary solutions. When problem is, what is it? Permanent. But don't think what is it? Temporary solution. Think about what is it? Permanent. So if X is a person who went to bank and he said that, sir, if I deposit now, right, I need forever income. Forever I want to get it. So that forever income, what you are going to get it is called, what is that? Perpetuity. So perpetuity is nothing but endless annuity. What is that? Endless annuity. You are going to get the cash inflow. How long? Cash inflows, you are going to get it. What is it? Forever. Forever. I told you. TTD. Hello? Thereafter I discussed Puttaparthi. Yes or no? Thereafter Vatican City. All these things they used to maintain. Of course. Right. Balu sir perpetuity ఎలా అవుతారా? మనకు పర్పెక్ట్ వద్దమ్మా. పర్పెక్ట్ అవసరం లేదు. నీకు 60 years దాటితే మిర్రర్ కూడా చూసుకోలేవు నువ్వు. నాకెందుకు అంత అవసరం లేదు నాకు. సో వీ షుడ్ బీ, ఐ డోంట్ వాంట్ ఎ పర్పెక్టిటీ. అసలు బర్త్డే రోజు నిన్ను 100 ఏళ్ళు బతుకంటే అసలు 100 ఏళ్ళు వద్దు. అసలు గ్లామర్ ఉండదు అసలు. అప్పుడు బతికితే ఎంత, బతకపోతే ఎంత? ఎస్ఆర్ నో? నిన్ను 100 ఏళ్ళు ఎందుకు? 100% డిప్రిసియేషన్. ఐ డోంట్ వాంట్ దట్, రైట్? ఏదైనా పోయినా ఎలా పోవాలి? గ్లామరస్గా పోవాలి, కానీ డిప్రిసియేట్ అయిపోయి మనకు అవసరం లేదు బాబు, మాకు వద్దు అంత నిన్ను 100 ఏళ్ళు. సో వీ నీడ్ వాట్ ఈస్ దట్ ఫ్యూ ఏళ్ళు. విత్ దట్ ఫ్యూ ఏళ్ళు మీన్స్ టైమ్ రా. With that time period, what happened? We have to do the miracle. When body, language, energy, everything is there. At the time, what you can't to do, at the end of 100 years, what you are going to tour paper man? ఏం చెప్తారు నువ్వు? అప్పుడు చేసే టైంలోనే చేయలేదు, ఇంకా అప్పుడు నిన్ను 100 ఏళ్ళు అప్పుడు ఏం చేస్తావు? Perpetuity is not at all useful. Yes or no? Do you agree my point, ma? Yeah, that is perpetuity. Perpetuity, simple logic is forever income. How many types of perpetuity? 2. What is that? Present value of normal perpetuity, present value of growing perpetuity. If the amount what you are going to make because of your deposit, suppose you made it a deposit here, right? Forever same income you will get it is called, what is it? Present value of perpetuity. Present value of perpetuity formula ma? Cash flows divided by what Maji? Rate. Okay? Cash flows divided by rate. Whereas present value of growing perpetuity means if you make a deposit or some amount, right? Every year cash inflow what happen? Increases. This is how long? Forever, sir. This is called present value of growing perpetuity. Present value of growing perpetuity equal to cash flows divided by rate minus what is that? Growth rate. So, which would be the better one? Present value of growing perpetuity. Present value of growing perpetuity is a better one. Why? Because this considers impact of what is that? Inflation. Yes or no? Inflation impact it considers. Which one? Growing perpetuity. Array, Puttaparthi group of institution is happen. If the company maintains same amount, will they get? No. First year, second year, okay. Thereafter, you cannot handle the organization. That's why you have to create what perpetuity? Growing perpetuity. So, growing perpetuity is the very, very important one. Now, present value of perpetuity, present value of growing perpetuity. What is the present value of perpetuity formula? Tell me. Cash flow divided by, see, X Limited issued forever, he is going to get it how much? 1000 rupees, and the 10,000 is going to get it interest of how much? 10%. But his expected rate is 15%, means 1000 on 10% means he is going to get it 100. 100 divided by 15% means how much he has to deposit? 6,667. For example, if the growth rate is there, then you have to deduct which one? Growth rate. There is a one more problem is given. Mr. Ram wants to purchase a building where he has to give a lease rental that building, right? He is to get the lease rental amount of how much? 6 lakhs. But it is going to increase by 2%. Means Mr. Ram is going to get the cash flow every year 6 lakhs plus 2% interest. Yes or no? Forever he is going to get it. In such a case, how much amount of worth he has to spend to buy that building? That is the point. His expected rate is 12%. Now tell me how much every year he is going to get it? 60 lakhs, right? What is in his expected rate is 12% minus growth rate. That is the formula, right? What is the present value of growing perpetuity? Cash flow divided by rate minus growth. Now by applying this formula, check this one. 60 lakhs divided by 12% minus 2%. You got it? 10%. So 60,000, 6 lakhs divided by 10%. How much ma? 60 lakhs. Here 0 is missed, right? So these are the concept with respect to time value of money. Got it, Maji? So what are the concept we discussed? So simply we covered what is the time value of money, basic time value of money, worth of Y rupee to be expected, and thereafter we discussed the simple interest, compounding and discounting pattern, future value single amount, whereas estimation of present value of single amount, and we discussed annuity. Annuity is mean future value of annuity, present value of annuity, and perpetuity. Perpetuity again, present value of perpetuity, present value of growing perpetuity, right? Okay, with this next chapter we will discuss what is that? Capital budgeting. So this is the book number 3, capital budgeting. In this capital budgeting, first of all you should understand what is a capital budgeting. Very simple. What is a capital budgeting? Sir, systematic investment on what assets? 2 marks question they may ask you. What is a capital budgeting? Very important chapter. Yes or no? Pay attention. So capital budgeting. Total 22 pages I prepared for this. 22 pages. ఎంతసేపట్లో చేయాలి? గుర్తుండిపోవాలి అలాగే చరిత్రలో. అరే మీ మెటీరియల్ చూపించి అలాగే చెప్పడం నాకు 1 సెకండ్ మ్యాటర్. కానీ ఇంత వర్క్ చేసి ఉంటానంటే నేను ఎంతసేపు వర్క్ చేసి ఉంటాను. దీనివల్ల మీకు ఎంత బెనిఫిట్ వచ్చిందో తెలియదు కానీ ఐ బికమ్ ఎ ఎక్స్పర్ట్. I work this one because having a passion on this subject and at the same time more passion to make you to wealthy people. మిమ్మల్ని భవిష్యత్తులో లక్షాధికారులు కోటీశ్వరులుగా చూడాలని నా భావన. కానీ నాకు చూడాలని ఉంది, మీకు చూడాలని ఉందా? మరి కానీ ఇక్కడ తీవ్రంగా చూడు. క్యాపిటల్ బడ్జెటింగ్. ఓకే, capital budgeting is very simple. Systematic investment on what assets? Fixed asset. So it is a capital budgeting. It is a It is a systematic evaluation of short-term project or long-term project. Yes, this is the one point you have to understand. Long-term projects. So long-term project you have to understand. So capital budgeting is a systematic evaluation of long-term projects. Okay. It is also called okay, capital expenditure planning. What is it? Capital expenditure planning. Okay, planning. Sir, why should I learn capital budgeting, sir? It enables, man, if you learn the capital budgeting, it enables you, what is it? It enables how to invest what? How to invest on short term asset, long term project. How to invest in, what is that? లాంగ్ టర్మ్ ప్రాజెక్ట్. చూడండి ఎంత బ్యూటిఫుల్గా చెప్తున్నాడు. ఒక లాంగ్ టర్మ్ ప్రాజెక్ట్లో మనం ఎలా ఇన్వెస్ట్మెంట్ చేయొచ్చు అనేది కన్సిడర్ చేయాలి. వేల కోట్లు ఒక షర్ట్ కొనాలంటే కంగారు పడుతుంటాం సమ్ టైమ్స్. వైల్ ఇన్వెస్టింగ్ 1000, 2000 crores of rupees of investment means it's not as simple as, man, right? That is, you need a lot of investment skills to be in investment. So that is how to invest in, what is that? Long term project. This is a capital budgeting. Tell me, what is a capital budgeting? Yes, good. It is a systematic evaluation of long term project. It is also called, so how to invest on what project? Right. Why, sir, capital budgeting నేర్చుకోకపోతే ఏం, sir? Why? It is a capital budgeting so important. Sir, capital budgeting is so important because your client who want to make investment on fixed asset is include small amount of substantial expenditure. Substantial expenditure ante, so the client who is going to make investment in this project involves, what is it? Huge expenditure. That is the reason you must learn. Hello, buying a pen is not a matter. Buying a plane is an ultimate matter. Yes or no? Where you are going to spend such a crores means you must have evaluation technique. Another one is, it is irreversibility. What is it? Irreversibility means what? If your client invest on fixed asset, he never get it his money back. Hello, that is the reason you have to learn what? Investment capital budgeting. Then you have to identify it. If it is reversible, no need to learn what? Capital budgeting. Only issue happens only when there is a, what is that? Irreversibility. Another one, tell me, huge risk, yes or no? And short term impact or long term impact? Long term impact, right? Long term impact means you are expert, you made it investment in a wonderful way. Because of this long term, if you made it capital budgeting decision, you made it investment, you will get benefit. Short run or long run? Long run. Because of you cannot made investment, you make a lot loss. Is it give short term or long run? For example, by attending Balusar class, if you clear CMA, your grandson, daughter also settled, right? Yes, చూడు ఎంత కాన్ఫిడెంట్గా చెప్పిందామి. నా మనోడి లైఫ్ కూడా సెటిల్ అయిపోద్ది. నేను నా కోసం చదవట్లా, నా మనవడి కోసం చదువుతున్నానని పెన్ను తీసుకొచ్చింది ఒక మహిళ. ఎస్ఆర్ను చదివితే అలా చదవాలరా అసలు. ఎస్ మా ఓకే. సో ఇట్ మీన్స్ దట్ ఈజ్ ఇట్ షార్ట్ రన్ లాంగ్ రన్? ఇట్స్ అ లాంగ్ రన్, మ్యాన్. ఇట్స్ అ లాంగ్ రన్. సో క్యాపిటల్ బడ్జెటింగ్ ఇండికేట్స్. హావ్ యూ సీన్ ఇట్? మా తాతగారు, అప్పట్లో మా తాతగారు, దెర్ ఇస్ అ తాతగారు, ఆంధ్రప్రదేశ్ తాతగారు ఎన్టీఆర్. ఎస్ఆర్ను ఎన్టీఆర్ పేరు చెప్పుకుని ఎంతమంది బతికేస్తున్నారు? బతికితే అలా బతకాలి అసలు అందరూ, right? Capital budgeting is short run or long run? Yeah, this is the very, very important for capital budgeting. Various methods, but capital budgeting identify challenge various methods. Yes or no? Methods of capital budgeting. So methods of capital budgeting being classified into how many? 2 types. Yes or no, ma? One is, what is that? Traditional methods. Traditional methods ignores. Yeah, traditional methods ignores, what is that? Time value of money. Ignores TVM, right? Ignores TVM. In traditional method, you have a 2. What are they? Payback period. What is that? Accounting rate of return. Whereas in modern method, what is that? Considers TVM, time value of money they will consider. What are they in this method? A, NPV. Number 2, IRR. Another one is a discounted payback period. Another one is profitability index. Okay, ma? So traditional method, modern method, both are same, ma? No. Okay, this concept also covered. To evaluate any of these methods, what happen? You have to consider the cash flows. Hello? Cash flows of the project. How many types means? Cash flows of the project being classified into two types, ma, actually. So one is, what is that? Cash outflow. Hello? Cash outflow. If you make investment, it is a cash outflow. And another one you will generate, what is that? Cash inflows. Cash inflows again classified into two types. What are they? Operating cash inflow. This is called, what is that? Operating cash inflows. Okay. And thereafter another cash inflow is terminal cash inflow. Following? Terminal cash inflows. Okay. Now a project is worthable. How do you say? Your cash inflows are greater than cash outflows. Project is financially okay. Yes or no? Financially okay. It is worthable. Okay. Without anything, you can say simply, okay, Rachel, like it. If you want to say, right, you have to identify what is it? Cash inflow. Are you getting? So cash inflow being how many? 2. Yes or no? Cash outflow is nothing but 1. If you want to say financially, is it okay or not okay, sir? Means beneficial, accept or reject, that depends upon everything. If you want to consider, you have to analyze the cash flows. Tell me cash flows of the project. Cash outflow, inflows, operating cash inflow. How do you say this project is worthwhile or not? Yes, sir. Operating, terminal, add it and compare with cash outflow. Then you can get it, right? And another most important method is given. What is that? Payback period. For 5 marks, they will get it. Payback period. What is the payback period? If you invest any project, how long you have to wait to recover your investment? Payback period is, what is the meaning, right? The point is, it is the time period in which invested cash outflow can be recovered from. Time period required to recover investment. Okay, payback period is, it is the time period required to recover investment from its what cash? From its cash inflows. Hello. Payback period speaks about a length of time duration. What is it? Length of time duration. Time duration. So for what is that? Recovery. Recovery of what, Balu sir? Recovery of investment. So as per payback period, which project should be accepted means which project gives you what is that? Investment in a smartest way. That is called what is that? Payback period. How do you calculate the payback period, sir? That depends upon two formulas. Every year equal cash inflows are there. What is that? Equal cash inflow. In such a case, payback period equal to initial investment divided by annual cash inflow. Hello? Initial cash inflow divided by annual cash inflow. Whereas when every year, what is that? Unequal cash inflows are there. Unequal cash inflow. In such a case, payback period equal to, you have covered year plus balance divided by next year CFAT. Hello? Next year CFAT, you have to calculate like this. For example, I invested 10 lakhs. Every year I used to get it 5 lakhs over the period of 10 years. In such a case, payback period is how many years? Hello? 10 lakhs I invested. First year 5 lakhs. Second year 5 lakhs. Like that I used to get it 10 years, man. Should I take a 10 years payback period? No. If I invest my money, it is going to recover how many years? 2 years means the payback period would be 2. Hello? What is the decision making? How do you take a decision? Very, very important point is always keep it in mind. Once payback period is calculated, payback period is compared with what is it? Standard payback period. What is that? Standard payback period. If payback period is, let us take 4 years, standard expected payback period is 8 years. In such a case, actually you expected 8, but you are recovering how much? 4 years. In such a case, project should be accepted. So payback period is less than standard payback period. Project should be accepted. More than, this is everything you know that. More than payback period, project should be accepted or rejected? Rejected. Whereas payback period is more than standard payback period. Payback period is more than standard payback period. In such a case, project should be accepted or rejected. Rejected. Are you getting ma? The payback period. Once you calculated payback period, what you have to do? Payback period is less than standard payback period. Accept. More than that, reject. Equal to either accept or reject. So multiple projects means accept which one? All the project if the payback period is less than standard payback period. Whereas if the projects are mutually exclusive, in such a case, accept the project with what? Least payback period. So this is the with respect to what is that? Payback period. Okay, payback period. But here in simple way I wrote it, payback period is less than standard payback period. What you can say? Accept. Okay, accept. Whereas if the payback period is greater than standard payback period, reject. Payback period is equal to standard payback period, either accept or reject. Okay, then we have the another concept, NPV. What is the NPV? NPV is nothing but it is the value or benefit derived from the project as on the day of investment. So what is the NPV? N means net. Are you getting? Net. Present value. Value means benefit or wealth. You can say wealth. So value. Net means what is that? Here indicates all. Let us take how you are getting net present value. You are deducting from the revenues variable cost, fixed cost, tax, legal cost and treatment of depreciation. Thereafter present means you are bringing into present means you are doing a discounting. Discounting means with that indirectly you are deducting financing cost called interest. It means that variable cost, fixed cost, tax, interest, thereafter cash outflow you will deduct what is that? Investment also. Whatever the value after all the values are deducted, finally how much you will get in is called what is that? Net present value. That is the point you can say. It is the value or benefit derived from the project as on the day of investment. So if you invest in this project, how much value you are going to get it as on today is called what is that? Net present value. So net present value formula, NPV equals to PV of cash inflow minus PV of cash outflow. Or can I write like this? PV of what cash inflow? Operating cash inflow plus PV of what cash inflow? Terminal cash inflow minus PV of what? Cash outflow. Okay. So this is the NPV. How do you take a decision basing on NPV? Where NPV is positive, the project should be accepted. NPV is negative, then project should be rejected. So basic simple idea is if project NPV is equal to or greater than, if NPV is greater than 0, project should be accept, right? If NPV equal to 0, either accept or reject. Whereas if NPV is less than 0, then what happen? Reject. So this is the basic idea with respect to what is that? NPV. Once the calculation is completed, we do this one, right? Next one is what is it? Profitability index. So profitability index, here you see index indicates here 1. For every 1 rupee, how much the profitability company is going to generate is called what is it? Profitability index. So profitability index speaks what? If you invest 1 rupee, it is the outcome of rupee invested. Hello? If you invest in a project, right? So for every rupee, how much it is going to generate? It indicates that you are not going to invest 1 rupee. Hello? You are going to check the pulse rate of the company for every 1 rupee, how this project is effectively utilizing. So profitability index is really wonderful technique. It is more valuable at the time of what is that? Scarcity of funds. When scarcity of funds are there, right? In such a case, what happens? Profitability index supports. You know that there is a one beauty point with respect to this is NPV guides you. NPV guides you invest. Okay, invest. We will calculate what is that NPV positive. What we say? NPV positive. We say that invest. But the profitability index speaks that what is that? Profitability hides that order of preference of invest. Hello? Are you getting? What is it? To try to understand how wonderful it is. Profitability just says investment says invest. But profitability index says order of preference of invest. Sir, why should I go for order, sir? Hello, bachcha. Tera paas paisa nahi hai re. If you have adequate funds, NPV is a supreme super technique. But you know, when funds are scarce in such a case, oh, we have to learn profitability index. You see, any corporate company funds always limited only. Even my owner also says that Balu, today is a third rent inka. Avuna? But he has a 14 buildings in Bradipet. But even the rent he is expecting means what he say? Rent. Actually, I don't have what? Funds. He said that. I said, don't worry. You are always in profitability index. I'm in NPV. Already I shared money yesterday. Your son phone pay. Check and ask your son. Okay. నిన్న సాయంత్రం పంపించేసారు నా దగ్గర డబ్బులకి ఏం కొరత లేదు హలో నువ్వేరా ప్రాఫిటబిలిటీ ఇండెక్స్ గురించి చెప్పుకుంటున్నావు అనుకున్నా దిస్ క్లాస్ ఈస్ రికార్డింగ్ ఎవ్రీ ఎగ్జాంపుల్ ఈస్ కోటెడ్ ఫర్ ద పర్పస్ ఆఫ్ అకాడమిక్ ఓకే సో నౌ టెల్ మీ ఎన్పివి ప్రాఫిటబిలిటీ ఇండెక్స్ బోత్ ఆర్ సేమా సార్ ఎన్పివి బోత్ కెన్ బి గైడ్స్ యూ టు హౌ టు సెలెక్ట్ ఎ ప్రాజెక్ట్ ఇఫ్ ఎన్పివి is positive accept profitability index is greater than 1 accept but what is the difference of this one sir why I am learning this why I am learning this means sir NPV guides you invest profitability index guides you order of preference of investment profitability index super at the time of what scarcity now tell me how do you calculate profitability index equal to Maji tell me formula profitability index equal to PV of cash inflow divided by PV of cash outflow or can I write like this PV of what cash inflow operating cash inflow plus PV of terminal cash inflow divided by PV of what is that cash outflow. How do you take a decision Balu said calculate profitability index if profitability index greater than 1 in such a case accept. So profitability index is less than 1 you can say what is that reject whereas profitability index is equal to 1 either accept or reject. So this is the point of profitability index. Are you getting? So thereafter we have what is it? Internal rate of return. Okay. Internal rate of return also very very important technique to be identified. So internal rate of return technique what it speaks that. So if you invest in a project how much maximum return you can generate. So it indicates you see the return means what is it? Profit only. Hello. This profit in the form of what is it? Rate only. This rate indicates in the form of internal. Now you added 3 lines to this. Number 1, kya hai? What is this? Return. Return means you have to calculate profit. Hello. Number 2, what is this? It is always in the form of rate. It means that what? You have to convert into percentage. This is nothing but internal indicates that your capacity indicates. So internal maximum. What internal rate of return IRR indicates? It is the you keep it in maximum rate of return. Maximum rate of return one can earn from the given project. Given project is called what is that? IRR. Or you can say it is the maximum rate of interest or cost. Maximum rate of interest one can pay to undertake a project. Undertake a project is called what is that? IRR. Simply it is a rate to be earned. Hello, maximum rate of return. Because sometimes the corporate companies, they used to estimate what is the maximum rate of return I am going to earn by investing in this project. So that maximum rate of return to be generated from this project. Once I am able to generate that much of rate, means I can pay, what is it? Maximum rate of interest, right? So simply what do you say? IRR is nothing but it is a discounting rate at which NPV equals to 0. Okay. So to calculate this IRR, you should understand IRR. IRR is a discounting rate. IRR is a discounting rate at which NPV equals to what is it? 0. Because NPV equals to 0 means at that discounting rate, at that much of rate, your NPV is 0 means you maximum pay that much of interest only. Hello? When you are paying that much of interest means you are generating that much of return. Hello, are you getting my point? I'm capable of paying 14% interest. 14% interest I'm capable means I'm generating how much? 14%. So that would be to understand the formula of ARR, you should know the Maha Mantra is nothing but IRR is a discounting rate at which NPV equals to 0. Now what you do is here NPV at IRR equal to 0, right? Hello? That is the reason simply in IRR you have to trace the rate. For this purpose what you do is you have to calculate PV of cash inflow at IRR minus PV of cash outflow equal to 0. By taking this value you have to trace which one? IRR. Got it? So any calculation which represents only one point you should understand. IRR is a discounting rate at which NPV equals to 0. So NPV at IRR equal to 0 means PV of cash inflow at IRR minus PV of cash outflow equal to 0. So decision making, how do you say decision making, ma? So IRR is what is it? Greater than cost of capital. What do you say? Accept. Hello? Whereas IRR is less than cost of capital. Reject. Whereas IRR is equal to cost of capital, either accept or reject. So this is the point with respect to IRR. So sir, IRR equals to cost of capital, sir. Maybe if you are raising funds at 15%, you are investing at 15% means your NPV is 0. You are not going to get it any benefit, right, ma? So that is now tell me, when a company is making wonderful profit means what is the basic idea for this? So company if generates IRR more than cost of capital, then only the company could make what is it? Wonderful, great, better return. Are you getting? So this is the IRR. IRR represents in amount of percentage. Percentage of IRR is 10%. Let's tell ABC Limited. ABC Limited IRR is how much percentage? 10%. What do you mean of this? 10% means it is the maximum return they can generate from this given project. Hello? And since they are generates maximum of how much? 10% means, so whatever the capital they have a proposal to raise, hello, they see to that the returns or the financing cost must be less than 10%, because you are going to generate maximum of how much? 10%. In such a case, you should not raise cost more than 10%. So this is the identity. Once again, tell me IRR is maximum rate of return. Maximum rate of return you can generate. Sir, again you wrote maximum rate of interest or cost. Yes man, I am generating this much of return means I can pay that much of cost. Okay. To calculate IRR, what is that? There is a Maha Mantra. What is that? IRR is a discounting rate at which NPV equals to 0. Thereafter, we have what is it? Discounted payback period. What is a discounted payback period? It is the payback period. It is the payback period which considers what is it? Time value of money. Which considers time value of money. So it can also speaks, what is that? Length of time duration. Hello? Length of time duration. Duration of what? Investment recovery. Investment recovery by considering, this is considers time value of money. With the considering time value of money, it speaks, what is that? Length of time duration. It is superior one. Which one? So it is a superior one comparing to which one? Payback period. So traditional payback period, comparing to traditional payback period, this method is very, very superior, effective, productive one, because that one could not consider which one? Time value of money, whereas this considers time value of money, right? So formula to be used. So it's very simple. Payback period every year equal means, in this situation we are not going to calculate, you are not going to get every year equal cash inflow. Why? Because every year cash inflow what happen? May varies. So formula would be same. Discounted payback period. By chance every year equal cash inflow? May not possible. By chance if it is there, initial investment divided by annual cash inflow, na discounted cash flow, na discounted cash flow. There we wrote the formula. Formula initial investment divided by annual cash inflow. But here initial investment divided by discounted cash flow. Whereas second formula, this is happens when equal cash inflow. What Maji? Whereas unequal cash inflow is there in such a case. Discounted payback period equal to initial investment divided by initial, not initial investment, here covered year plus balance. So covered year plus balance divided by next year CFAT. So next year CFAT, this is the point. Finally, what the decision you can write? How do you take decision? Sir, when discounted payback period is less than standard payback period, you should, what is it? Accept the project. Whereas when discounted payback period is greater than standard payback period, you have to reject the project. When discounted payback period equal to standard payback period, either accept or reject. Hello? So this is the way to find it out. Following ma? So what is the difference between payback period and standard payback period? Payback period considers which one? Time value of money. Payback period ignores, what is that? Time value of money. Standard payback period considers time value of money. Okay. So standard payback period is more superior than which one? Payback period. Got it? So that is the point. And thereafter you have accounting rate of return. Now try to understand here also, what is this? It is nothing but return. Return means profit only. Hello? This profit in the form of what? Rate, right? But this profit is called accounting profit. Accounting profit means accounting profit after tax. What is it? Profit after tax. What is the accounting rate of return means? It is the average annual yield, or earnings made from the given projects, So ARR, it is the average annual yield generated written from the given project. Suppose ARR of the project is 20%. What do you mean of this? ARR of the project is 20% means you made it investment today, right? Investment. So your investment as on today Y0 is, let us take a 40 lakhs. Every year, first year business you're doing, second year, third year and fourth year. Like this every year it is doing. Every year company is supposed to generate how much? 20%, 20%. It means that when company able to generate 20%, being a financial manager, whatever the investment you raised from market, right? Let us take in a bank you raised. What the interest rate of the project is 5%. Now try to understand. At 5% you are raising funds. Hello? 5% you are raising funds. You are investing 20%. So should we accept this project or not? So every year, how much return we supposed to generate from the project could be estimated. What is that? 20. That is called average annual return. This is a return which is called accounting. Why? Because it follows accounting profit. That is called what profit? Profit after tax. It is also called average annual rate of return. Hello? Average annual rate of return. Why used to call average annual return? Means every year this profit is, what is it? Same. Hello? Every year 20, 20, 20, 20 means in average it would be the same. Okay, how do you calculate ARR and how do you estimate? This formula means estimation of ARR have three methods to find it out. Okay, one is ARR estimation, ARR on total investment basis. What is that, ma? Total investment, you can take it. In total investment, what do you say? Average profit divided by total investment. What is that? Average profit divided by total investment. Second one is ARR equal to, can be estimated, average investment. Hello? Average investment. Where average investment equal to average profit. Okay? Average profit divided by, what is that? Average investment. Average investment, you have to take it. Okay? Whereas ARR average investment here indicates average investment equal to half of initial investment minus scrap value plus additional working capital. You should make it investment. And there is a one more method is left to you, is called, what is that? Another method is, what is that? On, what is that? Total investment basis. What is that? ARR on what basis we done it now? Average investment. Here it is total investment. Average investment formula we took it. And third one, ARR on the basis of annual rate of return. What is that? Annual investment basis. What is that? Annual investment basis. In annual investment basis, how the ARR to be calculated, right? You know. So here they will take every year profit after tax. Hello? Year 1, year 2, year 3. Let us take. Every year they will take, what is it? Average profit. Every year they will take investment in the beginning. Are you getting? Investment when it is? Beginning of the year. Beginning of the year, whatever, for example, you purchased asset. You purchased asset 6 lakhs. 3 years it is going to run, means every year asset gets depreciation of how much? 2 lakhs, let us take. Hello? So it means that asset you purchased, how much worth of asset as on today? You take it. When at the end of first year. Second year again, how much this asset? But here the asset worth is this much. But second year it would be this much. Why? Very good. Because asset gets depreciation. By holding this much of asset, you are generating this much of profit, means great only, you know, man. And third year it would be how much? This would be, because of your investment is gradually decreases. So every year they will take a beginning of the investment. What the company do is, by holding this much of investment, you are generating this much of profit. Second year, by holding this much of asset, you are generating this much of profit. And third year, by holding this much of investment, you are making. So now what do? You make it, what is it? Our return you have to calculate. Return equal to A divided by B. Hello? A divided by B you have to take. You will get, what is that? Some rate. Let us take, here it is 18% you got it. Here 20% you got it. Here 24% you got it. Because as the investment is, what is it? Decreasing, your investment also increases, right? Your investment also decreases. In such a case, finally, how do you calculate ARR? Tell me. So here you got the every year 18, 20, 24%. What is the hidden reason? You try to understand. Every year asset is getting, what is it? This much of asset came to this much, making earning Ram Charan is not a great comparing to Chiranjeevi ji, because Chiranjeevi ji is a depreciated. అంత ఏజ్లో కూడా అంత ఎర్న్ చేస్తున్నాడంటే బెటర్ కదరా బాబు. ఆయనతో పోల్చుకుంటే అమితాబ్ బచ్చన్ ఇంకా సీనియర్ మోస్ట్. ఎస్ ఆర్ నో? బట్ ఈవెన్ దే ఆర్ మేకింగ్. నౌ ఫైనలీ యూ కెన్ క్యాల్కులేట్ రేట్ ఆఫ్ రిటర్న్ ఈజ్ హౌ మచ్? టెల్ మీ. You can calculate ARR equal to average annual rate of return. Simple. In such a case, can you say 18 plus how much ma? 28.67% is what is that? ARR. So ARR is how do you take a decision making? Decision making, you are coming to decision making, you say simply ARR is greater than cost of capital, then project should be accept. ARR is less than cost of capital, reject. ARR is equal to cost of capital, accept or reject. So this is the ARR is less than cost of capital, reject. Whereas this is the 1, this is the 2, and third one, when ARR is less, ARR more, ARR equal to cost of capital, either accept or reject. So these are the concepts. Totally all the methods we covered, right? In exam, I observed your problem. Majority they been asking what is that NPV. By missing value, once again they are going for what is that comprehensive model. Okay, but meanwhile within a limited time period, I understood by reading your entire paper, I came to know that there are certain questions they been asking. These are so far whatever I told you, that is the methods. But in that methods, what happened? They are injecting several concepts. What are the several concepts? Here it is. Treatment of working capital. Do you know the working capital treatment? These are the points. I observed everything. I made a note. Then I came to know that only the given methods won't come, right? Since time is not comfortable. 24 hours given for capital budgeting. Maximum within a 1 hour. If I might have started NPV, that 1 hour has gone. Okay? But thing is, I should not solve the problem and explain. I should give you information in such a way that you should be able to solve any problem. So what shall I take NPV or shall I give the major concept? I analyzed all the concept. Treatment of working capital. They are given one problem in your material. So the point is, when company makes investment, fixed asset, along with fixed asset, company makes investment on what? Current assets also. So sometimes you have to invest the current assets. Beginning current assets would be invested how much? 100%. Hello? At the end, particularly in a terminal cash inflow estimation, you should make 100% R. R means recovery. Hello? So beginning you have to make how much? 100% I. Investment you have to make. But whereas at the end of the period, right, it is not mandatory that every business should have what? Working capital. Hello? Working capital is investment on what assets? Current assets. In order to make investment, sometimes they will give you, this is the treatment, you should keep it in mind. Number 1, treatment of subsidy. Subsidy means whenever you will start a business, government may gives you, what is that? Subsidy. When subsidy is given, then automatically it should, what is that? Deduct. Hello? This will reduces your cash outflow. Hello? You should deduct it from cash outflow so that your cash outflow value would be decreases. And there is a problem, they have asked variable cost ratio. Variable cost ratio formula, why variable cost ratio is given means to find it out, variable cost per unit. Variable cost ratio equal to variable cost divided by sales. Hello? Whereas contribution equal to 1 minus what is that? Variable cost ratio equal to contribution. Subsidy already we discussed, right? Tax and tax shield. When company makes a profit, you have to pay tax. When company makes a loss, sometimes you will get what is that? Tax shield. Tax shield is an inflow. Tax is what is that? Outflow. Thereafter, set off losses. Sometimes you may get the profit, right? Sometimes you may get the profit. Sometimes you may get the loss. If at all any year loss you got it, instead of getting tax shield for the concerned year, you may get what? Set off for the next year future profits. Hello? You got, suppose this year you got it a 40 lakhs of loss, man. 40 lakhs of loss. Tax is 50%. 40 lakhs loss means you will get the tax shield is how much? 20 lakhs. Hello? You will get the tax shield. But what the government says, if you skip to take this 20 lakh tax shield today, okay, but next year, how much profit you will make? How much profit will make? From this concern loss, you can make what? Set off. Hello? You can set off and you can deduct it from the next year profit. That is called set off. Okay? And the treatment of depreciation in the presence of tax and in the absence of tax. Balu sir, depreciation is a tax allowable expenditure. Hello? When there is a tax, you have to consider. When there is no tax, no need to consider depreciation. In the problem, sometimes they will skip the tax, they will give you depreciation. Hello? Don't consider. Sometimes they will give you tax, then they won't mention that which method to be taken into. They will be silent. Hello? They give tax, but they never mention what is that? Depreciation. In such a case, you have to take any of the method, take assumption and consider depreciation is there because tax is there, right? But sometimes they will tell you depreciation, this method I am using, but he would be silent with respect to what? Tax. In such a case, you should not take, because that is the most important. Treatment of depreciation in the presence of tax and in the absence of tax. Thereafter, one more point also is there, payback reciprocal. Payback reciprocal means it is a percentage of recovery of investment from the given project. It's called what? Payback reciprocal. So payback reciprocal formula 1 divided by payback period. And there is one more point you should understand, difference between profit after tax and what is it? CFAT. Hello? PAT means just now we discussed accounting profit. What is the worst thing of accounting profit? Accounting profit considers cash expenses as well as non-cash expenses. Sales as well as, sales means cash sales as well as credit sales. I repeat, cash expenses, non-cash expenses. Sales as well as cash sales, credit sales. That is the worst thing. Because of considering these two things, if you use the PAT, you cannot project the real relationship between set profit and available cash. If you are a financial manager, you say that I made it a 40 crores of profit. 40 crores of profit is what profit? Accounting profit. Go and check your cash balance. You never find what? 40 crores you never find. Why? Because you projected which profit? Accounting profit. Because of one of two worst things. What are the two worst things of PAT? It considers cash as well as non-cash expenses. And it considers sales as well as, it means cash sales as well as credit sales. Are you getting my point, ma? What about CFAT? Pure cash profit. How much profit you say is exactly the same cash profit you will find in your cash box. Because whatever the mistakes which do, accounting profit it never do. Hello? So it considers two things. What are they? Cash profit. Cash profit means it takes, sales means only cash sales. Hello? It takes only cash expenses and non-cash expenses means it takes only cash expenses. It never takes, what is that? Non-cash expenses. Are you getting my point, ma? So that is the observation, and for that purpose, my capital budgeting means in Dubai they are planning to construct this moon restaurant. Hello? This much of moon restaurant if they want to construct means you must have whatever so far I discussed with you. Hello? All these methods you have to learn. Otherwise, it could not possible. You try to understand, if the switch on, automatically entire Dubai will get the small moon. How much investment it is? Crores of rupees. Hello? That much of rupees. It is a Saudi Arabia restaurant. Already they constructed this building. This much of biggest. If you can able to solve this budget, capital budgeting means you must learn all the methods so far I discussed with you. Are you getting? So this is the important point. And with respect to exam, right, I considered one more problem is here it is NPV oriented one. This problem covers all the important concept, right? You see that XYZ Limited introducing a new product with a project life of how many years? Array, this one problem is enough because it covers all the concepts, right? No need to write because we don't have, right, man? For example, if I solve this problem, it will cross to 1 o'clock. But meanwhile, I'm going to give you why I took this one, and maximum I want to give all the benefit, all the important concept covered in this problem. You see, XYZ Limited planning to new project. Life is how many years? Initial cost of project is 3.5 crores. Additional equipment cost is 25 lakhs. Will be purchased at the end of third year from the cash inflow. You try to understand. You are going to make investment, but it's not from your pocket. From the third year cash inflow, whatever generates, from that cash inflow, you are going to buy an asset. How beautifully he asked. Okay. And original equipment will have no resale value, but additional equipment will be sold for 2,50,000. Working capital 40 lakhs. Treatment came, what treatment? Working capital treatment. And multiple assets we are going to start this project, right? And will be needed at the and working capital needed will be needed, and it will be realized. How much percentage it is going to realized? अभी तो मैं बताया था working capital 100% क्या है? 100% investment, 100% R, 100% recovery. By keeping this point only, I took this problem. Okay, and this project will produce how many units? 72,000, 1,08,000, 2,60,000, 2,70,000, 1,80,000. Selling price how much? 2 for. Variable expenses amounted to 60%. What this? Variable cost ratio in where a variable cost ratio is how much? 60% means what is a 40%? Contribution. Contribution per unit, how much how do I get? Are contribution per unit maji. Contribution ratio you can say, I know that. How much it is? 40%. Contribution per unit, how much you will get? 240 into 40%. Are you getting? Right. Whereas depreciation, you see, fixed operating cost excluding depreciation is 36,000. Means there is a one more concept here. What is given, Maji? Tax is, depreciation is given, right? Should I consider, should I ignore, sir? I could not consider. So far data ignore. Why? Because so far no data. But in the problem, what is there? Tax is there. How much percentage? 30%. When 30% tax means you have to consider, right? The loss of any year will be set off. What is the loss of any year set off? I given here. Set off losses, what Imaji? Set off loss I gave, Set off loss indicates what is it? If the concern year you will get the loss, don't worry. Next year you may set off. But this year you won't get it, the what? Tax shield. How many? Total 11 points. This 10 points exactly covers in this problem. Majority. If you understand this problem, yes, okay. With this problem knowledge, you can practice well and you can able to solve any of the problem. And considers cost of capital is 12%. Appropriate cost of capital. You have to calculate straight line. Depreciation is what method? Straight line method. Straight line method formula, you know that cost minus scrap divided by, right. Calculate net present value of the project. What will be the investment if the government provides, what is it? Subsidy. You see, subsidy covered. Variable cost ratio covered. Contribution ratio covered. Working capital covered. Net sale proceeds is covered. Net sale proceeds, one project is 0. Another project is nil. Hello? This is the set off concept. Wonderful problem, right? Now you see it. How do I do? Cost of initial equipment 350 lakhs. Let's add what I do. Working capital. Working capital kitna maji? 40. I have to add, that is only I told you, right? So cost of equipment, add working capital 40. Total investment how much? 390. Initial cash outflow 390. Balu sir, small mistake. What is that? Sir, second machine. That is a second bit subsidy. Additional equipment you ignored, sir. When I purchased, that is third year. Very good. Okay. That is the important point, ma. Here this point is no need to consider because already this point covered, right? Here total initial investment is 3,90,000. Depreciation I have to calculate, Maji. Depreciation what method? Straight line method. So straight line method means cost minus scrap divided by life. Depreciation 350 lakhs minus 0 divided by 8. 43.75. Okay na? Whereas additional equipment 25 lakhs minus 2.5 scrap value divided by 5. 4.5. Then what I have to find it out? Contribution per unit I have to find it out, right? So selling price per unit is 240. Variable cost ratio 60. Contribution ratio equal to 1 minus variable cost ratio. 1 minus 60% means 40%. So contribution per unit is selling price into contribution ratio. So 240 into 40%, 96. Then you see this much of problem you have to take. Total how many columns? 1, 2, 3, 4 to 5. Balu sir, 4 to 5 means what, sir? 4th year same column, 5th year same column. Hello? Thereafter 6th year same column, 7th year same column. Then same column means how do you bring into present, sir? I will tell you 2 strategies. Hello? Strategy 1 is how to bring this same cash inflow into factor. Present means either sum the present value factors. 4th year present value factor, 5th year present value factor. If you sum it, you will get it. Now tell me, Maji. You see sales volume, yes or no? For the sake, I told you several times, when zeros are there, become a James Bond. When zeros are there in your problem, right? Become a James Bond, take a gun, shoot the zeros. It means that you have to minimize the problem. Ante tappa gun తీసుకొని కాలమని కాదు అక్కడ చెప్పేది, ఏదో poetic గా చెప్పా. జీరోలు ఎక్కువ ఉన్నాయనుకో, జీరోలు పెట్టుకుంటూ పోతే మనకి చివరికి ఇచ్చేది జీరోనే. అటువంటిప్పుడు వాడు ఇప్పుడు చెప్పు 70,000 into 240 అంటే ఇట్ విల్ టేక్స్ యూ ప్రాబ్లమ్. దట్స్ వై ప్రాబ్లమ్ ఆల్వేస్ యూ హ్యావ్ టు minimize. Last you write it, sir, for the sake of academic purpose or for the sake of calculation easy, I take value at lakhs or thousand. Hello, right? First margin you see 1000. Right, sales volume you see 0.72. బ్రేక్ లేకుండా మన కోసం బాలు సార్ చెప్తున్నాడు రా అని అసలు వచ్చి కాళ్ళకి దండం పెట్టాలి నువ్వు ఇప్పుడు. ఇప్పుడు చూడ ఓకే, సెల్ఫ్ బూస్టింగ్. ఓకే రైట్. సేల్స్ వాల్యూమ్ హౌ మచ్? 0.72. ఎస్ ఆర్ నో? 1.8, 2.60, 2.70, 2.70. You know, sir, what is the strategy I used? I should not take a variable cost ratio. Why? Time waste, right? Yes or no? Again, if I take selling price, time waste. Variable cost, time waste. What I done? From the sales, I deducted contribution. Luckily, I find it out. Variable cost, by deducting, I find the contribution. By taking that contribution, I multiplied with the sales volume. Immediately, by skipping 3 columns, I brought the contribution. Yes or no? So contribution, we got it. Total contribution, right? From the total contribution, we have to pay what? Fixed cost is given, right? After that, what happened? I paid. Here it is, ma. So fixed cost, I paid. Here it is. I paid of what is that? Fixed cost, right? Fixed cost I deducted. After deducting fixed cost, I got it. C minus D. PBDT, 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 PBDT. From that, I deducted depreciation. Depreciation here 1 plus only 1, right? Here only 1, right? Here also only 1, right? Here 1 plus 2. Enduku sir? Additional equipment you are purchasing means third year ending you are getting means 4th year, 5th year depreciation also comes, right ma? From that, if you get it from the PBDT, you got it. Less you deducted depreciation. Here you have to, before making a tax, you have to add one more column. For that purpose, brought forward loss. Set of loss should be done, you know. For the sake, first year it won't come. Why? Last year loss may is there, you know, that loss it may come for this year. So, but I added one column even though I know that the first year won't be there. What is that? Set of loss. In first year, what happened? 33 PBDT, 33.12. Less I deducted 43.75. I got the PBT loss of how much? Now, shall I take tax shield? Why, sir? Set off. That's why loss I could not cover. In such a case, PAT loss also remains same. Add back depreciation. No, there is a here one more point is here whatever the set of loss is done, that should be added back again. Hello? But first year you could not deduct it and there is no chance to add back. Sir, why you deducting? Why you are add backing, sir? Suppose second year also, if why you deduct, why you add back, sir? Because my dear, second year there is no loss actually. First year loss I am bringing officially, I am deducting it and I am reducing taxable income because my intention is to pay less tax. Once tax is paid, again what happened? I will add back. Okay, so that is the forward loss and I got the CFAT and present value factor. If at all any investment is there, I might have deducted that concern year. First year nothing. What about second year? Tell me. Second year I calculated. Here I got the PBDT. Hello? PBDT. I deducted how much? 10.63. Why? Last year loss. So last year loss I deducted. Then I will find it out. PBT and I paid a tax. Tax of how much I paid? 3.99. Then we got the PAT and add back depreciation. We got a 10.63. Balu sir, why you again your add back, sir? This add set of loss, sir? Because for this only tax savings only you deducted. Now you got the CFAT and you brought the present value. Third year you got the PBDT is 213.60. Less you deducted depreciation. You got the no need of what is it? Brought forward. Why, sir? No loss. Already loss which is there. What is it? You recovered. Then you find it out the CFAT. But you got the CFAT out of that 25 lakhs I deducted. Why? Because already he said that in third year you are going to get it. What is that? That 25 lakhs by using that third year cash inflow you are going to buy asset. That's why to bring into present value, even though I know that CFAT is 162.645, from that 25 lakhs I deducted and finally I find it out 137.645 and I brought the present. I brought the present is 98.003. What about the remaining year? That is third year fourth year, this balance would remain same. But here in this column, 4 and 5, I summed up what factors? Present value factors. Present value factor 4 and 5. Whereas what about this one? 1.363. 6 and 8, I summed up this value, I brought it. And finally, total PV of operating cash inflow, I got it. 533.945. Coming to terminal cash inflow, okay. Initial equipment is 0. Why? Because I purchased asset for 350. Every year asset depreciated by 43.75 into how many years? 8 years means 100% asset got what? Depreciation. Next one, gross sale proceeds and net sale proceeds of additional equipment. You sold additional equipment for 22.5. Actually you purchased asset for how much? 25 minus 4.5 into 5. It means that only left amount is 2.5. Recovery of working capital also is there, 40, and the terminal cash inflow would be 42.5. So by bringing with the support of present value factor 17.17, you got what is it? PV of terminal cash inflow. Now NPV. NPV formula, PV of operating cash inflow, PV of terminal cash inflow minus PV of cash outflow. How much you got it? 161.144. Since NPV is positive, amounted to 105.55 lakhs. So it is beneficial to accept the project. What about this point? Estimation of PV of cash outflow when company receives subsidy of how much? 50 lakhs. In such a case, cost of initial equipment how much? 350 lakhs. Add working capital is 40. You got the subsidy, right? It should be deducted 340 used to get it. Okay. So this is the way to consider, right? Whatever the point I analyzed here, I thought it, why can't I explain a problem where it covers everything, including all the methods. Got it? So how many methods total we discussed? Here it is. So NPV, profitability index, all the methods, right ma? Only capital budgeting plays very important role, dear students. Got it ma? Right. So with this we completed which one? 3 areas actually I completed so far. What are they? Introduction part I completed, time value of money, capital budgeting, and the next concept you take break, and next concept here you see we will take, what is it? This is the another book number 3, cost of capital. Cost of capital 19 pages. 19 pages I will solve, I will write here, and finally I will give this entire booklet to you. If you want to take time period, this is cost of capital. First of all, before understanding cost of capital, you should understand what is financing decision, what is cost of capital. Cost of capital. So cost of capital, this is investment decision finished, right? Well, so cost of capital. Here, what is a financing decision? When you want to understand cost of capital means you have to find it out financing decision. Financing decision means already first class itself I told you. Financial management is subject of decision making. How many decisions? Financing decision, investment decision, dividend decision. Cost of capital is linked with which decision? Financing decision. So financing decision means rising of required funds at a, rising of required funds at a least cost. So this is the one of the most important point. In order to raise the required funds, right, you should understand, number one, what are the sources in which you are going to raise, and what are the its cost. Hello. Finally, the company financing decision ultimate objective is to cost would be, what is it? Least. Hello. That is called weighted average cost should be very low. If the financial manager don't know the concept of cost of capital, he is a very worst man in the world. So every company has to raise the funds, and each fund has its own cost, but overall all cost should be very low. So this is financing decision. Financing decision means a company has to raise the required funds at a least cost. Cost means here cost of capital. So a financing decision of the company depends upon the financing decision. What is the cost of capital? Cost of capital is the minimum rate of return. It is the minimum rate of return that a company must earn to pay to fund providers. Who are the fund providers? Yeah, fund providers are there, The fund providers are, who are they? Equity. For equity shareholders, we have to pay cost of equity. Yes or no? For preference shareholders, we have to pay cost of preference. For debenture holders, we have to pay KD, right? So KD. Now what to do means systematically you have to sum it up all this one, right? Finally, whatever you will get it, what is called? KO. This is called cost of capital. This cost of capital also called hurdle rate. What is it? Hurdle rate. What rate? Hurdle rate or minimum rate of return. What is it? Minimum rate of return to pay to the fund providers. Cost of capital deals. Fund providers means, Balu sir, who are the fund providers? Fund providers means short-term fund providers or long-term fund providers? Only, this is also one of the important point is, the fund providers are, what are they? Long-term fund providers. Okay, ma? This is the point to be kept in mind. Coming to significance of cost of capital. Sir, why should I learn cost of capital? Sir, without learning cost of capital, can't I open an office or can't I earn money, sir? No, you cannot. You cannot. Why? Because if you learn the cost of capital, you can evaluate investment decision. What is that? Evaluate what decision? Investment decision you can take it. Why, sir? How do you say, sir? Arey bacha, IRR should be greater than, what is that? Cost of capital. Then only project should be accepted. This is a global slogan with respect to investment decision. Yes or no? When you don't have, what is that? Cost of capital, man, can you take investment decision? No. And at the same time, performance of the company also you can say. So a company A is cost of capital is 15%. Company B cost of capital is 5%. Now tell me, which company is the best? 15% or 5%? A company's cost of capital is 15%. It means that for 15 rupees payment for every 100 rupees, company rising. Another company, for 5 rupees cost of capital, they are raising funds. Now tell me, between these two companies, which company would be the best? B, yes or no? Because basing on cost of capital, you can make a comment that which company would be the best. Are you getting? So another one is risk. Now tell me, which company is a risky one? Risk of the company also can be say, in which company, what is it? COC is low, that would be the, what is it? Low risk company. Do you agree, ma? Performance of the company, risk of the company, yes, evaluation of investment decision, you can say. And another one is, you may say that is nothing but credit policy of the company. What is that? Credit policy. See, there are two types of credit policy. Liberal credit policy means one can give, what is it? More credit period. Another one is low credit period. See, if the company, understand, if the company which provides more credit period can make more sales, can make a more sales means can make a more profit leads to market leader. Do you agree? So this is the idea. Now A company is there, B company is there. Which company can provide liberal credit policy? Liberal means it can provide, what is that? More. Another one is a restrictive. Now tell me, which company can stand market leader? Market leader, that company must make earn more profit, sir. So more sales, sir. So more credit period, sir. So low cost, sir. Do you agree? The company which has the least cost, they can make more credit. More credit leads to more sales leads to more profit, right? If the company is a cost of capital is very, very high, in such a case, you cannot give what? More credit period, yes or no? In such a case, they cannot stand, what is that, as a market leader. So basing on cost of capital, you can comment a company, what is its credit policy? Should they go for liberal credit policy? Restrictive. Restrictive means you never become, what is it? Market leader. If it is a liberal, yes, it is a possible. Are you getting me? So this is the significance of cost of capital. Then what is the cost of debt? Cost of debt means here a company may raise long-term loans. Hello? Long-term loans from a banks or financial institution, or sometimes they may issue, what is that, bonds, sometimes they may issue, what is that, debentures. So all this comes under, what is that, debt. So whenever you raise a debt, you have to pay cost, the minimum rate you have to pay to whom? Fund providers. Particularly who are they? Shareholders. Cost of debt, man. Debenture holders. Yes, it is a cost to be paid to. Cost to be paid to whom? Paid to debt providers, or hello, or you can say loan providers. Loan providers. So here the cost is nothing but, in general, what is it? Interest. Yes or no? Interest you always consider 1 minus tax. The interest always projected in post tax. So here the long term debt, the cost of debt means, simply you can understand, it is the minimum rate of return that a company must earn to pay to whom? Debenture holders. Okay, that is called cost of debt. What are the, if you want to calculate cost of debt, you should understand futures of debenture. Futures of debenture means it has a what value? Face value. Hello, you have to pay coupon rate of interest. Yes ma, coupon rate of interest. And it may be issue made at IP, would be issue price, may be par, premium. Do you remember? And another one is, what is it? Discount. Hello, another one is redeemable value. Issue value, issue price would be par, discount, premium. Redeemable value may be par, premium, and another one is, what is it? Discount. Hello, there is a tax advantage also is there. What is that? Tax advantage. Are you getting? Tax advantage how, sir? How much interest you will pay from that interest to the extent of tax rate, company gets what? Tax advantage. If you are paying interest, that interest you will show on profit and loss account. With effect, your taxable income, what happen? Decreases. Okay. Another important point they asked, based on redemption, what is the cost of debentures? Cost of irredeemable debt, right ma? Here, cost of which one? Cost of irredeemable debenture. What is the point here? Based on redemption. Debentures being classified into two types, right? Redeemable, irredeemable. Based on redemption, repayment of principal and maturity, how we classified? So there are two types of debenture. First one is, what is it? Irredeemable. Irredeemable means what? Principal amount. Principal amount, what is it? Never be repaid. Never be paid. Okay. What we can pay? We will pay only interest to be paid. Interest paid. So that is, what is that? Irredeemable debenture. If you understand, expect it is a perpetual bond. Okay, in that company never pay, what is that? Principal amount. It will pay only interest. In such a situation, what is the cost of debt? Cost of debt equal to interest into 1 minus tax divided by net proceeds or market price into 100. Hello. So this is the point you can understand. How do you calculate net proceeds? Net proceeds equal to face value minus, what is it? Discount, or plus premium minus what cost? Flotation cost. So these are the concept to be, right? Tell me, what is irredeemable debenture? Irredeemable means principal never be paid. Only what paid? Interest paid. What is the formula? Interest into 1 minus tax, net proceeds or market price. Net proceeds you are going to use for, what is that? Newly issued debenture. So market price indicates, what is it? Existing companies, right? Existing. So this is the point to irredeemable. Coming to, in that problem we have, what is that? Cost of redeemable. Redeemable, you have two things. What are they? Lump sum. Another one you have, what is that? Installment, right? So installment basis you can say. Here cost of based on redemption. Here this is the point is given. How will you calculate cost of redeemable debenture? Redeemable debenture, you can use the two types of methods. What are they? Shortcut method. You see, based on redemption, repayment of principal, how can we classify debt? See, on the basis of debt which is redeemable, it can be redeemed in two ways, right? One is, what is it? Lump sum. Hello ma? Lump sum you can make it. Another one is installment. So in lump sum amount, what happened? Installment and lump sum. This is nothing but repayment. Here approximate method they are given, right? Approximate method also called, what is that? Shortcut method. What method? Shortcut method. When this approximate method, shortcut method is used, two conditions. Conditions, you have to consider two conditions. Number one, lump sum redemption. What is that? Lump sum. Redemption should be lump sum at the end. At the end. Because it is, what is it? Redeemable. Redeemable means how you are going to redeem. Lump sum at the end you have to pay. And another one is coupon rate remain. Coupon rate remains same. Hello? Remains same. In such a case, you can use what method? Shortcut method. So shortcut method formula would be like this. Cost of debt equal to interest into 1 minus tax plus redeemable value minus net proceeds divided by n number of years old divided by RV plus NP divided by 2 into 100. Are you getting ma? This is the method to be used. What is another name of approximate method? Shortcut method. What are the conditions to be followed? Lump sum at the end, redemption should be done. Coupon rate remain same during the redeemable period. RP period, it would be remain same. And at the end, they have to pay. This is called shortcut method calculation. Coming to here, how will you calculate cost of debt? Present value method. This is what method? Approximate method. Okay, right. Even if you don't write, I'm saving all these things. I will give you this PDF. Okay, are you getting? Just you pay attention for this. Approximate method, present value method. Present value method also called YTM method. What is that? Yield to maturity method. What is that? Yield to maturity method. Another one is, what is that? IRR method. Okay, this method, when you can use it, point number one, this method would be used only when coupon rate gets changes. What is it? Coupon rate of interest changes. Rate of interest, what happened? Changes. Okay, another one is payment should be made on what basis? Installment payment. If the two things will happen, right, then you can use this present value method. Present value method, you have to go for, what is that? IRR, right? IRR you have to calculate from 2 points of view. What is that? Investor's point of view. Investor's point. Another one is whose point? Company point. So company point also you can calculate. But the thing is, if no flotation cost is there, then automatically you can calculate whose point of view? Investor's point of view would be the better technique, right? When flotation cost is there, in such a case you have to go with company point of view. These are the one more important point to be considered to use present value method, YTM method or IRR method. Okay ma? Now tell me, when should you use present value method? Coupon rate or interest, coupon rate of interest changes and installment payment. IRR to be done from whose point of view? Investor's point of view, company point of view. No flotation cost, better to calculate from whose point of view? Investor, right? And what about the, explain how we calculate convertible debentures. Convertible debentures, two condition. It is nothing but, first one is, it is a redeemable. Redeemable, yes or no? Redeemable debenture. This is basically redeemable debenture. But here what happened? Redeemable value equal to convertible value. Convertible value of debt into what is that? Equity. Hello? Sometimes company, what they do is, redeemable value is nothing but convertible value of debt into equity. It means that here redeemable value of one debenture, you have to find it out like this. One debenture equal to number of equity shares. What is that? Number of equity shares. In this debenture, what happens? Company will convert, what is that? Debt into equity. Instead of providing redeemable value, they will declare, what is that? Equity shares. So here redeemable value of one debenture equal to number of equity shares, okay, into equal one equity share price, okay, share price into 1 plus rate all divided by n. Hello, you try to understand what is the logic of behind this one. One debenture value you need it. Hello, if a company gives for one debenture 5 equity share means one debenture equal to how many shares? 5 equity shares you have to take. Today share price is how much? Let us take 20 rupees. Hello, 20 rupees. Will you multiply 20? No, you are going to get this redeemable value at the end of 10th year or 15th year. In such a case, what happened? 5 shares, 5 equity shares into today what is the share price? Let us take 20 rupees. This share price may increase, right? In such a case, what happened? You have to consider 1 plus at what rate the share price is increasing. You have to consider that rate through which it is increasing over the period of how many years? Let us take 5 years or 10 years. So 10 years this share price increases at the given rate. 20 rupees share price would be how much? One share would be this much, means the 5 shares is how much, you have to find it out. This is examination point of view, very, very important. Tell me, one debenture equal to? One debenture equal to, you have to ask number of equity shares and number of equity share price now. When? At the end of. In such a case, what you have to do is number of equity shares into 1 equity shares into 1 plus R, that is nothing but the growth rate in over the period of what is that? N number of years. Got it, ma? This is the convertible debenture. Is it redeemable? Irredeemable? Sir, why can't it is irredeemable? Redeemable value is there, means redeemable to be done, right, ma? Yeah, this is the redeemable debenture. Thereafter, cost of preference. Cost of preference. What is the cost of preference? When company raises capital, right? When company raises capital, tell me, raises capital by issuing debt, we have to calculate KP. Yes or no? Yes, sir. When company raises capital by issuing what? Preference shares. Hello? Preference shares. Then we have to calculate cost of preference. So cost of preference equal to what is the formula? Preference dividend divided by net proceeds or market price. Is there any tax advantage on this? Tax benefit? No tax benefit. Why? No tax benefit. Chappane? No tax benefit. Why? Because preference dividend paid. What is it? Preference dividend paid after tax. Very good. After tax. That would be no possible. Sometimes what happen? If at all company takes a burden of dividend distribution tax, I will also pay dividend distribution tax, means then it would be burden 1 plus dividend distribution tax to be paid. But this is the point with respect to cost of preference. Mention categories into preference shares capital being classified into. How many types preference shares? 2 types. What are they? Irredeemable preference shares. Another one is, what is it? Redeemable preference shares. Redeemable preference shares. Then explain the term irredeemable preference shares. What do you mean by irredeemable preference shares? Principal amount never be, what is that? Repaid. Principal never be repaid. Hello? Principal never be repaid. Paid only what? Interest. Preference dividend, right? In such a case, can you tell me the formula mathematically? Preference dividend, cost of preference equal to preference dividend divided by net proceeds or market price. And redeemable preference shares, express cost mathematically. Redeemable preference shares means you have 2 things, right? What are they? Redeemable preference shares. Redeemable, same, you have 2 things, right? One is, what is that? Redemption done at lump sum. Hello? Lump sum means, in such a case, preference dividend formula. Preference dividend, cost of preference equal to, we can use lump sum means what technique we can use? Tell me. Shortcut method you can use, Hello? Shortcut method, when redemption is done at lump sum, coupon rate remain constant. We can use what method? Shortcut method. Shortcut method formula would be cost of preference equal to preference dividend into 1 plus, not 1 plus tax, right? Here, preference dividend, no tax advantage, Preference dividend plus
redeemable value minus net proceeds all divided by n number of years RV plus NP divided by 2. Whereas redeemable means, sir, tell me. Redeemable means you have to understand redeemable, you have to go with what is that? No, this is a redeemable only. It's a lump sum. Here we have to, what we have to write? Installment we have to write, right? Installment. Installment can be done into, from whose point of view? Investor's point of view. Investor's point of view. Whereas whose point of view? Company's point of view. Company's point of view. Now, at whose situation we have to take? When there is no, what is that? No flotation cost. Whose point of view to be taken into consideration? Investors, right, ma? This is with respect to, what is that? Cost of preference. Coming to how will you describe cost of equity share capital with respect to company? Now tell me, when company need again capital, company issues, what is it? Equity. Hello? Equity shares. Then company has to pay cost, right? So cost of company need a capital, company issues equity. This is for new company. Hello? Sometimes retained earnings also. Whose profit? Equity shareholders profit. If it is an existing company, right? For equity retained earnings, company has to pay cost, right? They have to pay cost. That is called, what is that? Cost of equity. So cost of equity means it is the minimum rate of return that a company must earn to pay to whom? For fund providers. For issuing equity, you raised funds, right? For that purpose, you have to pay cost. And at the same time, for example, if your existing company is there, existing company profit you retain, for that also you have to pay what? Cost. So that is also comes under this category. Cost of equity. It is the minimum rate to be paid to whom? Fund provider, particularly who? Equity shareholder. And mention different methods of cost of equity. Do you have idea about cost of equity estimation? So cost of equity methods, you have, there are different types of methods. One is, what is it? Dividend price approach, and earning price, EPS, earning price approach, earning price approach. Another one is constant growth in dividend approach. Constant growth in dividend approach. And another one is constant growth. Thereafter, realized yield approach. Realized yield approach. Another one is, what is it? CAPM approach. What ma? So these are the methods we calculated cost of equity. There are different types of methods we have. What is that? Here you see. Growth in dividend given, but this method would be the best. What is that? Realized yield dividend price approach. Yes or no? Dividend based, no growth in based. This is also called zero growth. But here, this is called dividend price. You can say no growth. What is that? No growth. Tell me how many? Tell me what are the dividend price approach 1, earning price approach 2, constant growth in 3, realized yield approach 4, CAPM approach is 5. Okay. Another one is explain dividend price approach. In this model, dividend price approach is, what is that? Company pays, what is it? Dividend. Hello? This model also called no growth in dividend model. What is that? No growth in dividend model. So in this model, what the company follows is EPS would be declared as, what is that? Dividend. Hello? Whatever the company declares a EPS, that company gives, what is it? Dividend. It means that 100% dividend payout ratio company follows. When company follows 100% dividend payout ratio means what is the logic? Understand? Whatever the EPS company makes, it gives to whom? Equity shareholders. Assumption is company consistently earns income. Hello? Company earns consistently income. In such a case, EPS equal to dividend. Why? Because 100% DPR. DPR means dividend payout ratio. Can I say 0%? retaining ratio. When company follows 0% retaining ratio, this model is called explained dividend price approach. In this model, cost of equity equal to equity dividend means DPS 1 divided by net proceeds or market price. Okay. So far 16 questions I covered. Okay. Including, not randomly I'm taking. I thought it that what question I should ask the student by explaining this point, because your time is very, very less. In that situation, randomly I don't want to explain it. That's why I put it everything on paper and I identified 16 questions. Explain. So far, if you are clear with respect to this, you can understand 16 questions. And coming to 17th one, and explain the dividend price approach with constant dividend and the dividend price with growth constant. This model also called Gordon's model. What is that? Gordon's model. So Gordon's model, in this model, growth is there. Growth is there means, according to this model, KE equal to DPS1 divided by net proceeds or market price plus what is that? G, growth rate. So since it growth rate it follows means EPS of the company would be classified into two types. One is they will pay dividend payout ratio at, let us take 60%. It means that what? From the EPS they paid 60% dividend. What about the remaining? So retaining ratio. So this retaining ratio, what they do? Again they will, what is that? Invest. So when they will invest means at that investment they will generate a rate, right? So what is the point is this investment rate and retaining ratio will gives you, what is that? What is that? Growth rate. Hello? So growth rate equal to, tell me, how the company able to generate growth rate? Retaining profit, they will make what? Here they will make retaining profit, and this retaining amount they will make invest outside, they will generate this rate. This retaining ratio into rate of return on reinvestment generates what is that? Growth rate. It means that company never follows 100% dividend payout ratio. In this model, equity shareholders expects not only cash dividend but also market price appreciation. Are you getting? So this is the constant. Why the constant model used, sir? The reason is that what happened? Constant word they are using means dividend to payout ratio is, what is it? Constant. When dividend to payout ratio constant means retaining ratio also constant. When retaining ratio, dividend payout ratio both are constant, and reinvestment rate also, what is that? Constant. Hello? When reinvestment rate remain constant, dividend to payout ratio constant means automatically growth rate also will become, what is that? Constant. Got it, ma? Right. Coming to growth rate. How many ways are growth rate to be explained? In your material, there are three problems are there. First one, G equal to, you can calculate a retaining ratio into rate of return on investment. Return on investment. So this is the one point. Another one is growth rate equal to, you can calculate DPS 1 minus DPS 0 into DPS 0 into 100. Latest minus late divided by late. Growth rate. When subsequent 2 years data is given, what is that? Subsequent 2 years data is given. For example, you have given DPS 1, DPS 0 is given. Means 2 years data is given. In such a case, growth rate would be calculated like this. DPS 1 minus DPS 0 divided by DPS 0. Okay. Whereas more time period is given. In such a case, you can consider growth rate would be with the support of present value factor. For example, here it is a present value. Here it is a future value dividend. Over the period of 10 years means either you can calculate future value, some rate to be added to it, right? Some rate to be added to present value to find what value? Future value. At the same time, if you deduct this rate from this, you will find what value? Present value. Either future value factor or present value factor, you can find it out. For this future value factor, R percentage n number of is equal to future value divided by present value with a time value money element. It means that future value divided by present value. By estimating this value, by tracing, you can find what is that growth rate. This is another point, but this would be used only when more number of years. Here it is a present value given, here it is a future value. More than 10 years means by taking present value, future value, number of years with support of future value factor or present value factor, you can find what growth. These are the three ways. Number one, first version is what? First version is retaining ratio into rate of return on reinvestment. Second version equal to DPS 1 minus DPS 0 divided by DPS 0. Whereas third one, either future value factor or present value factor you can identify. Here this technique should be used only when how many years? Subsequent 2 years. But this technique should be used more than 2 years. Okay. This is the way. Then explain earning price approach. Earning price approach. According to this approach, company whatever the EPS it earns, either it gives dividend, not to gives dividend. Okay, gives dividend, not to give dividends. What it says, I made a EPS of 100 rupees. Hello, let us take EPS company made 100 rupees. Out of this 100, 50% company declared dividend payout ratio. So remaining 50 is what is it? Retaining ratio. Now tell me, if company retains 50%, is it money belongs to company or equity shareholders? Equity shareholders. In such a case, cost means why you are taking a dividend. You take what is that? EPS. If I give dividend, that money is you. If I don't give dividend, money is mine. Money is mine. It's not, if I give dividend, if you not give dividend, if I make income to you means either if I give, not to give, that income belongs to whom? You only. So first dividend model, what it takes, how much the dividend company made, they will take that concept. But in EPS model, what the opinion is, whatever the EPS I made, whether I give or not to give, okay, that belongs to cost you only. So in explain earning price approach, company never takes how much paid, how much dividend paid. Company considers KE equal to what they will take, EPS, net proceeds or market price. Sir, what is the difference between dividend model and EPS model, sir? Under the dividend model, company makes, let us take 100 rupees. 100 rupees is EPS. Company gives 100 rupees as a dividend. But the company there, their intention is cost is nothing but paid a dividend. But in this model, company either retained or paid, that is not the matter. Because I made for you, right? So EPS I made 100 rupees. If I pay, not to pay also, this 100 is to you only, right? That is the reason they will take KE equal to EPS or net proceeds. Once again, అర్థమైందా? డివిడెండ్ మోడల్కి దీనికి తేడా ఏంటి? అక్కడ వాడు ఎర్న్ చేసిన మొత్తాన్ని డివిడెండ్ ఇస్తాడు, కానీ ఈపీఎస్ని పారామీటర్ తీసుకోడు. దేన్ని తీసుకుంటాడు? డివిడెండ్ తీసుకుంటాడు. ఈ మోడల్లో ఈపీఎస్ తీసుకుంటాడు. నేను డివిడెండ్ ఎంత పే చేస్తాను, నీకు ఎందుకు పే అంటాడు వాడు. నేను నీకోసం ఎర్న్ చేశాను కదా, నీకు ఇంత పే చేస్తున్నాను, అప్పుడు పే చేయిందంటే నా అమౌంట్ కాదు కదా, నీదే కదా. దట్ ఈస్ ద రీజన్ యూ కెన్ టేక్ ఈపీఎస్. ఓకే, కేఈ అండర్ డివిడెండ్ మోడల్, వాట్ ఇస్ ద ఫార్ములా? Dividend divided by net proceeds or market price. EPS model, constant growth rate model, constant growth rate model. DPS అరే కాన్స్టెంట్ గ్రోత్ రేట్ మోడల్లో ఇప్పుడే కదమ్మా వచ్చాం. కాన్స్టెంట్ గ్రోత్ రేట్ మోడల్, వాట్ ఇస్ ద ఫార్ములా? DPS 1 divided by KE minus constant growth rate में किधर गए रहे तो here DPS 1 divided by net proceeds or market price plus growth rate. Okay, next one, what is that? Realized yield approach. Realized yield approach is nothing but here KE of the company always takes, what is it? Investors IRR. Hello, and it means that KE equal to return earned by who? Investor. Here that return is nothing but what is it? IRR. But the condition applies, this technique should not include, there should not know what class? Flotation cost. Because if the flotation cost exists in such a case, so this technique is Outflow of investor is nothing but inflow to the company. Hello. Inflow of the company is nothing but outflow of the company. This inflow outflow could matches only when there is no flotation cost. This is the what method ma? Realized yield approach. Thereafter we have a CAPM approach. CAPM approach identifies that what is the basic logic for this one is KE of the company. KE of the company depends upon what is it? Risk associated with the company. Risk associated with the company. So here equity shareholders gets two benefits. What are they? KE should be given 2. 1 plus 2. What are the one? Risk-free rate. What is that? Risk-free rate he has to get plus risk premium he has to get. What is that? Risk premium. Every company has a 2 types of risk. Diversifiable risk. Another one is non-diversifiable risk. Non-diversifiable risk also called beta. Basing on the beta, KE to be depend upon. In such a case, KE equal to risk-free rate means RF. Diversifiable risk, non-diversifiable risk means beta into RM minus RF. This is the another method to compute cost of equity. Then what about the cost of retained earnings? Cost of retained earnings happens E plus E rule. What is that? E plus E. E. Can you say E? E indicates existing company. Second one is earning companies. Hello? Retained earnings happens only when company makes what? Better. Retained earnings new company existing? Existing. And they should make what is that? Great earnings. Hello? What Maji? When company retaining means the company has to make wonderful earnings, right? If two things happens, cost of retained earnings happens. Cost of retained earnings what? Whenever company retains funds belongs to whom? Equity shareholders, instead of distributing this cost to them, right? If company retains that funds, then it has to pay cost. Hello? Such a cost is called what is it? Cost of retained earnings. Cost of retained earnings. Cost of retained earnings can be calculated in 2 ways. See, KR can be estimated in 2 ways. One is, you try to understand, I told you AC rule. What is that? AC rule. AC rule means not a AC rule. First one is analyze. Analyze is the first technique you should follow. Analyze means, since retained earnings are funds belongs to whom? Equity, analyze it, right? Retained earnings are funds belongs to whom? Equity shareholders. In such a case, KE equal to KR. Or KR equal to, you can use the word like this. You want to calculate KR, right? What you do is KR equal to KE, because retained earnings are funds belongs to whom? Equity shareholders. Retained earnings funds belongs to whom? Equity. Hello? Retained earnings funds belongs to equity. In such a case, KR equal to KE, but condition applies, no flotation cost. Okay? There should not, what is it? Flotation cost. Why? Because when company issues, what is it? Equity, in such a case, company incurs what cost? Flotation cost. But when you are considering KE as a KR means that company should not consist of what? Flotation cost. Are you getting? So which KR would be, sir, if the flotation cost is there, sir, in such a case, what to do, sir? You do one thing, you calculate what? KE by ignoring flotation cost. By ignoring flotation cost, you calculate KE, that KE would be KR. This is the one point. Another point is, you have to identify, you have to, A means analyze. Another one is, C means you have to calculate. Hello? In this calculation, what you have to do means, sometimes investor may give his expected rate. In such a case, KR equal to investor expected rate of return into 1 minus brokerage. Hello? Brokerage into 1 minus tax. What tax is? Personal tax. Suppose by investor, he may say that if I invest these funds outside, right, I may get, what is it? I may get this much of benefit, you may say. If you see, if company retains funds of whom? equity shareholders. Some equity shareholders expects that, sir, why you are holding my money, sir? Give it my money back. Why? Because if I invest these funds outside, I might have got some benefit, right? In such a case, being a CMA specialist, what you have to do is you have to analyze, okay, how much you are expecting? 20% you are expecting. But sir, for the sake of investment, you may lose 20%, at least 10%, 10% means 1 minus 0.10 you deduct. You may get it only 90%. From that, if the company makes, what is it? Personal tax. What is it? Personal tax means you have to pay 1 minus personal tax may be 50%. In such a case, calculate 20 into 90% into 50%. 20 into 90% into 50%. 9. Tell me what is the 9%? What is the investor 20%? Actually, investor demands in front of you that I supposed to generate. I can make how much? 20%. He may expect a cost of how much? 20%. But he may expect a 20%. Being a specialist of financial management, by considering his brokerage, by considering his personal tax, how much net cost, net earnings he is supposed to make. How much he can make? 9%. Then you may comfortably say that, sir, even though you are thinking that you are supposed to make 20%, sir, but actually it's not, sir. You are not going to earn how much? 20%. You are going to make just how much? 9%. Then client will surprisingly surprised. He may ask you, how? Because, sir, tax brokerage is going, sir. Because, sir, personal tax is going, sir. You are going Vijayawada, sir, expecting 20, sir. But actually, after earning that money, when you come to Bradipet, sir, you will have how much? 9%, sir. That 9% I will pay you, sir. No problem. So this is the way to calculate cost of retained earning. What is the AC rule? Analyze. No need to calculate. Analyze it. Just why, sir? Because why you are spending, man? You learned cost of equity, right? Any of the method KE calculate, that KE would be KR. How, sir? Because retained earnings or funds belongs to whom? Equity shareholders. But keep it in mind that KE should not include what? Flotation cost. Why, sir? Because, sir, for rising equity, there should not be flotation cost. Second method, calculate. Got it, ma? Once after calculation of all these things, you will find it out. What method? What? Weighted average cost of capital. What is the weighted average cost of capital? Briefly explain steps to used weighted average cost. Weighted average cost of capital is aggregate of, it is a systematic summation of, you can write, it is the, it is the weighted average cost of capital is, it is the systematic summation of various specific cost. Okay. So step 1, for that purpose, what you have to calculate? Specific cost you have to estimate. Hello? Specific cost. What are the specific costs? KE, KP, KD, KR, yes or no? All these things you have to calculate. Step 2, what to do? You have to calculate weighted average cost of capital. These are the first step, estimate specific cost. And specific cost, how do you calculate? Means you have two methods, either product method or proportionate method. How do you calculate the weighted average cost of capital? Means first one is itna ko itna, utna ko kitna. Do you remember the day? Itna ko itna, utna ko kitna. For example, you raised for equity. Hello? What is the cost to be paid? Take this amount. Hello? You raised for preference. What is the cost to be paid? You consider that amount. And at the same time, tu jawab bhai. Okay, equity into cost, take the amount. Preference into cost, take the amount. Now tell me, debt into cost, specific cost, right? Take the amount. Now total cost to be paid for total amount. Are you getting? Now weighted average cost of capital equal to? This is cost divided by total amount to be paid into 100. This is called, what is that? Weighted average cost of capital. This is in our given in our material in exclusive way. This is the point to be considered. Weighted average cost of capital. Here by multiplying, what is that? Are you getting? Equity and specific cost percentage. Okay, thereafter another method you can use it. This is the first method. What is the first method, ma? Weighted average cost. You have to take, what is it? Equity and multiply with the cost. Cost means what cost it is? Specific cost, you know? Specific cost. Specific cost multiply, calculate this amount and total amount you submit. Otherwise, second alternative I told you, weighted average cost of capital equal to KE into equity share capital divided by total capital employed plus KD into debt capital divided by total capital employed plus KR into retained earnings or KP into preference share capital divided by total capital employed. By using this method also, you can calculate, what is that? Weighted average cost of capital. Are you getting? These are the point to be estimated while analyzing cost of capital. What is that? This multiplying this technique is called what method? Product method. What is that? Product method. This one is, what is that? Proportionate method. Proportionate method. Between these two method, any of the method you can use and calculate it. And coming to weighted average cost of capital, book value, market value. So book value is nothing but, what is the book value? Number of securities into issue price. Number of security into issue price. What about the market value? Number of securities into what price? Market price. So in book value, security will remain constant. You check it in this point. One thing is confirmed. What is that? Security will remain same. This is the issue price. This is market price. Market price where it is available, stock market. But which would be the correct present? This would be, method is wonderful. Which one? Correct and at the same time present condition, which would be reflected? Weighted average cost of capital, market price. For example, MRF share price was issued, right ma? MRF share price was issued. Its share price once it is a 10 rupees. Now today its market price is, how much market price is? 87,000 something. Means you try to understand, if you want to calculate weighted average cost, will you take book issue price or market price? Market price. So market price exactly correct position it will speaks, as well as what is it? Present condition it reflects. Always you have to take weighted average cost of capital basing on what value? Market value. And thereafter briefly explain marginal cost of capital. What is it? Marginal. What the word I gave it? Marginal means what? Additional. The word marginal represents, what is that? Additional. Whereas marginal cost of capital means it is the additional cost of capital. Additional cost of capital estimated when company wants to rise. Company wants to rise what funds? Additional funds. Keep it in mind. Additional funds, if you want to rise it, then cost to be estimated is called what cost? Additional cost. When there is no need, additional funds should be raised, no need of this. Generally, sir, why the corporate company additionally rise, sir? E plus D plus X. This E indicates expansion. Hello? D indicates diversification. M represent modernization. Hello? Sometimes company may go for what? Already establishment done it. Thereafter company may go for what? Expansion, diversification, modernization. Purpose what happen? Again they will rise additional. Hello? To within a coming exam, they will give you a booklet to you. Hello? That is the weighted average cost of capital. After completion of this, if you ask, addition. Yes or no? Addition is nothing but additional. Hello? When you calculate additional, when you take what? Additional. Simple logic. This is the example. కానీ పర్వాలేదు, కొన్ని సందర్భాల్లో బ్రెయిన్కి కొంత ట్రైన్ చేయాలంటే అలా కన్సిడర్ చేయాలి. ఎందుకు అంటే ఇప్పుడు నువ్వు ఎక్స్పాండ్ చేయబట్టే కదా. ఆల్రెడీ బుక్లెట్ ఇచ్చారంటే ఏమని అర్థం, దాంతో సరిపోతురా అబ్బాయి అని. కానీ మీరేం చేస్తున్నారు, ఇంకా ఎక్స్పాండ్ చేస్తున్నారు, లేదు బ్యూటిఫుల్గా డైవర్సిఫై చేస్తున్నారు, ఇంకా మోడర్నైజ్ చేస్తున్నారు క్వశ్చన్ పేపర్ని. అది అర్థం చేసుకో. దెన్ ఇట్ వుడ్ బి కాల్డ్ వాట్ ఇస్ దట్, మార్జినల్ కాస్ట్ ఆఫ్ క్యాపిటల్, రైట్? దీస్ ఆర్ ద కాన్సెప్ట్ మాజీ. నౌ టెల్ మీ వాట్ ఆర్ ద కాస్ట్ we established, identified. One is first debenture, right? Debenture irredeemable, redeemable? Redeemable, irredeemable. Irredeemable formula, interest into 1 minus tax divided by net proceeds into market, yes or no, market price. Irredeemable. Thereafter redeemable. Redeemable shortcut to IRR. I will tell you one rule. 1 to AB, B1, A1, B1. 1 to irredeemable, redeemable. 1 to AB, redemption, lump sum, installment. B1, B2, investor point of view, company point of view. Now tell me 1 to AB, A1, B1. What is the 1? 1 irredeemable, 2 redeemable, AB lump sum installment, A1, B1. Preference 1 to AB, A1, B1. Preference irredeemable, redeemable, AB redemption and lump sum installment, A1, B1. Company point of view, investor point of view. Equity 1, 2, 3, 4, 5. అలా చూడొద్దు. EPS model, dividend model. Dividend model means first EPS model, no growth in dividend model, constant growth in dividend model, realized yield approach. Another one is CMA approach. Now tell me 1 to 1, no, I'm talking about a cost of debt. 1 to AB, B1, A1, B1. What about equity? 1, 2, 3, 4, 5. ప్రిఫరెన్స్ చెప్పండి, మీ దగ్గర ఉన్న షార్ట్ కట్ ఏంటి? ఈరోజు క్లాస్కి వచ్చావు, బయటికి వెళ్ళి రేపు క్లాస్కి రానోడితో చెప్పు. కాస్ట్ ఆఫ్ ప్రిఫరెన్స్ తెలియదరా? 1 to AB, A1, B1 అయిపోయింది అంతే. ఏసీ రూల్ తెలీదా? తెలీదు ఏసీ రూల్. దేనికి ఏసీ రూల్ చెప్పాను? అది అరే నీకు ఏసీ గురించే తెలుసు. ఈరోజు క్లాస్ అడగడం వల్ల నాకు ఏసీతో పాటు ఏసీ రూల్ కూడా, అనలైజ్ 1, క్యాల్కులేట్ 1. అనలైజ్ ఏం చేయాలి సార్? సిన్స్ రిటైన్డ్ ఎర్నింగ్స్ ఆర్ ఫండ్స్ బిలాంగ్స్ టు హూమ్? Equity shareholders. If there is no flotation cost, KR equal to KE. Matter is finished. Flotation cost unte, then you have to calculate KE. That KE would be considered, right? KE. What about cost of equity? How many methods? 5. హస్తం. అవునా? రాహుల్ గాంధీని గుర్తుపెట్టుకోండి అంతే. ఏమొస్తాయి ఇందులో? ఈపీఎస్, నో గ్రోత్, కాన్స్టెంట్ గ్రోత్, రియలైజ్డ్ yield, CAPM approach, right? Marginal cost of capital means additional. Got the point, ma? These are the topics I identified. Thereafter, you have to concentrate some point. Flotation cost. What is the flotation cost? Issuing cost. What is it? Issuing cost. Sometimes the company spends some amount additionally to estimate that. That is called, what is that? Additional cost. How do you estimate net proceeds? I give the formula. Net proceeds equal to face value minus discount or premium minus flotation cost. What is the fair value of bond? ఫెయిర్ వాల్యూ ఆఫ్ బాండ్ అంటే ఇట్ ఈస్ ద ప్రెజెంట్ వాల్యూ ఆఫ్ ఫ్యూచర్ బెనిఫిట్స్. హలో, ఒక బాండ్ యొక్క ఫెయిర్ వాల్యూ ఎంత అంటే ఫెయిర్ వాల్యూ ఆఫ్ బాండ్ ఆల్సో కాల్డ్ మార్కెట్ వాల్యూ ఆఫ్ బాండ్. ఇఫ్ ఎన్ ఇన్వెస్టర్, ఇఫ్ సపోజ్ ఈ బై ద డిబెంచర్ ఆర్ బాండ్, వాట్ ఎవర్ ద బెనిఫిట్స్ ఈస్ గోయింగ్ టు గెట్ ఇట్ ఇన్ ఫ్యూచర్, ఇట్స్ టోటల్ బెనిఫిట్ వాట్ యూ గోయింగ్ టు రియలైజ్ ఇన్ ఫ్యూచర్, ఇట్స్ ప్రెజెంట్ వర్త్ యాజ్ ఆన్ టుడే ఈస్ కాల్డ్ వాట్? ఫెయిర్ వాల్యూ ఆఫ్ బాండ్. ఆర్ గెటింగ్ right? Amortization of bond ante enti? When you are going to buy a bond, how they are going to give money to you is called, what is that? Amortization. వాళ్ళు ఇస్తేనే కదా నువ్వు ప్రజెంట్లో తీసుకొస్తావు. ఫెయిర్ వాల్యూ అనేది ఎవరి పాయింట్ ఆఫ్ వ్యూలో జరుగుద్ది? కంపెనీ పాయింట్ ఆఫ్ వ్యూలో జరుగుద్ది. హలో, అమోర్టైజేషన్ అనేది ఎవరి పాయింట్ ఆఫ్ వ్యూ జరుగుద్ది? ఇన్వెస్టర్. నేను ఇలా ఇస్తున్నాను, నువ్వు ఇస్తే నాకు ఇంత వస్తుంది. ఎంత వస్తుంది అనేది ఫెయిర్ మార్కెట్ వాల్యూ ఆఫ్ బాండ్. ఫెయిర్ మార్కెట్ వాల్యూ ఆఫ్ బాండ్ ఈస్ డిపెండ్స్ అపాన్ అమోర్టైజేషన్. అమోర్టైజేషన్ అంటే ఏంటి? మనీ ఐ టుక్ ఇట్, ఐఎమ్ గోయింగ్ టు గివ్ బ్యాక్ టు యూ. హలో, ఫర్ ఎగ్జాంపుల్ ఒక 1000 రూపీస్ బాండ్ అనుకోండి. హౌ ద కంపెనీ ఈస్ గోయింగ్ టు అమోర్టైజ్ ఈస్ డిపెండ్స్ అపాన్ వాల్యుయేషన్. హలో, నువ్వు ఇంత ఇస్తావు, దాని మొత్తాన్ని నేను ఏం చేస్తాను, ఐ విల్ బ్రింగ్ ఇన్ టు present. That is called amortization bond. You can take this one. I think amortization concept is not in CMA, but take an additional point, right ma? These are the problems, and we can discuss a problem with respect to this weighted average cost of capital. Here there is a small problem left. This is the marginal cost. This problem is very important. You see, equity share capital of PK Limited is the share capital of how much it is, total capital 200 lakhs, 11.5% preference shares 60, debenture is 100 lakhs, total equity share capital how much ma? Total capital is 360 lakhs. They are raised. This point I am covering both weighted average cost as well as marginal cost. Now tell me, company is raising funds from A, equity, preference and debenture. Total capital raised how much? 360. Equity share of the company sold is how much? 200. It is expected that company will pay next year dividend of how much? 10 per equity share. Forever. Assume how much it is? 35% tax rate. Now tell me, you have to calculate what are they? What are the costs you have to calculate? KE you have to calculate. KP you have to calculate. KD you have to calculate. Okay. Now the growth rate is 5%. Compute weighted average cost of capital of the company basing on existing structure. And again they are going to new means additional. Additionally they are rising, because of rising additional 50 lakhs debt by issuing how much? 12% debenture. This would result in increasing expected equity dividend is 12.5 and leave the growth rate is unchanged, but the price of equity share will fall to 160. You try to understand, when company raises additional debt, automatically risk element of equity shareholders what happen? Increases. When risk element of equity shareholders increases, there might be change in dividend. May they expect more, growth rate also they will expect more, and market price may decrease because they never pay more amount to the concerned share. These are the point to be kept in mind when company raises additional funds by issuing of what? Debt. Now we have to calculate KE, KP, KD, right? In this problem you tell me market price is how much? Market price, how much ra? Market price is 200. Growth rate is 5% is there. Growth rate is given means which model it will be? Constant growth rate model, right? Constant growth rate model formula? DPS1. DPS1 is given, right? DPS1 is how much? 10 divided by market price 200 plus growth rate 5. How much the KE ma? You see, here this is the cost of equity. Market price kitna re? 200. Growth rate is 5. DPS1 is 10. So cost of equity formula, DPS1 divided by market price plus growth rate. How much? 10%. Cost of preference. Cost of preference, is there any information? Actually cost of preference we discussed 1, 2, A, B, B1, A1, B1. But here it is not 2. It is only A. What is this? Irredeemable. Irredeemable debenture formula is what? Preference dividend divided by net proceeds or market price. How much? 11.5%. What about the cost of debt? Interest into 1 minus tax divided by net proceeds or market price. 6.5. Weighted average cost of capital. Just now I projected, right? What method? Proportionate method I used here. KE into equity share capital divided by total capital employed. KD into debt capital divided by total capital employed. Same logic they followed here, right? With this they calculated weighted average cost of capital. How much? 9. Right. Now company going for additional funds, right? Additional funds they are going to rise. When the company raises additional funds by debt, with effect market price will become 160. Yes or no? Growth rate remain unchanged. DPS1 is going to increase 12.5. In such a case KE equal to DPS1 divided by market price plus growth rate. So 12.76%. Cost of preference remain same. Yes or no? Cost of old debt remain same. But new debt you are raising. New debt cost, interest into 1 minus tax divided by net proceeds or market price. So 12 into 1 minus 0.35 divided by 100 into 100. How much it is? 7.5%. By taking weighted average cost of capital, KE into equity share capital divided by total capital employed plus KP into preference share capital divided by total capital employed plus KD into debt capital divided by total capital employed plus KD is a new, right? KD is nothing but old as well as new into debt capital divided by total capital employed. By taking all the value, if you estimate 10.41%. Previous one, what is that? This is weighted average cost of capital. This is what is it? Marginal cost of capital. Okay, ma? So this is with respect to cost of capital. Maximum you can solve the problem, because I'm not here to solve the problem. If one problem I will solve, this much of information I cannot give it. But the randomly what I thought it, even though I talk to the student over the period of 45 minutes, student may think that generally, okay, sir gave some information. But I don't want to give. That is the point. I wrote it. How many questions? 25 questions, including some concepts. And there are several things which I could not put it on paper, but I explained this. So today you came and you remembering how many? 25. With the numerical data, I want to give it up. Because last time, before time, when I used to give information, right? Students just generally listen, but they too know that, oh, attending this class, today I learned these many concepts. At a time, 45 minutes exactly I spent on cost of capital. But this 45 minutes you can spend unproductively outside. But even though you learn for 4 hours, you cannot get this much of conceptual knowledge. So now with this support, you can make an attempt for all the questions. You can understand better way. Right? With this, we completed, what is that? Cost of capital. Very, very important chapter. Another important chapter, because it includes, you see, KE, KP, KD, KR. How many techniques? Yes or no, ma? Right. The next one. Another important point is cost of capital. We will take, what is it? Capital structure. This is another book. 18 pages are there. Capital structure. ఒకసారి అందరూ లేడు పైకి. अब नहीं तो కభీ నహీ. డబ్బులు ఊరికే రావు రే, డబ్బులు ఊరికే రావు. కానీ మీతో ఈరోజు రాని వాళ్ళతో పోల్చుకుంటే మీకు వస్తాం. Exactly half an hour I will give a break. Next afternoon session I will take working capital management. You know that how important that is, right? Jaldi kaake aa jao, right? Explain capital structure. What is a capital structure? See, capital structure, this is the most important point. Capital structure. So capital structure means, dear student, you should understand, when company need a capital, this capital company rises from what sources? Long term sources. Its mixture is called, what is that? Mixture, or what is that? Combination is called, what is that, ma? Capital structure. Point number 1. Is it what? Short term or long term, ma? Long term. What is this? It's their combination is called capital structure. It happens only when the company wants to raise what? Capital. Okay. Capital structure. That is, what do you mean by capital structure decision? Capital structure decision means, so it is a decision with respect to what proportion? What is that? What proportion or percentage of capital mix to be done, right? Mix to be done. Sir, what is the wrong, sir? If we raise debt, what happen? If you raise more debt, Coffee Day CEO story. More debt, more interest, unable to pay, suicide. More equity, sir. In such a case, Satyam Computers. More equity means ownership lost at one fine day for the sake of not able to, a person who started company, but a person who failed to manage a company. The person who has a knowledge to what? Start. But the person who don't know, manage. So that is the most important. Hello? Katnam godu teesko. No. Equity. Equity means Satyam Computers is the best example. Satyam Computers got collapsed. Why? Because the company raised 100% debt. 100% equity. Man, when you raise 100% equity, you will lose what? Ownership raised. Whereas more debt, low equity. Debt more and what is that? Equity little bit less. What is that? Kingfisher, you can take it. Bhag gaya bachcha. That is a real. You have to design capital mixture in such a way that like a Reliance. Hello? 51%, what is that? Equity. And the remaining 49% is debt. They will take your opinion, but they won't listen. They will take a decision. They will take your opinion, but they will take already decision. Because for raising every debt and equity, they have only, they have their own positive as well as what is that? Negative. Being a financial manager, what do you have to do? You have to mix in such a way that it should give the best. If the ingredients in curry is not good, curry goes waste, right? In the same way, the company has to design such a mixture. What proportion company has to do, what percentage of capital mix should be done by considering what do you have to consider? Risk, cost, control, government, rules and regulations. By considering all these points, being a financial manager, you have to determine which one? Capital mix. What do you have to consider? Risk, cost, control, government rules and regulations. By considering all these things, you have to design a capital structure, right? Capital structure is different. Capital structure, decision is different. What is a financial structure? Financial structure means both short term, okay? Financial structure means not a capital structure, Maji. Financial structure equal to, what is it? Financial structure equal to long term funds and what is it? Short term funds. Long term fund, short term funds mix is called, what is it? Capital structure, right? Explain meaning of optimum capital structure. Optimum means what is it? Best. So optimum capital structure, best capital structure. In this best capital structure, what happens? The three things may happen. Either EPS may highest, or market price may highest, or weighted average cost may, what is it? Least. So such a indication, any capital structure which may have which may gives highest EPS, which may have highest market price, or which may have, what is it? Least cost. Such a capital structure is called what? Optimum capital structure. And how do you identify? Already I discussed that point, is clear. Explain briefly what analysis? EBIT, EPS analysis. In this analysis, what we are going to calculate? Estimation, we will estimation of EPS from given EBIT. Hello, what we do? We estimation of, what is it? EPS from the given EBIT. Which financial plan has highest EPS that would be recommended as? Hello, and which financial plan? Highest EPS financial plan is considered as, what is that? Optimum capital structure. Optimum capital structure. Maji, optimum capital structure indicates what is the EBIT EPS analysis? Tell me. Sir, very simple. In this analysis, what we going to do, sir? We are going to estimate what? EPS, sir. From where? EBIT. Thereafter, sir, what we going to do, sir? Highest EPS we are going to declare optimum capital structure. Very simple, sir. If you ask me, sir, Balu sir, what we do is, we are going to do is, we will take different types of plans, sir. Different types of plan. Plan 1, sir. Plan 2, sir. Plan 3, sir. What we going to do, sir? Here we will take which one? We will take each and every plan. We will take what? EBIT. Hello? From EBIT, what we are going to do? Less interest. Are you getting? After deducting interest, what we will get? EBT. From that EBT, what we are going to do? Then we will pay, what is that? Tax. Less tax. Then we will get, what is that? EAT, sir. So EAT, from that EAT, what we do, sir? We will less, what is that? Preference dividend, sir. From the preference dividend, what we will get, sir? So earning availability to equity shareholders, sir. From the earning availability equity shareholders, we will take, what is it? Number of equity shares, sir. From number of equity shares, then we will get, what is it? EPS, sir. So like this, Balu sir, how many given plans are there? Yes or no? Each and every financial plan, what happened, ma? We used to calculate the same procedure of EPS. Here also we calculate EPS, right? And here also we will calculate, what is it? Same EPS. So which plan will gives you, what is that? Highest EPS, that would be recommended as optimum. For this purpose, you must have the knowledge on how to commence the problem from what, Maji? From EBIT to how to take the problem to where? EPS. This is called EBIT EPS analysis. Got the point? So in this plan, we will start to find it out EPS from EBIT. Which plan gives you highest EPS? Now here it is 25, 99, 49. Tell me which plan would be the best? Plan 2 would be the best. I got it? 10 marks was the problem. Right. Next analysis. EBIT market price analysis. In order to understand EBIT market price analysis, you should understand what is PE ratio. Hello? PE ratio means it is the ratio which shows the relationship between market price and EPS. Basing on this, you can calculate market price like this. Market price equal to PE ratio into what is that? EPS. That equal to market price, you will get it. So in this analysis, what you are going to do, you must estimation of what is that? Estimation of market price from given plans with support of what? With support of PE ratio. Hello? PE ratio. So here how do you calculate, sir? Very simple. How many plans you have? 3 plans, right? Plan 1, plan 2, plan 3. What we are going to do is, already you calculated what is it? EPS. Hello? Up to EBIT EPS analysis you came. Now take a EPS. EPS is 40, 29, 60. What you do is PE ratio. PE ratio is 20, 16, 5. Now can you calculate market price? Market price equal to? So A into B. How much ma? First plan. Tell me. Involve. Huh? 800. 464. Huh? 300. Now tell me, in which plan you will recommend why? Which plan you will recommend? Tell me. Plan 1. Why? Because highest. If now tell me, in this, what is a EBIT market price analysis? Sir, EBIT market price analysis. Sir, it is analysis where we estimate what, sir? Market price from the given plan, sir. What is with support of what is it? PE ratio, sir. How do you calculate market price, man? Very simple, sir. PE ratio into EPS, sir. Sir, what is a PE ratio? Sir, PE ratio is a ratio which shows the relationship between market price and EPS. It speaks that how many times the market price is higher than comparing to its EPS. PE ratio always represents in times. What is that? Times. Let us take 40 times. Ante the meaning edi. So now the company's EPS is earning 1 rupee, but the market price of the company is floating how many times? 40 times. Or you can also understand like this. I observe the PE ratio of the company is 40 times means in the market all the people are ready to pay 40 times more than to concern share. అందరూ 40 టైమ్స్ ఎక్కువ పే చేయడానికి రెడీగా ఉన్నారు. ఎందుకు సార్ అంత ఎక్కువ ఉన్నారు? తెలియదు. అందువల్ల దాని PE రేషియో ఎంత ఉంది? 40 ఉంది. దీన్ని 2 రకాలుగా ఆలోచించవచ్చు. 40 టైమ్స్ ఎక్కువ ఉంది కదా, ఇప్పుడు మనకు అవసరమా అని ఆలోచించవచ్చు. అందరూ 40 టైమ్స్ పెట్టుకుంటున్నారంటే ఏదో ఉంది కదా, కాబట్టి మనము కొందాం అని ఆలోచించవచ్చు. ఏది రైటు ఏది నిజం మనం ఏం చెప్పలేం. ఇన్పుట్ ఇవ్వడమే నా బాధ్యత. ఎస్ఆర్నో దాన్ని ఎలా డీకోడ్ చేసుకుంటాం అనేది మీ ఇష్టం. దట్ ఈస్ అనాలిసిస్ ఇస్ వ్యారీస్ ఫ్రమ్ పర్సన్ టు పర్సన్. దట్ ఈస్ ద రీజన్ స్టాక్ మార్కెట్లో ప్రతి సెకండ్ రెడ్ గ్రీన్ వస్తుంటుంది. అంటే ఈ షేర్ ప్రైస్ పడిపోద్ది అనేవాడు అమ్మేసుకుంటాడు, వావ్ దొరికింది అనేవాడు కొంటాడు. పెరుగుతుంది అనుకునేవాడు ఏం చేస్తాడు? పర్చేజ్ చేస్తాడు. పడిపోద్ది అనుకునేవాడు సెల్ చేస్తాడు. వీళ్ళిద్దరు ఒపీనియన్లో మారడం బట్టే షేర్ ప్రైస్ వాట్ హ్యాపెన్ గెట్స్ అ ఫ్లక్చువేషన్. దిస్ ఇస్ బాలు సార్. ఈబీఐటీ ఈపీఎస్ అనాలిసిస్, ఈబీఐటీ మార్కెట్ ప్రైస్ అనాలిసిస్ బోత్ ఆర్ సేమ్, యు నో. ఏం ఆలోచించి ఆన్సర్ 6 సంవత్సరాలు చెప్తున్నారు. ఇప్పుడే కదా ఎంత ఎఫెక్టివ్గా చెప్పింది. ఈబీఐటీ నుంచి ఈపీఎస్ క్యాలిక్యులేట్ చేస్తాం. ఆ ఈపీఎస్కి PE రేషియో మల్టిప్లై చేస్తే మార్కెట్ ప్రైస్ వస్తుంది. ఇప్పుడు ఒక క్లయింట్ విల్ కమ్ అండ్ ఈ విల్ ఆస్క్ దట్ ఐ నీడ్ ఆప్టిమమ్ క్యాపిటల్ స్ట్రక్చర్ బేసింగ్ ఆన్ వాట్ ఇస్ ఇట్ ఈపీఎస్ అన్నాడు అనుకోండి. ఫర్ హిమ్ వాట్ హ్యాపెన్, వీ యూస్ టు టేక్ వాట్ ఇస్ ఇట్, వాట్ అనాలిసిస్, Here to calculate optimum capital structure, one person EPS తాగొచ్చు. Hello? Another person he may come what? Market price. Okay? That is the reason we calculated the market price analysis. Next one. What is the indifference point analysis? Difference. Indifference means what is it? So indifference means no difference. Yes or no? Indifference means no difference. So what is this point is? Indifference point, it indicates it is the level of EBIT. What is it? It is the level of EBIT at which EPS remains same between two financial plans. How many plans? Two financial plans. It is the level of EBIT at which EPS remains same between two financial plans. Indifference never be calculated between one plan. It need compulsorily how many plans? Two plans you need it. But in the two plans, what is that? EPS remains same at that level of what we are going to calculate. What is this? EBIT, we are going to find it out. So how do you calculate indifference point? It indicates here. Let us take plan 1. We will take plan 2. So EPS remains same means indifferent point equal to what we will take. We will take X EBIT. X minus interest into 1 minus tax minus preference dividend divided by number of equity shares. Hello? Equal to X minus interest into 1 minus tax minus preference dividend divided by a number of equity shares. This is 100%. Let us take equity. This is 50% equity, 50% debt. By resolving this equation, you will get a indifferent point R X equal to 40,000. What do you mean of this 40,000? 40,000 indicates how much capital you are going to raise. I don't know, but the thing is one thing, man. Whatever the capital you will invest in this business, with the business, if you are able to generate how much? 40,000. If you are able to earn 40,000, at that 40,000, both plan will give you same EPS. Hello? 40,000 both plan will gives you what is that? Same EPS. Are you getting? Same EPS. Could you able to earn more than EBIT? More than 40,000 or less than 40,000? We have to ask. If the company says, sir, I will earn more than 40,000. More than 40,000, then you have a capacity to take risk. I advise you go with the plan 2. Because plan 2 consists what? Here plan 1 is what? 100% equity. Here plan 1 is equity. Let us take 25% debt plus 25% preference. Means what we can say? You better to take which one? Plan B. If you are able to earn more than 40,000. Balu sir, 10,000 only sir. In such a case, sir, better to go with which one? Plan 1. Sir, Balu sir, 40,000 sir. In such a case, 40,000. Either A or B. It does not make any sense, man. So such a analysis is called, what is that? Indifference point analysis. See, in order to select a capital structure optimum, we have a lot of analysis. One of the analysis is indifference point analysis. Tell me indifference point analysis. Indifference means no difference. Indifference point analysis. It is the one of the analysis at which at level of EBIT, EPS remains same between two financial plan. Indifference point at indifference point or indifference level of EBIT, after calculation this, you have to interact with whom? Your client. Hello? Are you getting? You have to interact with your client and you have to find it, you have to identify that, sir, I calculated 40,000 indifference level of EBIT. It means, sir, if you can generate 40,000, okay, generate 40,000 between the two financial plan, both will give you same EPS. Sir, now tell me, if I want to guide you which plan would be the best, means you tell me how much EBIT you supposed to earn in future. If you are able to earn more than 40,000, you have a guts to take a risk, go with a risky plan. If you earn less than 40,000, sir, we can see less, sir, equity calendar 40,000, any of the same. Hello? This is called what analysis, ma? Indifference point analysis. Thereafter, what is that? Financial break-even point analysis. Financial break-even point analysis means it is the level of EBIT at which EPS remains same. What is that? Any plan you may take it, right? Not same. 0. What is that, ma? 0 means you try to understand. It is the level of EBIT at which EPS remains, what is it? 0. It means that you are making a profit. How much profit you supposed to make where your EBIT equal to your EPS equal to 0. It means that whenever any plan, if you are going to implement, you have to understand commitment. If you want to get Rama like a husband, you must be Sita. If you want to get Rama like a husband, you must be Sita. If you want to get Sita like a wife, you must be Rama. If something goes wrong, right? ఒకడికి హెడ్ పగిలిపోయింది, ఇంకొక ముక్కు పగిలిపోయింది, తెలుసుంటుంది కదా. మిగిలిన స్టోరీని మీరు చదువుకోండి. అంటే ఆ కమిట్మెంట్కి కమిట్ అయ్యే విధంగా మీ కమిట్మెంట్ ఉంటేనే అది వర్కౌట్ అవుతుంది. ఫర్ ఎగ్జాంపుల్, ఐఎమ్ రైజింగ్ అ ఫండ్, ఐఎమ్ డూయింగ్ అ బిజినెస్ మీన్స్ నథింగ్ ఎల్స్. You have to understand that what is the commitment in this plan. For example, you try to understand there is a 3 plans are there, right? 2 plans. One plan 100% equity, another plan 50% equity plus 50% debt. 50% debt means you have to compulsorily pay, what is it? Interest. ఇందులో ఉండదు, ఇందులో అయితే పే చేయాలిగా. So it means that how much EBIT you are earning. Now, I don't want, right? For example, 40,000 interest means what is the commitment you have? 40,000 EBIT you must earn. Sir, actually I am earning 2 lakhs, sir. Arey, that is not a matter, man. నువ్వు 40,000 కంపల్సరీగా ఎర్న్ చేయాలి. వర్షం పడ్డా పడకపోయినా, బైక్ పని చేసినా పని చేయకపోయినా, మైక్ ఉన్నా పోయినా, అంతెందుకు? సార్ నో, దిస్ ఈజ్ యువర్ కమిట్మెంట్ ఇర్రెస్పెక్టివ్ ఆఫ్ లెవెల్ ఆఫ్ ఈబిఐటి. ఇట్ ఈస్ అ కమిట్మెంట్, రైట్? మాస్టర్ మైండ్ ఈరోజు మారితాను కండక్ట్ చేసింది. ఒక్కరు వచ్చినా రాకపోయినా నాకు ఇవ్వాల్సిన శాలరీ ఇచ్చేయాలిగా. ఇట్స్ అ కమిట్మెంట్. ఒప్పుకున్నారు కదా, ఇచ్చేసేయండి. అంత డెప్ట్ రైజ్ చేసావు కదా, ఇంట్రెస్ట్ కట్టాలిగా, అంత ఎర్న్ చేయి. సార్ నేను అంతకంటే ఎక్కువ ఎర్న్ చేస్తాను, నాకు ఎందుకు రా అంటాడు. సార్ అంతకంటే తక్కువ ఎర్న్ చేస్తాను, నీకెందుకు రా అంటాడు. ఓకే, నువ్వు ఎంత ఎర్న్ చేయాలి? 40,000. దట్ ఈస్ యువర్ కమిట్మెంట్. ఇఫ్ ద కంపెనీ నోస్ దట్ దిస్ కమిట్మెంట్ 40,000 ఈజ్ మై కమిట్మెంట్, నౌ థింక్ హౌ మచ్ యాక్చువల్లీ యూ కెన్ జనరేట్. 4 crores. రిలాక్స్. Because hardly your commitment is how much? 40,000. Every year you are making 40 crores. Kada? You can celebrate your life. But you don't know that whether you are going to make 40,000 or not. In such a case, what happened? It is high risky. Are you getting? So financial break-even point means what? It is the level of EBIT at which EPS remains 0. Ante company have what is that? EBIT. Company have a EBIT. Now tell me, for plan 2, you must earn at least how much? 40,000. For plan A, 100% equity, how much they have to earn? 0. Why? Because no commitment. Hello? No commitment. Without commitment, you can understand, comfortably run your business. This is called financial break-even point. It means that EBIT of the company equal to fixed financial commitments. Fixed financial commitments of the company. Are you getting, ma? So how many analysis we completed, Maji? 4 analysis. EBIT, EPS analysis. Highest EPS is the optimum. EBIT market price analysis. EPS into PE ratio, market price, highest market price is the optimum. Indifference point analysis. It is the level of EBIT at which EPS remains same between 2 financial plan. Indifference point arises between 2 financial plan. 3 is given, sir. In such a case, 3 given. In such a case, A and B, B and C, AC. Hello? Are you getting? And financial break-even point. It is the level of EBIT at which EPS is 0. It is a commitment, right? Once you are continue to implement, you have to commit yourself for the commitments of the concern plan. Got it? CMA లో జాయిన్ అయితే CMA లాగా చదవాలి. అవునా? BA లాగా చదివితే ఎస్, అది కూడా రాదురా. Next, what do you mean by these are the 4 analysis we done. Thereafter we have what? 4 approaches. Capital structure theories. Next concept is theories we have. How many theories you know that? Net income theory, net operating income theory, traditional theory. Another one is, what is that, ma? Machperamma? MM model. How many models, Maji? Net income, net operating income, traditional theory, theory. And each theory is based on certain assumptions. What are the assumptions? There are only two sources of funds. Hello. Two sources of funds. What are they? Equity plus what is it? Debt. No chance of what? Preference. What are the assumptions of this one? Two sources means what? ఓన్లీ మీకు మొత్తం కూడా నేను రాయలేను, ఎందుకు చెప్పు? టైం లేదు. దాన్ని చూస్తే అర్థమైపోవాలి, ఇంకంతే. అర్థమైందా? పక్కింట్లో స్మెల్ చూసి ఏ కర్రీ చెప్పేస్తాంగా. మరి అంత ఎక్స్పర్ట్స్కి చెప్తున్నా, నేను ఏమైనా బేసిక్ పీపుల్కి చెప్తున్నా మొత్తం టూ సోర్స్ అని రాయడానికి. రైట్, ఇటు చెప్పు. టూ సోర్సెస్ ఆఫ్ ఫండ్స్, ఈక్విటీ ప్లస్ డెప్ట్. రైట్. అనదర్ వన్ ఈస్ company, there is a guarantee of what is that? EBIT. Company certainly makes what is that? EBIT. No loss. Hello? No loss. Company makes a EBIT. Whereas what is that? Two sources of funds. KD is less than what is that? KE. Hello? KD is less than KE. And at the same time there is no risk. No risk of what? Because of what decision? Financial decision. If company raises funds, because of that there is no risk to whom? Equity shareholders as well as investor. Now tell me, two sources of funds are? There is a guarantee of what? EBIT. KD is less than KE. No risk to, no risk because of debt rise cheyadam valla, equity rise cheyadam valla meeku risk perigedi ledu, taggedi ledu. Another one is company follows 100% DPR. 100% DPR means 100% dividend payout ratio. It never retains it. Hello. Another one is no tax. What is that? No tax. No tax. So these are the certain points to be considered. What are the once again? Two sources. Confirm EBIT. KD is less than KE. No risk. Financial decision. 100% dividend payout ratio. No tax and perpetual existence. Perpetual existence. Gurtunda perpetual existence ante enti? So yeah, forever perpetual existence. These are the points. Theory కూడా అడిగినాడు మీకు ఇందులో. రైట్. నెక్స్ట్ కమింగ్ టు నెట్ ఇన్కమ్ థియరీ. వాట్ ఇస్ దట్? నెట్ ఇన్కమ్ థియరీ. దిస్ థియరీ వాస్ ప్రపోజ్డ్ బై డేవిడ్ డ్యూరెండ్. ఎవడు? డేవిడ్ డ్యూరెండ్. దిస్ థియరీ స్పీక్స్ అబౌట్ రెలవెన్స్. దిస్ ఇస్ కాల్డ్ వాట్ ఇస్ దట్? వాట్ మోడల్? Relevance model. Relevance model indicates what is the relevance model. It speaks that debt equity mix of the company. What it indicates? Net income theory, what it identifies that debt equity mix of the company does not, debt equity mix of the company. Hello, Farangma? Are you getting? What theory this is? First one is what? Our class up to, that's I'm seeing that watch, that's my attention is 1:30. Okay. Who is David Durant? What is the relevance model? Relevance model means because of your capital structure you can influence market price. So this theory argues that very, very simple. A company, try to understand. Company may reduce, which one? Reduce KO. Reduce KO and increase market value of what is that? Firm by employing which one? Least cost fund. Which one? Debt. Is a theory. Are you getting? What is this point is? A company financial manager, if he raises funds, which one? A company can reduce, what is it? KO, Induku, by increasing, what is it? Market value of firm by employing, which one? Least cost fund called. What is the logic, sir? Balu, sir. Market value of firm equal to EBIT divided by KO, sir. You know that? Market value of firm equal to EBIT divided by KO. EBIT 50 lakhs anko. KO 20% undanko. Appudu enta avudamma cheppu? 50 lakhs divided by 20%. 250 lakhs. 50 lakhs divided by 10% aithe? Huh? 500 lakhs. 40 lakhs divided by 8% aithe? Huh? 500 lakhs. What is observation? KO decreases. EBIT same. KO decreases automatically. What happened, man? ఇఫ్ కంపెనీ రెడ్యూసెస్ కేఓ విత్ ఎఫెక్ట్ వాట్ హ్యాపెన్? ఇదే కదా మనం అనుకుంది, మీరే కదా ప్రూవ్ చేసి చెప్పారు. ఇప్పుడు కేఓ డిక్రీజ్ అవుతూ ఉంటే ఏమైంది? మార్కెట్ వాల్యూ ఆఫ్ ఫర్మ్ పెరిగింది కదా. ఒక కంపెనీ క్యాపిటల్లో కేఓ తగ్గాలంటే లీస్ట్ కాస్ట్ ఫండ్ రావాలిగా. ఇప్పుడు మార్కెట్లో అజంప్షన్స్ ఏంటి? కేడి ఈజ్ లెస్ దాన్ వాట్ ఇస్ ఇట్? కేఈ కదా. when KD is less than KE అయినప్పుడు one thing is confirmed, if I able to reduce KO I can increase market value of firm. If I want to increase market value of firm, what should I do? KO to be reduced. KO to be reduced means what should I do? In the place of equity what happen? I should do what? In the place of equity ni redeem chesi దాని ప్లేస్ లో ఏది తీసుకోవాలి? డెప్ట్. ఈక్విటీని redeem చేసి డెప్ట్ if I bring it, automatically KO what happen? Decreases. KO decreases, automatically market value of firm increases. Hence practically you people calculated now. So David Durand first theory, net income theory. This theory was suggested by David Durand. According to this theory, a company may decrease its KO and increase its market value of firm by employing least cost fund called what? Debt. Sir, there is no risk to equity shareholders, sir? No risk. That is the this point theory model, this point. So net income approach, this theory, he practically proved with a diagrammatic representation like this. So there is a KD, here is KE equal to KO, which is funds are available at a 25%. Now the company KD is available. KD is available at a 10%. Now tell me, you are the financial manager. Your ultimate job is to market value of firm you have to increase. So market value of firm has to increase means KO you have to decrease. KO you have to decrease means your eyes on this, right? Your eyes on what is that? These two things, right? In such a case, financial manager what happen? He will takes, this company moves 100% equity means KE equal to KO equal to 25% కదా. ఏమ్రా ఇప్పుడు మీరు ఏం చేయాలి? మార్కెట్ వాల్యూ పెంచాలి. పెంచాలంటే ముందు ఏం చేయాలి? కేఓని తగ్గించాలి. కేఓని తగ్గించాలంటే ఏం చేయాలి? కేఈని రెడీమ్ చేసి దాని ప్లేస్లో వాట్ హ్యాపెన్? కేడీని తెచ్చుకున్నాం అనుకో, వాట్ హ్యాపెన్? కేఓ గ్రాడ్యువల్లీ డిక్రీజెస్. వెన్ కేఓ డిక్రీజెస్, automatically market value of firm what happen? Increases. Sir, there is no risk to equity shareholders, sir? No. Why, sir? Because return on capital employed is greater than interest to be paid. Company raises a debt at 5%, but invested and generates a return worth of how much? 25%. From the 25%, after all it gives to debenture holders how much? 5%. Remaining 20% will be given to equity shareholders. Is there any risk to whom? Equity shareholders. So this is the theory of with respect to what? Net income theory approach. Net income approach. Assumption. There are only two sources of funds. What are they? Equity and debt. There is no risk to equity shareholders. KD is less than. There is a guarantee of EBIT. సార్ అప్పు తెచ్చుకుంటూ పోతే ఒకవేళ ప్రాఫిట్ రాకపోతే సర్వనాశనం కదా, అందుకోసం కదా అజంప్షన్ అంటున్నాం. ఏమని? దేర్ ఈస్ ఎ గ్యారంటీ ఆఫ్ EBIT, రైట్? దిస్ ద థియరీ విత్ రెస్పెక్ట్ టు net in David Durand. Net operating income theory. We'll continue. Right, ma? And here more than I covered, there are topics to be. Here you see, these are the past exam points they asked. This chapter, PE ratio, debt equity ratio, capital employed, equity shareholders, risk element of debenture holders, old equity, capital employed, finding return on capital employed, tax shield on debt, why debt is cheaper than equity, over capitalization, under capitalization. ఇవన్నీ ఆఫ్టర్నూన్ సెషన్లో డిస్కస్ చేద్దాం. రైట్? సి, యూ హ్యావ్ ఎ మచ్ టైమ్ టు స్పెండ్ యువర్ లీజర్ టైమ్, బట్ టుడే ప్రొడక్టివ్ సెషన్ ఈస్ గోయింగ్ ఆన్. ఇఫ్ యూ కాంట్ యూజ్ దిస్ టైమ్ మీన్స్ చెప్పేసి వచ్చేసారు కదా ఇంట్లో పాస్ అవుతామని, ప్రూవ్ చేసి చూపించడం కోసం మీకు ఒక ఛాన్స్ ఇచ్చాం. తర్వాత ఎన్ని చెప్పాలో అని చెప్పుకోవాలి. మీరు పెట్టబెడ సర్దుకొని బరాడబెట్టికి వచ్చేటప్పుడు CMA పాస్ అవుజాయిగా చెప్పేసి వచ్చాగా పాస్ చేసి చూపించాలి. సో వాట్ ద టాపిక్ ప్రీవియస్ క్లాస్ మా? క్యాపిటల్ స్ట్రక్చర్ అప్ టు నెట్ ఇన్కమ్ థియరీ, రైట్? నెట్ ఇన్కమ్ థియరీ suggested by David Durand. What is his logic? Debt is not only cheapest but also best source of finance. Because of when company raises the funds, KO decreases with effect market value of firm what happen? Increases. So if you want to raise the funds, it is advisable to raise which one? Advisable to raise maximum funds with a debt.
his way of assumption is that there is no risk to whom? Equity shareholders, and KE and KD remain, what is that? Constant. KE, KD remain constant, and company able to generate normal regular EBIT. Okay, that is the net income theory. This theory favorable to whom? This theory favorable to rise what? Equity or debt? Debt. Okay, that is this theory. What about the net operating income theory? This theory also suggested by point number 1. This theory suggested by who? By David Durant. This theory also suggested by David Durant. According to this theory, what happened? Debt equity mix. What is it? Debt equity mix of the company does not change. What is it? Does not change KO. Does not change KO and what is it? Market value of firm. Market value of firm. It does not change which one? KO and market value of firm. Because the advantage of debt. What is it? Advantage of debt. Debt set off with what is it? Risk of equity shareholders. Risk of equity shareholders or risk of equity. Risk of equity with effect. What happens? KE with effect KO and market value of firm remains same. Remains same. See what this argument is. This theory was suggested by who is that? David Durant. What is his argument? Debt equity mix. Either you increase debt, decrease the debt. Decrease debt, increase the debt. Company does not change. What is it? KO and market value of firm. Both will remain. What is it? Constant. Why, sir? Because the advantage of debt. Because you are raising a debt. Debt is least cost. With effect of KO, what happened? Decreases. Actually has to decrease. But the point is when you debt rises, okay, when you debt rises, you are getting a debt advantage. Actually, KO has to increase because you are replacing equity with what? Debt. But when debt comes means automatically existing equity, what happened? Risk of what is that? Equity shareholders. Advantage of debt set off with risk of equity shareholders means the advantage of debt would increase. Which one? Risk of when you raise a debt and thinking that debt is very, very favorable. But what happened? The existing equity shareholders increasing KE. With effect advantage of debt, disadvantage of equity, what happened? Both are getting set off. Let us take here the situation is this. A company is there 50% equity, 50% debt. Here what the company is planning, company planning to rise equity is 14%. Debt is available at or completely, let us take it is 100% of what is it? Equity. 100% equity is there. The company is moving at a 10%. How much? 10%. Now the financial manager of the company thinking that debt is available at us, let us take at a 10%. Here equity 10%, 8% you take it. How much? 8%. So now the financial manager may think that we do one thing, 50% out of this 100%, 50% equity we will redeem. Hello? When we will redeem means how much of cost percentage funds going out? 14%. Not this is 10%, right? 10% cost is going out and 8% cost is coming in. With effect how much you had saved? 2% saved. Generally if 2% saved means KO has to what happen? Decrease. But the David Durant what he recognized, now presently company moves 100% equity means KE equal to KO. Hello? KE equal to how much? KO. That is how much percentage? 10%, right? Now you redeeming equity, it means that 8%, 50% oriented equity is going out. This funds is how much? 10%. 10% cost is going and in that how much coming? 8% is coming. So how much you saved? 2% saved. Sir, I saved 2%. With effect KO decreases. With effect market value of firm will increase. Apdiya? Ippa paranted. Apdi if we debt equity the remaining 50% equity shareholders, previously they've been asking how much? 10% and their risk increases. With effect they will add 2 more percent and they will stand to 14%. Now tell me how much advantage you got it? 10% is gone 8% came. How much advantage you got it? 2%. Because of rising debt, already 10% equity shareholders remaining people has increased. 12%. 12, right? 12% increased. So this 10, what happened? This 2. Both would add up hence. Set off effect. Are you getting my point? Any get? So simple logic here it is. Advantage of debt would be set off with risk element of equity shareholders. I am running company 100% equity. 100% equity means KE equal to my KO. Are you getting? I know that if I reduce the KO, market value of firm, what happened? Increases. I thought it that why don't I send the equity shareholders outside? The 10% people, hey, go out. I send all the people. Instead of them, I call whom? Debenture holders, where the funds available at 8%. Now tell me, being a financial manager, you people are equity. 10 actually is there. 50% these people I send outside and 80% I called out. So 10 went, 8 came. I saved how much? 2%. And remaining, I thought that these people are 10. Average is nothing but, now KO, what happens? Decreases. But thing is, when 50% equity goes and in that place debt comes, remaining 50% equity shareholders charge to increase KE 12%. So previously how much they used to get? 10. Now how much you expecting? 12. Previous, in that case, why the 2% increased? Because I raised a debt. What is the advantage I got it? Why for I went for debt? Because taking advantage of what? Debt. So 8 gone, 10 gone, 8 came, 2% saved. Because of this debt, equity increased 2. Hello? 2 advantage, 2 disadvantages. Exactly set off. If you make a set off, KO will remain constant. So KO remain constant. Market value firm will remain constant. Thus, debt is not a best, debt is not a worst, debt is just. What about David theory? Since debt is cheapest, thus it is the best. Whereas net operating income theory, debt is not best, debt is not worst, debt is just. So this theory, what it arguments is, if you project in diagrammatic representation, let us take, here it is a company moves with a KE, KE equal to KO, hello, here it is, what is that, KD is there. Now if the company rises a debt percentage, automatically what happen? As debt increases, KE never be at 20%, hello, automatically KE starts to increase. So here, when the advantage of debt whatever is there, this is exactly what happened. Set off with effect, KO will remain, what is it? Constant. When KO remain constant, market value of firm will remain constant. So this would be KE, this would become KO, and this would become, what is it? KD. When you are rising debt because of this debt, what is increased? KE increased. So advantage, disadvantage both would happen. What is it? Set off effect. With effect, KO will remain constant. Both the theories are suggested by who? David Durant. Now tell me, David Durant argument. Is there any risk to equity shareholders? Yes. When there is no risk to equity shareholders, if it is a net income theory. Are you getting? There is a risk to equity shareholders when it is net operating income theory. So he said that because of rising debt, if equity shareholders feels risk, then advantage of debt would set off with the equity, with effect KO remain constant, then there is no chance of optimum capital structure. Why? Because every capital structure is optimum. Because in every capital structure, KO will remain constant. When KO remain constant, market value of firm will remain constant. Got it? What about net income theory? When you rise a debt, there is no risk to equity shareholders. With effect, KO decreases. With effect, market value of firm increases. So debt is best because it is the cheapest. Here debt is worst because it is the riskiest. Okay. Here set off effect happens. With effect, KO remain constant. This is the both the theory suggested by who? David Durant. Next theory. This is the what? Traditional theory. This theory was suggested by Ezra Solomon. Who is that? Ezra Solomon. Ezra Solomon. According to this theory, what is that? He projected that debt is that a company is there, right? This company, what this company makes, this company can reduce which one? KO. And increases, what is it? Market value of firm by employing least cost fund. Which one? Least cost fund. That is debt. Okay.
This is what theory actually? Net income theory, right? See, a company can reduce which one? KO and increase market value of firm because of least cost fund, that is a debt. But only thing is up to certain point. Up to certain point. So thereafter, up to certain point, this phenomena happens, right? Whereas additional debt, if you raise additional debt, what happen? Okay, with effect additional debt, what increases? KE increases, KD increases, KE increases, KD increases. Because of this both effect, what happen? KO increases. Because of with effect of market value of firm, what happen? Decreases. So debt is best up to certain level. Thereafter it is the costliest, riskiest, finally worst. పూర్తిగా మారిపోయిన చంద్రముఖి అయిపోతుంది. అది మొత్తం డెప్ట్ తెచ్చుకున్నాం అనుకో, ఇది సిచ్యువేషన్. ఇప్పుడు చెప్పండి, ఇమేజ్ని బేస్ చేసుకొని చెప్పండి, వాట్ దిస్ థియరీ సేస్. దిస్ థియరీ వాస్ ప్రొజెక్టెడ్ బై హూ? Israel Solomon. What this is argument? Sir, a company certainly reduces what? KO, sir. And with effect when KO decreases, sir, market value of firm, what happen? Increases, sir. But this will happen because of least cost fund called what, sir? Debt, sir. But sir, up to certain level, sir. If you ride beyond a certain point, what happen? Additional debt, number one, it increases KE. Number two, KD also increases. When KD increases, KD increases with effect. KO increases. KO increases, market value decreases. So, Balu sir, raise the debt up to certain level. Okay. Beyond that level, if you rises, automatically risk what happen? Increases. Is this argument. So, first, David Durant first theory. Since debt is cheapest, thus it is the best. Net operating income theory. Debt is not best, debt is not worst. Debt is just. But this theory says debt is best up to certain level. Thereafter it will become riskiest, come costliest, finally worst. So don't raise debt. ఇంతకీ మనం ఫండ్ రైజ్ చేయాలా, రైజ్ చేయకూడదా? ఒక్కొక్కడు చెప్పి చచ్చిపోయాడు. అవునా? ఇప్పుడు మనం వీటిలన్నిటిని స్టడీ చేసి బికాస్ ఆఫ్ కరెంట్ ఎన్విరాన్మెంట్ you have to consider. So these are the three theories suggested by David Durant. David Durant diagrammatic representation is this. It is a KD. Okay. This is the KE is there. Okay. When company moves 100% equity, then KE equal to KO, right? But the thing is, once you raise a debt, this is the debt. While going on raising a debt up to certain level, there is no risk to whom? Equity shareholders. So then KO gradually, what happen? Decreases. When KO decreases up to certain level, right? Because of this KD also will remain up to kidhar? Up to here. If you rise beyond this, what happen? The KE, what is there in the company, up to who, whatever the journey it makes, after this, it will starts to increase. When it starts to increases, automatically there is another effect will also takes place. What is it? KD up to here, the journey, what the debt will takes place, KD also increases. So with effect, what happen? KD increases, KED increases, both will increase, with effect, what happen? Up to here, whatever the KO will comes, right? From this onwards, what it will increase? KO also increases. So finally, what you have to do? You raise the debt up to certain level. So what level you can raise the debt means? Where debt, there is no risk to debenture holders, there is no risk to equity shareholders. So up to this is the best chance. So that would be, you can raise the debt and you can enjoy the debt advantage, but it has its own limit. That is the theory of which one? Traditional approach. తెలుగులో చెప్పాలంటే తెగేదాకా లాగకూడదు. అంటే లాగొచ్చునేగా, లాగొచ్చు, ప్రాబ్లం లేదు. ఎప్పటిదాకా? అదే పక్కనోడికి గెలవచ్చు, ఏం ప్రాబ్లం లేదు. ఎప్పటిదాకా? అది ఎగ్జామ్లో కూడా కాపీ కొట్టచ్చు, ప్రాబ్లం లేదు. ఎప్పటిదాకా? అది దొరికామనుకో ఇది అయిపోద్ది పని బతుకు. కాబట్టి దట్స్ వై ఫర్ ఎవ్రీథింగ్ వాట్ ఇస్ దట్? దెర్ ఈస్ అ లిమిట్. సో that theory, this is the theory suggested by traditional theory. So this theory indirectly says that raise a debt but have limit. But net income theory says that debt is cheapest, rise how much you need it. Whereas net operating income theory says that no, don't rise, debt is worst. But this theory says not best, not worst. Okay. Next theory is, what is that? MM theory. Modigliani and Miller theory. Modigliani Miller theory practically proved which theory? Net operating income theory. Net operating income theory argument is what? See, MM approach, here it is. How Modigliani-Miller approach is similar to which one? Net operating income approach. Let us take. So, approach, Modigliani-Miller approach. First of all, you understand net operating income argument is KO remain constant. With effect, market value of firm will remain also constant. Do you agree? Why? Because of what effect? Set off effect. Do you agree? Set off effect. Advantage of debt would be set off with what? Risk element of equity shareholders. But Modigliani-Miller, what happened? Modigliani-Miller, practically proved which theory? Practically proved what theory? Net operating income approach with concept called arbitrage. What is it? With concept called arbitrage. Let us make a practically, I will prove you. Okay. Let us understand. According to net operating income theory, there is a two firms. Firm A, man, hello? Firm A, 100% equity. Do you agree? Firm B is 50% equity plus 50% debt. What is it? 50% equity, 50% debt. Now tell me, as per net operating income theory, which company has a chance to get the tax advantage? Debt advantage. That is nothing but where? B firm. Yes or no? So, net operating income argues that in both company, KO remains same only. Why? Sir, here debt is there, no sir? No. Here KO is there. Here also KO is there. But here actually KO has to, what is it? Decrease. Are you getting my point? But KO is not decreasing there because KE would be here 15%. Certainly here firm B, KE would be. But KE undanako. Net operating income theory prakaram. Both the firms KO will remain argument enti. KO will remain same kada. What is the reason? Even though debt is there, why KO remain constant, sir? Because if the KE in firm A is 15% means certainly here it would be 20%. Hello? Because of this having a 20%, what I am speaking? KE. Hello? KE means what? Cost of equity. ఎందులో ఈక్విటీ షేర్స్ రిస్క్ ఉండదు. అరే ఫర్మ్ ఏ 100% ఈక్విటీతో రన్ అవుతుంది కదా, అటువంటిప్పుడు వాడికి అందులో పెద్ద రిస్క్ ఏమీ ఉండదు. అదే ఫర్మ్ బిలో ఉన్నాడు అనుకో, అందులో దాదాపు డెప్ట్ ఉంది కదా, వాడికి ఇన్కమ్ ఎప్పుడు వస్తుంది? డిబెంచర్ హోల్డర్స్కి పే చేయాల్సిన ఇంట్రెస్ట్ పే చేసిన తర్వాత వాడికి వస్తుంది. అటువంటిప్పుడు కేఈ ఎందులో ఎక్కువ ఉంటుంది? ఎందులో అయితే రిస్క్ ఎక్కువ ఉంటుందో అందులోనే కదా ఎక్కువ ఉంటుంది. సో కేఈ వుడ్ బి హై ఇన్ వేర్? ఇన్ ఫర్మ్ బి. ఇన్ ఫర్మ్ బి కేఈ, హియర్ కేఈ is 15%, here it is 20%. Because of having 20%, advantage of debt would be set off with risk element of equity shareholders with effect KO remain constant. Are you getting my point? So KO remain constant, KE effect. ఇప్పుడు చెప్పండి, ఇక్కడ KE ఇందులో ఎక్కువ ఉంటుంది, KE ఇందులో ఎక్కువ ఉంటుంది, ఇందులో తక్కువ ఉంటుంది, కానీ KO రెండు కాన్స్టెంట్ అవుద్ది. బికాస్ ఆఫ్ వాట్ ఎఫెక్ట్? సెట్ ఆఫ్ ఎఫెక్ట్. ఇదే కదా మనం అనుకునేది. ఇప్పుడు డేవిడ్ డ్యూరెంట్ బోత్ ద ఫర్మ్స్ KO కాన్స్టెంట్ గా ఉన్నప్పుడు మార్కెట్ వాల్యూ ఆఫ్ ఫర్మ్ ఆల్సో విల్ రిమైన్ వాట్ ఇస్ దట్? కాన్స్టెంట్, రైట్? మార్కెట్ వాల్యూ ఆఫ్ ఫర్మ్ విల్ రిమైన్ సేమ్ బిట్వీన్ ద టూ ఫర్మ్స్. డూ అగ్రిమెంట్? డూ అగ్రీ మా దిస్ కాన్సెప్ట్? ఇప్పుడు చెప్పండి, ఈ డయాగ్రామాటిక్ ఏం రిప్రజెంట్ అయ్యింది మీకు? యాజ్ పర్ నెట్ ఆపరేటింగ్ ఇన్కమ్ అప్రోచ్, డెప్ట్ ఈక్విటీ మిక్స్ ఆఫ్ ద కంపెనీ KO రిమైన్ కాన్స్టెంట్. Why it is constant, sir, even though debt is there? Because advantage is there in which company? B. But there is a risk element to whom? Equity shareholders. So advantage of debt, disadvantage of equity, what happen? Gets a set off. Here KE ఎందులో తక్కువ ఉంది? ఫర్మ్ ఏలో తక్కువ ఉంది. హలో, ఫర్మ్ ఏలో ఈక్విటీ షేర్స్ ఎక్కువ ఎక్స్పెక్ట్ చేయడు. ఎందుకు ఎక్కువ ఎక్స్పెక్ట్ చేయడు? వాడికి రిస్క్ లేదు కదా. ఫర్మ్ బిలో రిస్క్ ఉంది. అప్పుడు కంపెనీ ఎందులో ట్యాక్స్ అడ్వాంటేజ్ వస్తుంది? నాట్ ట్యాక్స్ అడ్వాంటేజ్, least cost advantage company enjoys where? B. So tax advantage positive, equity shareholders risk is negative, both will what? Set off. With effect KO remain constant. KO remain constant అయిపోవడం వల్ల market value firm will remain constant. Are you getting? Yeah, this is the point you should understand, dear students. Here KO remain constant, here KO remain constant, KO remain constant. With effect market value of firm also remain constant. But the surprising is debt is there, no sir. So why the KO remain constant? Because here KE would be how much? 15%. Here KE would be 20%. Because here debt advantage is there. Hello? This debt advantage, KE disadvantages, both will takes place. What is it? Set off effect. With effect market value of firm will remain constant. This is whose theory? net operating income theory. Same this theory was proved by who? Modigliani Miller argument is there. He proved that, let us take both the companies are there. Company A and company B is there. Let us take both the company market value remains same. 200 rupees, 200 rupees. This company moves 100% equity and this company goes with what is that? 50% equity plus 50% debt. In this both the company KO remain constant. Market value firm will remain. Market value firm will remain constant. What about KE, my dears? KE. In which company you will find more KE? If this is A, this is the B. So KE would be here, maybe 15% means here it would be 20%. So this is the argument of whom? Net operating income theory. Modigliani Miller argument that okay, this is the theory. But the thing is now present scenario, when net operating income theory was suggested by David Durant, at the time no tax, no financial market, no tax procedure, no stock market, no buying, no selling, no perfect market with respect to information, no attitude change of investor, nothing is there. Just people blindly depend upon, they made it investment, they used to get the earnings. But now situation is changed. People are investing in where? Stock market. They will buy, they will sell basing on various information which is available in the market. Now tell me, company B is there. This company has a close link with the international relationship. Or let us take one company. Suddenly there is an income tax raid is happen in B company. What happens? Income tax raid happen and came to know that it done some little bit scam. In such a case, what happens? People start to sell which company? B company. B company start to sell means market value of B, what happened? Decreases. But actually net operating income argument is that will remain constant. Because you don't know that whether stock market is what? Whether people are going to buy it or not. Nothing. But here, if at all any market bias information comes, suddenly the market value of firm, what happened? From 200 to, of course, if it comes to 20 rupees, how much? 20 rupees. Now market value changed, right? Now tell me, if there is some intelligent investor who been observing this entire procedure outside and he will undertake arbitrage. He will undertake, what is that? Arbitrage. What he will do means, what happened? Because he will find it out that what would be the reason for 200 rupees share price today is floating at how much? 20. There is a scam which happened. Okay, scam happened, right? Legal threat, something is there. Okay, legal procedures are there. Government is there. They will protect, Hello? Now people are, because of just that random information, people are selling the share. Morning 200 rupees. Now how much? 20 rupees. So intelligent investor, what he will think means, morning 200 rupees company share. Now it is at 20 rupees. What is the reason? Because some illegal information the company might have done. Okay, no problem. That is a long run to be sorted out. Hello? Now I want to take this advantage. How should I do? If the 20 rupees share price goes to 40, 100% written, right? Array, 200 rupees 20 kochindi. 20 konno porapadna 40 ayindanako. 100% written kada. In such a case, what he will do means, he will undertake arbitrage. Arbitrage he will undertake. What the arbitrage he will do means, he will start to sell which company share? డబ్బులు లేదు వాడి దగ్గర, సడన్గా పడిపోయింది. ఇప్పుడు వెళ్ళి ఇన్వెస్ట్మెంట్ చేయాలంటే డబ్బులు తీసుకురావాలి, వాడి దగ్గర లేదు మనీ. అప్పుడు వాడు ఏం చేస్తాడు? ఇమీడియట్లీ ఈ విల్ గో టు వేర్? బీ కంపెనీ. అండ్ హీ స్టార్ట్ టు సెల్ విచ్ కంపెనీ? B company shares, and he will take the money. With that money he will come to A company shares, he will sell, right? And he take the money. With that money he will start to buy which company? B company. ఇప్పుడు దేనికి బై చేశాడు, దేనికి సెల్ చేశాడు? ఎందుకు బై చేశాడు, ఎందుకు సెల్ చేశాడు? సార్ 200 20కి వచ్చింది సార్, 20ది 40కి అయిందంటే 100% రిటర్న్. స్కామ్ జరిగింది కదా. అరే స్కామ్ జరిగితే పోలీసులు లేరా? సిబిఐ లేరా? సెబీ లేదా? ఆర్బీఐ లేదా? నువ్వెందుకు అంత కంగారు పడుతున్నావు? నీ యొక్క ఇన్నోసెంట్ ఇంపర్ఫెక్ట్ని నేను ఎన్కాష్ చేసుకోవాలనుకుంటాడు. గెటింగ్? క్రాక్రోచ్ని చూసి సూసైడ్ చేసుకున్న వాళ్ళు కూడా ఉన్నారు కొంతమంది. నాకు తెలిసి క్రాక్రోచ్ని చూసి సూసైడ్ చేసుకోలేదు, కానీ క్రాక్రోచ్ని బైట్ చేసి చచ్చిపోయిన వాళ్ళు ఇంతవరకు నేను చూడలే. కానీ క్రాక్రోచ్ కనిపిస్తే అరిచే వాళ్ళు ఎంత ఉన్నారు తెలుసా? ఆ అరుపులకు పక్కన వాళ్ళు పోతారు ఇంకా, అంతే. అసలు అదొక ఆర్తనాదం. అసలు ఇంకా చావు కేక. అది శ్మశానంలో అరిచామనుకో చచ్చిపోయిన సేవలు కూడా చచ్చిపోతాయి ఇంకా. ఇప్పుడు చూడు, అంత ఓ మై గాడ్. ఉండరా, ఎప్పుడన్నా పేపర్ చదివారా? ఇప్పుడు క్రాక్రోచ్, బికాస్ ఆఫ్ క్రాక్రోచ్ బైట్ ద పర్సన్ లాస్ట్ హిస్ లైఫ్, రైట్? ఈజ్ దర్ ఎనీ? అసలు అది ఏం చేయరు. చైనా వాళ్ళకి ఇస్తే దాని మీద తండూరి చికెన్లా తినేస్తారు దాన్ని.
చీ ఎస్ అమ్మ మన చీ అంటాం, వాళ్ళు సూపర్ అంటారు వాళ్ళు. Okay, means such a product is there, but the thing is, because of risk element. Now you tell me, if the investor by selling his company shares of A, he will buy the company of B, with effect what happen? This company value what happen? Increases, this company value decreases at one point of time, set off takes place. And both the firms will reach equilibrium. His argument is, Mr. David Duran, your argument is right, but way of explanation is wrong. Finally, you said that market value will remain same. I too agree, market value will remain same. But you told because of set-off effect. That would be good in the year of 1961. But in 2023, it could not work, man. Because stock market is there. Arbitrage takes place. With every seconds, people start to buy, people start to sell, and they will undertake the arbitrage. Idhar se idhar. Jump karta rehta hai bachcha. Because of jump ra. Danne technical ga trading antar. Okay na? When you start to make investment, right, దీన్ని బై చేసి దాన్ని సెల్ చేసామంటారు కదా, దాన్ని బై చేసి దీన్ని సెల్ చేసామంటే వై యు ఆర్ బయింగ్, వై యు ఆర్ సెల్లింగ్ మీన్స్ బికాస్ యూ వాంట్ టు గెట్ సమ్ అడ్వాంటేజ్. వెన్ యూ స్టార్ట్ టు సెల్, ఆటోమేటిక్లీ మార్కెట్ వాల్యూ decreases. When you start to buy, market value increases. Because of this two effect, market value of firm what happen? Increases. Now tell me, both the firm proved practically, both the firms market value will remain same. Net of David Duran argument is, because of set of market value firm will be same. But MM of argument, because of arbitrage, both firm will reach what is it? Equilibrium. What is the arbitrage? Arbitrage is mechanism means selling a security, selling at security at high price and buying at security at a low price. Because of this, so two imperfect companies will reach to perfect, means same equilibrium. This is the argument. Are you getting? In Modigliani-Miller argument, you would be asked, if there is no MM theory without a tax, without stock market, without all these things is nothing but which theory? Net operating income theory. Net operating income theory with tax is nothing but MM theory. Got it, ma? But here, Modigliani-Miller argument, one of the finest argument is how to calculate market value of firm in the presence of tax. So, MM argument, last argument is market value of two firms, what you have to find it out. So, market value of firm according to whom? MM, according to MM, in the presence of tax. In the presence of tax, you have to consider. How you have to estimate market value of firm means, first you have to calculate market value of which one? Unlevered firm. What is that, ma? Unlevered firm means 100% equity. 100% equity firm, what do you say? Earning availability to equity shareholder divided by KE. Whereas market value of which one? Levered firm, you have to find it out means no need to calculate. What you do is similar to market value of unlevered firm plus market value of tax shield. What is that? Market value of unlevered firm plus market value of tax shield. Market value of tax shield is nothing but debt into tax rate. You will get a debt into tax rate. You will find market value of levered firm. So according to MM, only one topic is very, very important in MM theory, is nothing but market value of unlevered firm, earning availability equity shareholders divided by KE. Market value of levered firm. Levered firm means which moves? 100% debt and equity. So if you want to find it out, first you have to take what is it? Market value of unlevered firm and take what is it? Market value of tax shield on debt. In order to make you to this estimation of market value of firm, how do you calculate? According to MM, two similar approach. In the absence of tax, market value of levered firm equal to market value of unlevered firm, market value of equity divided by market value of unlevered firm, market value of equity equal to earning availability equity shares divided by KE. Whereas market value of levered firm, levered means which includes debt. In such a case, market value of equity plus market value of debt. Whereas in the presence of tax, market value of first you have to calculate which firm? Unlevered firm. Unlevered firm equal to market value of unlevered firm equal to market value of equity equal to earning availability equity shares divided by KE. How do you calculate levered firm means market value of levered firm equal to, with the tax means market value of unlevered firm plus market value of tax shield on debt.
Tax shield on debt means debt into tax rate. Debt into tax rate would be market value of levered firm. This is the most important point, students. Got the logic, ma? So whenever you want to calculate market value of levered firm, you should understand which company, which firms you are supposed to estimate. That would be the most important. In our CMA material, we will see that. Right, ma? So this problem, where it is, they gave CMAs. This is no, actually the marathon market value of firm, I computed, I took the problem. It missed, if you get it, this one, here it is. This is the problem. Here you see, there are two firms, P and Q, which are identical, except P does not use any debt and capital structure, while Q has how much? 8,09% debenture in its capital structure. Both the firms having earning before interest and tax of how much? 2,60,000. And the capitalization rate, KE, is how much? 10%. Assuming corporate tax rate is 30%. Calculate value of these firms according to MM. Just I showed this one. This is the MM theory. According to MM, step number 1, what we have to do? First, we have to calculate market value of unlevered firm. Market value of unlevered firm between these two, which is unlevered firm, which one this is? P does not use any debt, means what you have to calculate? Market value of P is unlevered firm. Now you see, given P is unlevered firm, Q is levered firm, debenture is there, how much? 8 lakhs into at 9% mean 9%. EBIT, which is a given, how much? 2,60,000. KE is 10%. You see, estimation of market value of firm according to MM in the presence of tax. Market value of unlevered firm equal to market value of P, that is earning availability equity shareholders divided by KE. 2,60,000 EBIT. Yes or no? Minus interest is 0. Why? Because that is 100% equity into 1 minus tax. Minus preference dividend is not there. So 2,60,000 minus 0 into 1 minus 0.30 divided by 10%. How much? 18,20,000 is the market value of which one? Unlevered firm. Now for this market value of tax shield to be, if you add it, you will get what is it? Levered firm. Market value of levered firm equal to market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Market value of tax shield on debt formula is debt into tax rate. So this is the one of the most important and repeated model they used to ask with respect to capital structure. Okay, now we will come to our topic again. So now tell me, according to Modigliani Miller, what is that? What to calculate? Market value of firm according to MM tax. First, what you do? Market value of levered firm, 100% equity. In such a case, earning availability equity shareholders divided by KE. Market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Sir, market value of tax shield on debt, it would be market value of tax shield equal to debt into tax rate. So only this is an important point. What is the arbitrage mechanism? Arbitrage mechanism means buying a security at low price and selling at a high price. Once you start to buy at low price, means you are selling one security at high price, means because of selling this value decreases, because of buying this value increases. At one point of view, both will reach us equal. Are you getting? So this is the most important point. And here one more point is there, repeated in examination point of view. If the examiner wants to design any question paper, he is considering all these factors. Number 1, PE ratio. Morning class we discussed. PE ratio, it is the ratio which shows the relationship between market price and equity. Debt equity ratio. Debt equity ratio, it is a ratio shows the relationship between debt percentage in total capital employed. So debt equity ratio formula is debt divided by total capital employed. Return on capital employed equal to EBIT divided by capital employed. Whereas risk element of equity shareholders. See, when debt increases, risk increases, automatically KE what happen? Increases. We learned this concept from which concept? Net operating income theory. Because of rising a debt, what increases? KE increases. Because of KE increases, set off effect takes place, with effect KO decreases. and debenture holders risk element means hardly KD increases. Then finding return on old capital employed. When there is a company is there, if the new company means a company raises newly funds, how much return the company able to generate from the newly raised funds if not given in the problem, then you have to follow that. How much return the company able to generate from the old funds, same rate would be applicable for new funds also. Previously company return on capital employed is 20%. Hello, if the company raising additionally 15%, 15 crores, previously company rising funds and doing business, it generating 15%. 15% is ROI. ROI means return on investment or return on capital employed. Now company raises additional funds, but it could not revealing any information with respect to how much return it is generating. Then come to conclusion, old return seems to be, what is it? New rate of return for new company, new capital also. If there is no any specific information is given, in such a case take as a common. Otherwise, whatever the rate he gives, you have to follow. Then tax shield on debt. Just now I told you last one. Tax shield on debt formula. Debt into tax rate. Okay. This is the, and why debt is cheaper than equity? Because of three reasons. One is low cost. Very good, man. And another one is low flotation cost. Because generally debenture holders expects a low cost. He charges low coupon rate. Because company assures that irrespective of my earning, I will give you, what is it? Interest. నా చావు నేను చేస్తాను, నీకు మాత్రం ఇంట్రెస్ట్ పే చేస్తాను అంటాడు కదా. అప్పుడు డిబెంచర్ హోల్డర్స్ రిస్క్ ఫీల్ అవుతాడా? ఏం ఫీల్ కాడు. అయితే పర్వాలేదు సార్ 20 వద్దులే 5 అన్నా ఇవ్వండి అంటాడు. అంటే సిన్స్ దేర్ ఈజ్ నో రిస్క్ టు డిబెంచర్ హోల్డర్స్, జనరలీ డిబెంచర్ హోల్డర్స్ చార్జెస్ low cost. Point number 1. Number 2, if you want to raise equity, you have to spend much flotation cost. Hello, whereas equity ki debenture ki anta flotation cost incur cheyalsina avasaramu ledu. Next, and tax advantage. And finally, over capitalization, under capitalization. If you don't know capital structure clearly, you may raise funds more than required, that is called over capitalization. And if you raise more than less, right, then it would be less than required, then it is called under capitalization. Okay. Finally, in a summary, what is the capital structure? Here it is. Capital structure is the mix of what funds? Capital structure is the mix of long-term funds. In order, ultimate objective of this capital structure is to determine optimum capital structure. In order to determine optimum capital structure, you have to make 4 analysis, 4 approaches. 4 analysis: EBIT, EPS analysis, indifference point analysis, financial break-even point analysis, EBIT, market price analysis. 4 approach: net income, net operating, traditional approach. What as per net op EBIT, EPS analysis? Take EBIT, calculate EPS, highest EPS capital structure is optimum. Market price analysis: take EBIT, calculate market price, condition applies, EPS into PE ratio is the market price. Highest market price plan is optimum. Financial break-even point. It is financial break-even point. It is a level of EBIT at which EPS is 0. Indifference level of point. It is a level of EBIT at which EPS remain same between two financial plan. Coming to net income theory, all the theories. So theory is a statement of fact based on certain assumption and conditions. These theories are universally proved, but you have to follow assumptions. David Durant net income theory says that debt is best. If you raise debt, you can reduce KO, you can increase market value. Whenever you want to raise the funds, go with the debt because debt is cheapest, thus it is the best. David Durant second theory says that because of debt is cheapest, okay, but if you raise a debt, it will create risk to equity shareholders. The advantage of equity will set off with the risk element of equity shareholders with effect KO remain constant, market value of firm will remain constant. Debt is not best, debt is not best, debt is just. David Israel Solomon argument is debt is best up to certain level, thereafter it will become costliest, riskiest, finally turn worst, don't take the more debt. But Modigliani Miller theory practically proved which theory? Net operating income theory. It explained the behavior of an investor when the market value of the shares are not same. So he will undertake arbitrage. Because of this arbitrage, he will set, what is it? Both the firms in a equilibrium condition. Okay. Market value of levered firm formula. Market value of unlevered firm plus market value of tax shield on debt. So this is the capital structure. Thereafter, we have a small, we will take a working capital also, no problem. Thereafter, you have one more introduction, finish, time value, capital budgeting, cost of capital, capital structure. HOTC chapter hai. Which one? Leverage. Just it but before going to that, leverage. Leverage is, what is it? See, explain the meaning of term leverage. Leverage is nothing but risk associated with the company is called leverage. Here, the leverage indicates in the finance concept, right? Leverage represents leverage. What is it? Risk associated with the company. Having, what is that? Fixed financial commitment. Fixed financial commitments. Whenever fixed financial commitments are there, whereas this, because of this fixed financial commitments, how much risk can be associated with the company can be understood with what analysis? Leverage analysis. Are you getting? Leverage. Whereas second bit, what are the various types of risk faced by the company? See, dear students, any company have two types of risks. Any company. This is the, let us take this company. One is, what is that? Business risk. What is that? Business risk. Business risk arises because of fixed cost. When a business undertakes its business operation, it incurs, what is that? In the regular business operation, it spends much and more fixed cost, right? Salary, rent, bonus, commission, electricity, all these things in the operation of any company. This is the company, right? Because of this running this company, in business operation of this company, if company incurs more fixed cost, the risk associated with the company is called what risk? Operating risk. This is also called what risk? Operating risk. It is also called, what is it? Business risk. But at the same time, when company takes the financing decision, what decision? Financing decision. Because of financing decision, if company rises, what is it? Condition applies, debt. Because of that debt, company has to pay interest irrespective of his earnings. In such a case, whatever the risk is called, such a risk is called financial risk. Okay? Financial risk. How many risks associated with the company? 2. Array, 3 kadra. 2. What are they? Business risk, financial risk. What is another name of business risk? Operating risk. Operating risk arises because of fixed cost. Financial risk arises because of debt. Okay? Then another important point is right. Here, what are the different types of leverages? How many types of leverages? I think it's a common. What is that? Operating leverage. Operating leverage. And another one is financial leverage. And another one is combined leverage. Combined leverage, right? Coming to here, operating leverage. What is operating leverage? Operating leverage, risk associated with the company having what cost? Fixed cost. So if the another bit, fixed cost is high, operating leverage is high. Hello? No fixed cost, then no what? Operating leverage. Yes or no? Low fixed cost, then what is it? Low operating leverage. Are you getting? This is the point you should understand very clearly. Fixed cost, because of fixed cost, operating leverage will be related. No. Low. High means high operating leverage. So it speaks that because of fluctuation in sales, because of any small change in sales, how much operating profit will be influenced can be learned with what is that? Operating leverage. So it shows the relationship between what is that? Number 1, sales. Number 2, EBIT. What is that? EBIT. So operating leverage can be calculated like this. Operating leverage equal to, what is the formula? Contribution divided by EBIT. Contribution divided by EBIT. If one income statement is given, what is that? single income statement is given, then you can follow this one. Whereas two income statements are given, in such a case, operating leverage equal to percentage of change in EBIT divided by percentage of change in sales. So this indicates operating leverage. It always projects in, what is that, times. See, it not represent present situation. What it explains, by chance this much of sales changes, the impact would be like this leverage projects. Are you getting ma? Okay, operating leverage. Thereafter, operating leverage is a projects. In the operating leverage, you have to understand what is the final observation of operating leverage. When interest of the company is high, means what leverage is more? Financial leverage is more. In such a case, fixed cost maximum you have to reduce. If the interest is very, very low, in such a case, you can increase operating leverage. But having a more fixed cost is not a phenomena to the company. Are you getting? This is the operating leverage. Operating leverage indirectly shows the relationship between, this is the sales, and from the sales, if you deduct variable cost, you will get the contribution. From the contribution, if you deduct, what is it? Fixed cost, you will get, what is that? EBIT. If sales changes given percentage, what is the impact on change in EBIT because of what cost? Fixed cost can be learned with what? OL, operating leverage. Okay, this shows because of change in sales, how much impact on change in, what is it? EBIT because of fixed cost can be learned with operating leverage. Right, ma? This is the point. Then we will move to financial leverage. It happens because of financial decision of the company. Financial decision. Okay. So that only if rises what? Debt. Only if it rises debt. It is avoidable risk. Why? Avoidable risk. Why it is avoidable risk? Because if company moves without 100% equity, this can be eliminated. So this leverage shows relationship between, it shows the relationship between in between A, EBIT, and B, what is that? EPS, or you can say shareholder income. Shareholder income. This is the financial leverage. So financial leverage formula A, how do you calculate? Financial leverage equal to EBIT divided by EBT. If one income statement is given, if two income statements are given, financial leverage equal to percentage of change in EPS divided by percentage of change in EBIT, right? If it is a two income statements are given. So this shows what is that? If EBIT changes, what is the impact of whom? EPS can be learned with what? Percentage of change in EBIT. How much impact it will give on what? EPS because of what is that? Interest. Of course, if preference is there, you can also take preference dividend. Is called what leverage? Financial leverage. Is it avoidable or not? Avoidable. Then galoch miru 100% equity galoch. So this would be the financial leverage. And finally, if you think about what is that? Combined leverage. Combined leverage also called what leverage? Total leverage. What is that? Total leverage. So it considers what is that? Operating leverage and what is that? Financial leverage. So operating leverage, it shows the relationship between in between two things. What are they? Sales and what is it? EPS. So operating leverage combined leverage can be calculated. Combined leverage equal to already operating leverage into financial leverage you can calculate. Whereas contribution divided by EBT, you can take contribution divided by EBT. This is the one version. Second version you can calculate combined leverage equal to percentage of change in EPS divided by percentage of change in sales. Okay, always projects in times. Okay, ma? Right. And finally, what it shows, if sales changes because of sales, how much impact is there? What? EPS because of what cost? Fixed cost, because of interest, and because of what is it? Preference dividend. So if 1% percentage changes sales, how much percentage change would be on EPS can be learned with what is that? Combined leverage. Okay, these are the concepts of combined leverage. Whereas basing on this, we are going to solve one problem. It's a very simple problems which are given in our material. How do you find it out? What is that? Income statement from the concerned company. Leverages can be estimated with a different identity. Highest leverage, this would be, ma'am, here there is a madam, estimation of leverages. మీరు భవిష్యత్తులో ఈ స్థాయిలో అలా అడ్రస్తో అలా ఇంగ్లీష్లో కార్పొరేట్ కంపెనీలో చెప్పాలి, ఐబిఆర్డి ఇంటర్నేషనల్ బ్యాంక్ ఆఫ్ రీకన్స్ట్రక్షన్లో వర్క్ చేయాలని ఐ విష్ నా స్టూడెంట్స్ పర్టికులర్గా. ఓకే, రైట్. ఇప్పుడు చూద్దాం, ఈ ప్రాబ్లం సాల్వ్ చేశారనుకో. సి how many times they ask this problem is a repeated model, man. Several times cainter, CMA, IPCC, all these things. Sales are given how much? 24 lakhs. Variable cost is 50%. Fixed cost is 10 lakhs. Company has 10 lakh, 10% of what is it? Borrowing means debt. And share capital is 10 lakhs. Okay. Now calculate operating leverage, financial leverage, combined leverage, return on investment. If sales increases by 6 lakhs, what will be the new EBIT? It is a common question. Now you tell me what we do. Sales, right? 24 lakhs. From this 24 lakhs, what we have done? Variable cost is 12 lakhs. Contribution is 12 lakhs. Fixed cost is 10 lakh. EBIT 2 lakhs. Less interest we deducted 1 lakh. We got what is it? EBIT. Now can you say operating leverage? This is not yours, right? Operating leverage equal to, what is the formula, Maji? Contribution divided by EBIT. Contribution is how much? Just now we calculated. 12 lakhs divided by 2 lakhs. So how much it is? 6. 6 times means what? At any cost, 1% change in sales leads to 6% change in EBIT. What about here it is? Here, financial leverage again, here we estimated. 1 minute, here it is not statement to us. Financial leverage equal to EBIT divided by EBT. 2 lakhs divided by 1 lakh, that is nothing but 2 times. What is the observation? At any cost, 1% change in EBIT leads to 2% change in shareholders income. That is nothing but what? EPS. What about another one is finally combined leverage. Combined leverage equal to operating leverage into financial leverage. Operating leverage, combined leverage equal to operating leverage into financial leverage. So 6 into 2, how many? 12 times. What is observation? At any cost, 1% change in sales leads to 12% change in EPS because of what is it? Fixed cost and interest. So return on investment formula, EBIT divided by capital employed. So even if the sales increases by given percentage, so how much it could be there, we can easily estimate. If the sales increases, then what would be the new EBIT? Means presently sales are how much? 24 lakhs. If it increases 25% means 24 into 125%, how much? 30 lakhs. From variable cost also increases same way, right? So here 12 lakhs. Here 12 lakhs into 125%. Is it 15 lakhs, ma? Yeah, if you deduct, you will get the contribution. Less, you will get it 12, 15. Less what you do? Fixed cost. Sir, fixed cost could increase అవ్వాలిగా. అలా ఇంక్రీజ్ మీరు చేస్తారనే వాడు వచ్చింది ఆ ప్రాబ్లం. అవునా? ఫిక్స్డ్ కాస్ట్ విల్ రిమైన్ సేమ్ 10 lakhs, 10 lakhs. Then you will get it, what is that? EBIT. So now you will get it, incremental EBIT would be how much? 3 lakhs. So this is the basic repeated model in this. Whatever the information I gave to you, that would be enough to handle all the problems. Because every problem, we have a time constraint, right? So this is the list I prepared. How many questions, how many hours are there means, even if I touch extra One problem practically, I may lose one chapter. Okay, this is the leverage. Clear now? But whereas I'm giving such a information so that if you have this information, you can understand. But I gone with all the lines of in your study material. I came to understand that there are certain points he frequently asking. Number one, asset turnover ratio. With the asset turnover ratio, you see, you have to calculate operating leverage. Operating leverage, how do you get? Contribution, how do you get? How do you get sales? That is the point. అక్కడ తొక్కాడు ఎక్కడ ఆపరేటింగ్ లెవరేజ్ నీకు వస్తుందో నాకు తెలుసు కానీ సేల్స్ ఎలా వస్తాయి అది చెప్పడం బాలసుబ్రహ్మణ్యం గారు అంటాడు. అప్పుడు సేల్స్ కోసం వీ హ్యావ్ టు క్యాలిక్యులేట్ వాట్ ఇస్ అట్ అసెట్ టర్న్ ఓవర్ రేషియో. వాట్ ఈస్ అసెట్ టర్న్ ఓవర్ రేషియో? టర్న్ ఓవర్ డివైడెడ్ బై టోటల్ అసెట్స్. టోటల్ అసెట్స్ ఇన్క్లూడ్స్ ఫిక్స్డ్ అసెట్. ఇది రాలేదా ఇప్పుడు నేను చెప్పిందంతా వేస్టే, ఎందుకంటే నీకు సేల్స్ రాదు, మొత్తం పోయింది. ఏం పోయినట్టు? ఆపరేటింగ్ లెవరేజ్ పోయింది, ఇంకా ఇంకేం లేదు, ఇంకంతే. రైట్, దిస్ ఇస్ ద టెక్నికలీ కాల్డ్ అవర్ బతుకు అసెట్ టర్న్ ఓవర్ రేషియో. సార్ బాలు సార్, ఇంకో అనదర్ వన్ మోర్ క్వశ్చన్ ఇన్ యువర్ మెటీరియల్ దే ఆస్క్డ్ us. See, actually here whatever the points I consider, right, I thought to explain 6 problems, but 6 problems means entire marathon only leverage, అంతే కదా, అయిపోద్ది. బట్ వాట్ ఐ థాట్ ఇట్, ఎలా చేద్దాం, బట్ అన్ని ప్రాబ్లమ్స్ చెప్పలేము అన్నప్పుడు ఓహో అసలు ఏ ప్రాబ్లంలో నేను ఇంట్రడక్షన్ నుంచి లివరేజ్ వరకు ఇచ్చి ఒక ప్రాబ్లం చెప్పిన తర్వాత కూడా ఇంకా ఏదైతే చెప్పాలనుకుంటున్నానో ఆ ప్రాబ్లం చెప్పకుండా అందులో ఉన్న పాయింట్ చెప్పాను అనుకో, ఆ ప్రాబ్లం చేసిన నాలెడ్జ్ వస్తుంది కదా. అందుకోసం ఐఎమ్ ఎక్స్ప్లెయినింగ్ 6 ప్రాబ్లమ్. 1 ప్రాబ్లమ్ ఈజ్ బేస్డ్ ఆన్ అసెట్ టర్నోవర్ రేషియో. యూ నెవర్ ప్రాబ్లమ్ వితౌట్ ద అండర్స్టాండింగ్ వాట్ ఇస్ ఇట్ assets. So asset turnover ratio equal to turnover divided by total asset. Total assets includes, yeah, another point he asked us calculate financial leverage. I know sir, tell me, EBIT divided by EBT sir, very good. Financial leverage favorable, unfavorable? Favorable, unfavorable? Favorable, unfavorability, it will come with the fair and lovely. What is the favorable, unfavorable? Sir, financial leverage favorable or unfavorable means the question is at what rate you are raising fund. Hello, debt 5%. What is your return on investment? 25%. Now tell me, you are raising debt funds at a 5%, but whereas your return on investment is 25%. Now tell me, debt is favorable, unfavorable? Favorable. Unfavorable. Now tell me, unfavorable, debt is 25%, return is 5%. That is unfavorable. Okay sir. Okay sir means interest is 5%, return on investment also 5%, right? Return on asset, actually return on asset is nothing but EBIT divided by total assets. Return on asset, return on capital employed, return on investment, all will comes in the same zone. Okay. Margin of safety. Margin of safety means from the given sales, after deducting break even sales, whatever the sales left to you is called what is it? Margin of safety. Break even sales depends upon fixed cost. More fixed cost leads to more margin of safety. More fixed cost leads to more break even point. Yes or no? More break even point leads to less margin of safety. If you want to get it more margin, what do? You have to recover your break even yearly. For that purpose, what to do? You have to reduce fixed cost. Right ma. Next, briefly explain ట్రేడింగ్ ఆన్ ఈక్విటీ. వాట్ ఈస్ దిస్ ట్రేడింగ్ ఆన్ ఈక్విటీ? అరే ఇంకో 10 రోజుల్లో ఎగ్జామ్ రాస్తారు, అసలు ఇవన్నీ నేను చెప్పకపోతే మీ బతికేమైపోవాలి. ట్రేడింగ్ ఆన్ ఈక్విటీ. ట్రేడింగ్ ఆన్ ఈక్విటీ మీన్స్ ద అడ్వాంటేజ్ ఎంజాయ్డ్ బై ద ఈక్విటీ షేర్ హోల్డర్స్ బికాస్ ఆఫ్ డెప్ట్. ఫర్ ఎగ్జాంపుల్, ట్రేడింగ్ ఆన్ ఈక్విటీ మీన్స్ యూ ఆర్ రైజింగ్ ఫండ్స్ ఎట్ అ లీస్ట్ కాస్ట్, బట్ వాట్ ఎవర్ ద ప్రాఫిట్ యూ జనరేట్ ఫ్రమ్ దట్, వాట్ హ్యాపెన్, యూ విల్ పే ద కాస్ట్ టు whom? For example, I am an equity shareholder, so I am raising the funds at a 5% and investing at 25%. From the 25, I will give you how much? 5 to equity shareholders, right? Whatever the return left to you, that return comes to whose pocket? Equity shareholders' profit. This is called, what is that? Trading on equity means getting debt, using business, getting debt and doing business, making profit and making settlement to debenture holders and making wealth to whom? Equity shareholders comes under the category of what? Trading on equity, right? Why financial leverage is known as what is a double-edged sword? In first point they asked favorable or not. Yes or no? Last point is double-edged sword. Double-edged sword means very, very dangerous sword. For example, sword, I have a knife, right? If I kill the enemy and he died and I killed, that person died, right? And I want to show my victory to the entire people, and I shouted gloriously and I said, I killed that man. If I hold that sword in my shoulder, what happens? అది పక్కనే కాదు, ఎవరిని లేపేస్తుంది? నిన్ను కూడా లేపేస్తుంది. డబుల్ ఎడ్జెడ్ స్వార్డ్. సో వన్స్ యూ రైజ్ ద డెప్ట్, interest is favorable to you as long as if you are able to generate return more than interest to be paid. By chance, if you are not able to earn more than interest to be paid, means it will consume your life. Coffee Day CEO case study is the best example. Many people, crores of people gave the money because believe that he can repay. But he also thought that I can repay. He raised the funds, but at one point of time, he unable to pay. So this is nothing but I am explained 6 problems, total 7 problems. One problem practically with the numerically explained. Remaining problem, I decoded most important point. I projected this one. Got it? Trading on equity. Advantage enjoyed by who? Equity shareholders because of debt fund. Double-edged sword means be careful with the debt, sir, because you have to pay interest. Is it favorable one point of view time? Risk is another point of time. Asset turnover ratio formula. Turnover divided by return on asset formula. P ratio formula. P ratio formula. Market price divided by debt is cheaper. Sir, but debt is cheaper annar ga sir. Debt risk ga sir. అవును సార్, డెప్ట్ చీపర్గా సార్. ఆ రిస్క్ లేదా సార్? సార్ డెప్ట్ చీప్కి రిస్క్కి అసలు సంబంధం లేని క్వశ్చన్ అడుగుతున్నా మీరు. డెప్ట్ చీపెస్టే కానీ రిస్కియెస్ట్. హలో, ఈక్విటీ కాస్ట్లీయెస్ట్ బట్ నో రిస్క్. దట్ యూ హ్యావ్ టు అండర్స్టాండ్. డెప్ట్ ఈస్ చీపర్ దాన్ ఈక్విటీ. డూ యూ హ్యావ్ రీజన్స్? హౌ మెనీ? 3. Low coupon rate, low flotation cost, and a tax advantage. Right. This is with respect to, what is that, Maji? Financial leverage. And we have now our break time is when? 5. Now tell me, if I take working capital, it will goes out. Meanwhile, I will complete dividend. After break, we will take exclusive. What, Maji? Those people who came for working capital, you have to work. No alternative. నేను భూమి పుట్టినప్పుడు పుట్టా, సంతూర్ సోప్ వాడుతున్నా, అందువల్ల ఫేస్ తెలియట్లే. రైట్. అనదర్ సింపుల్ చాప్టర్ ఈజ్ నథింగ్ బట్, వాట్ ఇస్ దట్? Dividend decision. Very important chapter, but comparing to CA Inter, you have a lot of concepts in this, right? What is a dividend? So dividend is nothing but profit belongs to whom? Equity shareholders. So dividend is distributable profit to, simple logic. What is that? Distributable profit belongs to whom? Equity shareholders. Equity shareholders. So this is a distributable, that is a profit belongs to equity shareholders, is nothing but, what is that? Dividend. Or some books, it is a part of, what is that? Part of profit of whom? Whose profit? Equity shareholders profit, but to be, what is that? Distributed. So this is the dividend. And another one is a dividend policy. It's a way of work. It's my policy. What is that? It's my way of work. Dividend policy is nothing but, it is a procedure or work pattern. It is a procedure with respect to work pattern with respect to dividend. What is their policy with respect to, what is it? Dividend means, dividend policy, do they retain the profit, or do they distribute the profit? Hello? Distribute. So what their policy? That is the most important point. Here, what is the dividend policy means? పాలసీ మీన్స్ వాట్ మాజీ? ఇట్స్ ఎ ప్రొసీజర్. మా పాలసీ అండి, మా పాలసీలో లేదంటే ఏంటి మీ పాలసీ? ఏంటి నీ పాలసీ? తొక్కలో పాలసీ అంటే అదో పాలసీ అంతే. అది పాలసీ అండి అది. మా పాలసీ లేదు సార్. వాట్ ఈస్ ద పాలసీ? అది దట్ ఈస్ నథింగ్ బట్ వర్క్ ప్యాటర్న్. సో డివిడెండ్ ఇండికేట్స్ దిస్ is nothing but retain the profit and distribute. This indicates dividend policy. Whereas next one is, what are the various types of dividend models? Dividend models means whether it is good to pay dividend or not to pay dividend. Finally, whatever the policy, whatever the here you see, whatever the policy you should implement, so wealth of the company should be maximized. What is that, ma? Wealth of the company must be maximized. So this is the ultimately all the companies they used to concentrate this. Wealth of the company should be maximized. Next, explain various types of dividend models. Dividend models being classified into two types. One is relevant models and irrelevant models. Irrelevant models. See, already just now we discussed what is the each model ultimate objective. Just now I discussed what is that, ma? Wealth of the company should be what happen? Maximized. This is my ultimate point. Wealth of the company should be maximized with what decision? With the dividend policy. With the dividend policy, wealth should be maximized. So for this purpose you have a question. What the question is? Should we retain or what is that? Distribute. Retain or distribute I have to do. For this purpose I have to implement various types of dividend policies. But the dividend model arguments that this model speaks, there are two types of models. What is that? Relevant, another one is irrelevant model. Relevant model arguments that market value of firm cannot be influenced with what? Dividend decision. Relevant model argues that yes, it is a possible. Effective dividend decision can increase, what is that? Market value or wealth of the investor can be maximized. Irrelevant model says that no chance. Okay, relevant model argues that dividend decision can certainly influence what? Market value or wealth of the company. These are what are they? Walter model, Gordon model and Linter model and Graham Dodd model. What are them? Walter, Gordon, Linter, Graham Dodd. Whereas here MM model, Modigliani, Miller, and another one is residual model. So these are the models to be considered, ma. So one is, what is that? Walter, Gordon, Linter, Graham Dodd. Here MM model and residual model. And first Gordon model. What is the Gordon model argument is? మా ఫాలోయింగ్ కదా. ఇప్పటిదాకా ఏమేమి నేర్చుకున్నా? డివిడెండ్ అంటే ఏంటి? దిస్ ఇస్ ద డిస్ట్రిబ్యూటబుల్ ప్రాఫిట్. దిస్ చాప్టర్ ఆరిజిన్ టేక్స్ ప్లేస్ వెన్ కంపెనీ ఏబుల్స్ టు టేక్ two decisions effectively. Which one? Financing decision, investment decision, right? If the company able to finance the funds and invest, if it able to generate maximum return, then in such a situation it can generate, what is it? Dividend decision. Are you getting? Now dividend decision లో మనం ఇప్పటిదాకా ఏం డిస్కస్ చేసుకున్నాం? You discussed what is that? Dividend policy and dividend models. Yes, dividend models. Here first model, what is it? Gordon model. Gordon model argument is here. Gordon is what model? Relevant or irrelevant? Relevant model. So relevant model argument is, Mr. Gordon model is, if the company able to generate, what is it? EPS. Okay. From that EPS, if the company wants to retain, the question arises, retain or what is it? Distribute. So what the Modigliani means, Walter argument is, if the company, let us take retains, company has to reinvest. Hello? Reinvest. If the company, who will reinvest? If the company retains means who will get a chance to reinvest? అరే ఈపీఎస్ వచ్చింది, ఈపీఎస్ని కంపెనీ ఏం చేయాలని డిసైడ్ అయింది, రీటైన్ చేయాలనుకో. ఇప్పుడు రీటైన్ చేస్తే ఫండ్స్ మొత్తం ఎవరి దగ్గర ఉంటాయి? కంపెనీ దగ్గర ఉంటాయి. ఈసారి ఇన్వెస్ట్మెంట్ ఎవరు చేస్తారు? కంపెనీ చేస్తుంది. అంటే రీటైన్ చేసిన ఫండ్ని మొత్తాన్ని ఎవరి దగ్గర ఈ ఫండ్స్ ఉంటాయి అంటే, ఇఫ్ ద కంపెనీ, యూ ట్రై టు అండర్స్టాండ్, ఈపీఎస్ ఇస్ దేర్. కంపెనీకి ఉన్న క్వశ్చన్ ఏంటి? రీటైన్ చేయాలా, డిస్ట్రిబ్యూట్ చేయాలా? ఇదే కదా సమస్య. సో దిస్ ఇస్ ద ప్రాబ్లమ్ విత్ రెస్పెక్ట్ టు వాట్ టు డూ విత్ రెస్పెక్ట్ టు దిస్ అమౌంట్ ఈజ్ ద ప్రాబ్లమ్ ఆఫ్ హూమ్? దిస్ ఇస్ ఈజ్ ద ఈక్విటీ షేర్ హోల్డర్స్. వీడిదే సమస్య ఇది. సో దట్ ఈస్ ద రీజన్ దిస్ మ్యాన్ ఈజ్ క్రయింగ్. ఏం చేయాలి సార్ అని ఏడుస్తున్నాడు తలుపు వేసుకొని. ఇప్పుడు ఏడుస్తున్నాడు కదా. ఇప్పుడు వీడికి ఆర్గ్యుమెంట్ ఎవరిచ్చారు? మిస్టర్ వాల్టర్ గేవ్ వండర్ఫుల్ ఐడెంటిటీ. హీ గేవ్ దట్ హీ ఈజ్ అ మిస్టర్ వాల్టర్. గార్డెన్ కదా, హీ ఈజ్ గార్డెన్. Okay, who is he? Gordon. This Gordon argument is, Gordon explains that he is asking a question. What man you want to distribute? Yes sir. Sir, I don't know sir whether retain or what is it? Distribute. Okay, man, if you retain, who will invest? Company invest. If you invest means, will you invest in current assets or fixed asset? Fixed asset. If you invest a fixed asset, you will generate a return. Yes or no? That return is called IRR or ARR? IRR. ARR. ARR ఎందుకు సార్? ARR will ignores what is that? Time value of money. IRR is always best, right? So that is called, then you will generate IRR, right man? What is your IRR? 20%. Very good. IRR 20%. This IRR also called, what is it? Rate of return. Hello ma? Rate of return. And technically it is also called R. What is it? R. What is this R? R is happens which side? ఎవరి సైడ్లో ఆర్ కనిపిస్తుంది? ఇన్వెస్టర్ సైడ్లోనా, కంపెనీ సైడ్లోనా? ఇప్పుడు చెప్పండి, వే చెప్పండి. ఇఫ్ కంపెనీ రీటైన్స్ ద ప్రాఫిట్, దెన్ ఆటోమేటిక్లీ రీఇన్వెస్ట్ హూ? ఏ అసెట్? ఫిక్స్డ్ అసెట్. ఫిక్స్డ్ అసెట్ మీద ఇన్వెస్ట్మెంట్ చేస్తే వచ్చేది ఏంటి? ఐఆర్ఆర్. ఐఆర్ఆర్ హౌ మచ్? 20%, which is also called rate of return. Finally it is also denoted as R. R is how much? తెలీదు. Let us take R is how much? It is 20% అనుకుందాం. What is that? 20%. Now if company declares a dividend, in such a case who will invest? That is nothing but investor. Yes or no? Investor invest. Investor, if you makes invest, right? Investor invest. Investor invest these funds, right? Investor, if he invest in that fund, he will also generate return, right? This return is called, what is that? Investor expected rate of return. This is also called investor expected rate of return. This investor expected rate of return also called what is that? KE. What is that? KE. KE, investor expected rate of return. Hello? Are you getting ma? This KE is suppose 10%. In such a case, you have a clarity. Dividend ఇవ్వాలా వద్దా? ఇప్పుడు చెప్పండి. అకార్డింగ్ టు గార్డెన్ మోడల్, ఇఫ్ company means nothing but financial manager. If company retains the funds and reinvests whatever the benefit company gets, it will take and it will go and celebrate, sir. This amount, whatever it makes earning today or tomorrow, again it has to give to whom? Equity shareholder. Or if I give dividend, who is going to invest? Means you invest for the sake of yourself. I invest for the sake of myself, yourself. But I would be the best comparing to you because my IRR is greater than your KE, my dear. So I will follow 0% dividend payout ratio. Then only to increase, what is that? Market value of value. Are you getting? So when, now tell me, which would be the right option? If R is greater than KE, then company has to follow 100% retaining ratio. Yes or no? Retaining ratio, or you can say 0%, what is it? Dividend payout ratio, Maimaji. Whereas if KR is less than KE, then what is it? 100% what ratio? dividend payout ratio, whereas 0% retaining ratio. Whereas if R equal to KE, then no effect. Do you agree? No effect. So this is the way Mr. Walter's argument. In order to make you prove when the market value is going to decrease or increase, he projected a formula. The formula is this. The formula is this. According to Gordon. Oh, this is the theory. Walter or Gordon we've been discussing. Actually, Walter theory, this would be. This is wrong completely. पेयर तो गया, ये क्यों आया रे इधर? फर्स्ट वाल्टर था ना. दिस इज ఆన్లైన్ బచ్చే చేంజ్ దిస్ వన్. ఫ్యూచర్లో వస్తారు కదా, ఇది వీడియోలో పెడతారుగా. ఎఫ్ఎం ఆ మాత్రం గెస్ట్ ఉండాలి కదమ్మా. ఎస్, వాల్టర్స్ మోడల్. ఓకే, దిస్ ఇస్ ద నౌ అకార్డింగ్ టు దిస్ market price equal to MP0 equal to formula would be D plus E minus D into R divided by KE whole divided by KE. This formula indicates that market value is nothing but what is that? Present value of future benefit discounted at investor expected rate of return. For example, if the company makes a EPS, okay? If company makes a EPS, so company makes a EPS means company will get what is it? Dividend. Dividend I will get in this point of time. Hello? But what happened? Remaining, this is the nothing but remaining balance is what? Retaining. This retaining amount I will invest where? Outside. On this retained amount reinvest, I will generate the return. But the return I cannot generate now. Hello? Are you getting? So this formula what it speaks? Dividend plus, from you see, dividend you are giving, plus E minus D, if you direct E minus, see D plus E minus D, what it indicates? E includes two things, retained earnings, dividend. So you gave a dividend to him, plus EPS is there, minus D, you made it. From earnings, if you deduct dividend means you will get what? Retained profit, yes or no? This retained amount, if you invest on R percentage, you will get the benefit. That benefit you have to bring into present to the time of what is that? Dividend to be distributed. This both should be brought into present. So this indicates the market value of firm according to whom? Walter. So Walter argument is D plus E minus D into R divided by KE whole divided by KE. Sir, KE 2 times enduku తీసుకున్నారు సార్? ఇదే జనరల్ గా అడిగే కామన్ క్వశ్చన్. ఫస్ట్ dividend when you are declaring, and after deducting declaration you have left certain profit. Belongs to whom? Equity shareholders. That amount again you are reinvesting. Yes or no? ఇక్కడ ఇదే పాయింట్ చూడండి. ఇప్పుడు ఒక షార్ట్ కట్ చెప్తాను. ఇదేంటి తెలుసా? చెయ్యరా? ఇది చూడు, వాల్టర్ థియరీ. మార్కెట్ వాల్యూ ఇస్ నథింగ్ బట్ ప్రెసెంట్ వాల్యూ ఆఫ్ ఫ్యూచర్ బెనిఫిట్స్ కదా. ఇదే పాయింట్. ఫస్ట్ నీకు డివిడెండ్ ఇమీడియట్గా వచ్చేస్తుందిగా, డివిడెండ్ని ప్రెసెంట్లోకి వస్తుంది. మరి ఇదేంటి? ఇది రిటైన్ ప్రాఫిట్. ఇది మొత్తం ఈపీఎస్ కదమ్మా. ఈపీఎస్లో డివిడెండ్ ఇచ్చావు. ఇదంతా ఏంటి? రీటైన్ అని. ఇప్పుడు క్వశ్చన్ ఏంటంటే ఎంత రీటైన్ చేసావు, రీటైన్ చేసిన దాన్ని ఏ రేట్ దగ్గర ఇన్వెస్ట్మెంట్ చేసావు, ఎంత వచ్చింది, మొత్తం ఇప్పుడు ఎంత వచ్చింది. ఆర్ యు గెటింగ్? ఇఫ్ ఇట్ ఇస్ సే ఇన్ ఇంగ్లీష్, సో యూ గేవ్ ఎ డివిడెండ్, రైట్? డివిడెండ్ ఐఎమ్ గోయింగ్ టు గెట్ ఇట్. వాట్ అబౌట్ దిస్ రిటైన్డ్ ఎర్నింగ్స్? హౌ మచ్ వుడ్ బి ద రిటైన్డ్ ఎర్నింగ్స్, అట్ వాట్ రేట్ యూ ఇన్వెస్టెడ్, వాట్ అమౌంట్ ఆఫ్ రిటర్న్ యూ జనరేటెడ్, వాట్ ఈస్ ద టోటల్ రిటర్న్ ఆన్ ద డే ఆఫ్ అట్ ద టైమ్ ఆఫ్ వాట్ ఇస్ ద డివిడెండ్ డిస్ట్రిబ్యూషన్. డివిడెండ్ ఎంత వచ్చింది, ఇది ప్రాఫిట్, రైట్? దిస్ ఇస్ ద టోటల్ ఈపీఎస్ అనుకోండి. ఇందులో డివిడెండ్ ఇచ్చేసాం వాడికి, ప్లస్ రిమైనింగ్ ఏముంటుంది? రిటైన్ ఎర్నింగ్. ఇందులో ఎంత రీటైన్ చేసావు, రీటైన్ చేసిన దాన్ని ఏ రేటు దగ్గర ఇన్వెస్ట్మెంట్ చేసావు, ఆ రేటు మీద రిటర్న్ ఎంత వచ్చింది, ఆ రిటర్న్ ఇప్పుడు ఎంత వచ్చింది, అప్పుడు మళ్ళీ మనకి రెండు వచ్చేస్తుంటాయి. ఈ మొత్తం కలిపితే మనకు వచ్చింది ఏంటి? ఈ మొత్తం ఏంటి? రీటైనింగ్ చేసిన అమౌంట్ని రీఇన్వెస్ట్మెంట్ చేయడం వల్ల వచ్చే బెనిఫిట్ మొత్తాన్ని ప్రజెంట్లో తీసుకొచ్చావు. ఇప్పుడు ఈ రెండింటిని ప్రజెంట్లో తీసుకురా. ఆర్ యు గెటింగ్? దిస్ ఇండికేట్స్ ద ఫార్ములా. So D plus E minus D into R divided by KE whole divided by KE. Now we have, so for the sake of time being, we are going to estimate this value. You see, this is not relevant for you. Now you see, this is the problem. How do you calculate, according to Walter, how do you calculate market price? Number of shares outstanding is how much? 1 lakh. EPS is DPS 2.4. Equity capitalization rate is 12%. Rate of return is 15%. Now, as per Walter model, what is the market value of share? You have to calculate market value of share. Now, can you take calculator and can you calculate with me? So, according to Walter, market price equal to, what is the formula of market price? D plus E minus D into R divided by KE whole divided by KE. Dividend is how much? 2.4. Yes or no? 2.4 plus EPS is how much? 4. From the 4, 2.4 you paid 1.6. Already R is how much? 15%. Divided by KE you can make it 15% divided by 12%. 15% divided by 12%. 0.15 divided by 0.12. Total market value ma? 30? Yes. Walter theory we were discussing, right? Here it is. The problem is the working capital. Next chapter, right? What is the Walter theory argument? We done it. Simply, what is the formula ma? Walter theory. So Walter theory, tell me. So market price equal to DPS means DPS or D, right? D plus E minus D into R divided by KE whole divided by KE. So this is the formula. Basing on this, in your CMA inter there is a problem. The following figures collected from XYZ Limited Company. Okay. Net profit after tax 30 lakhs. Outstanding preference share is 100 lakhs. Number of equity shares 3 lakhs. And return on investment is 20%. Return on investment is nothing but R. Cost of equity is nothing but KE. Now we have to calculate according to market price as per Walter. So now tell me, Walter formula equal to MP0 equal to D. D is there. If you want to find it out, D means what you have to do is, here net profit after tax is PAT how much? 30 lakhs. Out of 30 lakhs, preference dividend to be deducted, right? So 30 lakhs is the profit after tax minus 100 lakhs into 12% preference dividend. If you deduct it from PAT, if you deduct the preference dividend, you will get the earning availability to equity shareholders divided by 3 if you take it. That is 6 rupees. So what is that? EPS. Yes or no? EPS would be 6 rupees. In this problem, EPS equal to earning availability equity shareholders divided by number of equity shares. So 30 lakhs minus 100 lakhs into 12% divided by 3 lakhs. How much? 6 rupees is the EPS. And here the question is, return on investment is this. What should be the approximate market price to keep the share price at 42 rupees? Actually, in this problem, they could not ask the dividend payout ratio. To keep 42 rupees, what would be the dividend payout ratio? Dividend payout ratio formula is dividend divided by EPS into 100. EPS you have, but only missing is dividend you have, but market price you have. Hello? So according to Walter theory, estimation of dividend per share as basing on, what is that? Basing on given market price, that is how much it is? 42. According to Walter, what is the formula? Walter theory equal to D plus E minus D into R divided by KE whole divided by KE. So 42 equal to D plus 6 minus D into 0.20 divided by 0.16. Yes or no? Now if you make a cross multiplication, 6 into how much? 42 into 0.16, you will get it 0.72. D plus 7.5 minus 1.250. Finally, if you solve this equation, here 0.67, 0.25 D plus 7.5. D equal to how much? 3.2. Is it right, ma? So D equal to 3.2 means then immediately you can solve, what is this? EPS. Here dividend payout ratio equal to dividend divided by EPS into 100. 3.12 divided by 6 into 100. How much it is? 52%. So this is the way to which Walter theory. This problem covers two things. What is it? Dividend to payout ratio as well as market value of Walter. But actually in this problem, market value is given. Previous problem we discussed when power has gone. In that problem, only market price. So for finally, market value of firm, market value of equity according to Walter, D plus E minus D into R divided by KE whole divided by KE, right? Next one, what is that? Walter theory is finished. Now Gordon's model. What is the Gordon model also is a relevance theory or irrelevance theory? Yeah, here it is a relevant model. किधर गया रे ये Walter? This one, right? Yes. Here it is. What is it? Relevant model. Relevant model. According to Gordon model, what is the market price of the companies? Market price of the company. Walter theory is, what is the argument of Walter theory? Walter theory argument is, try to understand what is the Walter's argument is. When R is greater than KE, then by implementing R is 0% dividend payout ratio, company can increase its market price. Yes or no? When R is greater than KE, company retains, then automatically market value increases. But Gordon argument is, market value of equity shares will increase like this. You see, MP0 of the company, market price increases when investor expected rate of return decreases. That could be possible when you give, what is it, better growth rate. So growth rate equal to, what you will going to get it, what is it, growth rate equal to retaining ratio into rate of return on reinvestment, rate of return. So it indicates that suppose a company EPS is there. EPS is there, you have a two choices. You can, what you can do? Retain. Hello? If you retain, again, thereafter you have to reinvest. Hello? Then you have to submit, what is that, growth rate. When growth rate, if investor equity shareholders observes, automatically is expected rate of return is suppose 10%. But if you give 5% growth rate, automatically this time by seeing this growth rate, he can reduce how much? -5. Hello? His expected rate comes to how much? 5%. 5% is expected rate decreases. With effect, market value increases. So in this point, what you can say, market price equal to DPS1, hello, divided by, if investor KE or investor expected rate of return is, both are same. Suppose if 2 divided by investor expected rate 20%. In such a case, market price is how much? 2 divided by 20%. How much? 10. Now, if you gave 10% growth rate, in such a case, 2 divided by 20%, you gave a 10% growth rate means his expected rate, what happened? Decreases. In such a case, what happened? 20 rupees. Hello? If you gave 15 rupees of 15% of growth rate, 2 divided by 20% minus how much? 15%. In such a case, 40 rupees. If you gave 19%, in such a case, 20% minus 19, 200. Now from this observation, what you are observing, tell me. As growth rate, what happened? Increases. So investor expected rate net decreasing, right? 20 minus 10, 10. 20 minus 15, net 5. So 20 minus 19, net 1. As you are giving a growth rate, investor expected decreases, with effect to market price increases. So Walter argument is just retaining share, retaining the profit does not take, what is that, market price. You have to retain, and retained amount you have to reinvest, and then you have to submit, what is that, better growth rate. Already I used to take generally example. ఒక ఫాదర్ ఒక అమ్మాయిని ఒక 20 సంవత్సరాలు జాగ్రత్తగా చదివించి ఎంబీఏనో సిఏనో చేర్పించాడు, కానీ మ్యారేజ్ దగ్గర చిన్న ఇంబ్యాలెన్స్ తప్పాడు అనుకో, ఆ అమ్మాయి లైఫ్ అయిపోద్దిగా. కాబట్టి యు ఆర్ టేకింగ్ క్రోర్స్ ఆఫ్ డెసిషన్స్, దట్ ఇస్ నాట్ ద మ్యాటర్. వేర్ యు ఆర్ రీఇన్వెస్టింగ్ ఈజ్ ఆల్సో వెరీ వెరీ ఇంపార్టెంట్. నేను ఇన్ని డెసిషన్లు తీసుకున్నాను కంటే ఎవ్రీథింగ్ ఈజ్ గాన్ మ్యాన్. యూ మేడ్ ఇట్ సేల్స్, ఈపీఎస్, వేరియబుల్ కాస్ట్ అన్నీ చేసావు, బట్ రీటైన్ దగ్గర రాంగ్ చేసావు, మొత్తం పోయింది. దట్ లాజిక్ వుడ్ బి అప్లికబుల్ హియర్.
Mr. Walter argument is when R is greater than KE. When R is greater than KE, by following, what is it, 0% dividend payout ratio, company market value increases. This man says, no. When R is greater than KE, you have to retain. Thereafter, you have to reinvest. Hello? Thereafter, you have to submit a growth rate. That growth rate will reduces investor expected rate. Then market value, what happened? Increases. So this is the argument with respect to whose? Walter and Gordon. So Walter theory, relevant model. According to this theory, simply according to Gordon theory, market price could be calculated like this, right? Market price equal to, what is the final formula, ma? So here DPS1, so market price equal to DPS1 divided by KE minus, what is it, growth rate. KE can be called investor expected rate of return or what rate? Yield rate. Hello? Yield rate. So growth rate, how do you calculate? Retaining ratio into rate of return. Are you getting? Rate of return. This is the relevant model. Now we have one more point we can discuss here in this model. Here you see, this is, yeah, in this model you see the following information applied to total earnings is how much? 200 lakhs. Number of equity share is 20. So 2 lakhs, 200 lakhs divided by 20. EPS is how much? 10 rupees. Now dividend paid is how much? 1,50,000. P ratio. P ratio, price earning ratio is how much? 12.5. Price earning ratio is nothing but morning class we discussed, right? Price earning ratio equal to market price divided by EPS. Whereas KE equal to EPS divided by market price. Hello? In such a case, reciprocal of what rate? Reciprocal of P ratio 1 divided by P ratio equal to what is it? KE. Are you getting? So 1 divided by 12.5 into 100 equal to how much? 8% is what is that? KE. KE is how much? 8%. Are you getting, ma? That is the reason I took this problem. And thereafter total earnings, how much you made it? 2 lakhs. Number of equity shares, how much? 20,000 into 100 rupees. 200. 2 lakhs divided by 200 into 100. R is how much then? No, your earnings are 2 lakhs, right, ma? Your capital employed is how much? 20,000 into 100. Into 100 means how much percentage? 10%, right? So R is how much? 10%. Whereas your KE is how much? 8%. Now as per Walter theory, company what has to do? Company has to declare dividend. No. R is how much? 10%. KE is how much? Who is best? అవును ఎవరు బెస్ట్? కంపెనీ బెస్టా, ఇన్వెస్టర్ బెస్టా? కంపెనీ బెస్ట్. ఇన్వెస్టర్ ఎక్కడ బెస్ట్ మాజీ? వాడు ఎంతనే చేస్తున్నాడు? 8%. నువ్వు ఎంతనే చేస్తున్నావు? ఏది బెస్ట్? కంపెనీ. సో వాట్ యూ హ్యావ్ టు ఫాలో? రిటైనింగ్ ఫాలో. డివిడెండ్ టు పేఅవుట్ రేషియో షుడ్ బి 0. If you follow that one, market value will increase. But whereas Gordon argument is that if you retain, thereafter what you do? Reinvest. Then you have to submit a growth rate. That growth rate will influence investor expected rate. With effect, market value increases. Hello? Now you see, you try to understand, ascertain whether the company is following optimum dividend payout ratio. No. Why? Actually, in the problem, company is paid how much? 1,50,000. It means that observation is, what is the total earning? 2 lakh. On the 2 lakh, 1,50,000 they are paying dividend means. So 75%, 1,50,000 divided by 2 lakhs into 100. How much percentage? 75% dividend they are paying, right? Since R is greater than KE, they should not pay. Okay, the answer is they should not follow this one. The observation is this. EPS equal to 10 rupees. Dividend per share is 7.5. Whereas here it is dividend to payout ratio is how much? 75%. Now company is not following optimum dividend payout ratio because when R is greater than KE, then optimum dividend payout ratio is how much? 0. Whereas company currently following how much percentage? 75%. Okay, now find out what should be the PE ratio
at which the dividend policy will have no effect the value of the share. At what price value of the share will remain same? When R equal to KE. So find out what should be the PE ratio at which dividend policy will have no effect. So already R is how much now? 10%, right ma? R is 10% means PE ratio should be 10 times. Hello? When PE ratio is 10 times, then KE would be 10%. అంతే కదా? PE ratio, KE రెండు ఒకటే. PE ratio times లో చెప్పుద్ది. KE percentage లో ఉంటుంది. Reciprocal of KE is PE ratio. Reciprocal of PE ratio is nothing but KE. So what should be the market price? అంటే అది PE ratio 10 times ఉంటే what happen? There is no effect on what? Market price. And will you decision changes if PE ratio is 8 instead of how much? 12.5. 12.5 means 12.5 divided by, from the PE ratio, you take the KE. 12.5 indicates how much it is. Where? Here it is. 8%, right? Here, when PE ratio is 8, previously 12.5, right? If you take 8, then KE of the company would be 1 divided by KE, 1 divided by 8 into 12.5%. When R is greater than KE, in order to increase the market price, company has to follow, what is it? 100% dividend payout ratio. So this would be the another problem. Walter theory and Gordon theory argument. Got it? Finally, what is the Walter theory? What is Gordon theory? This is the Gordon theory. Walter theory also we discussed previous class. We could not save it, I think so. Power has gone, it's gone. Right, ma. Simply, what is Walter theory, Gordon theory, maji? So Walter theory argument is what? Very simple. Walter argues that when R is greater than KE, by retaining 100%, company share value what happen? Increases. Gordon theory, if you retain, share value won't increase. Thereafter, you have to retain and you have to reinvest and you have to submit growth rate. One more problem, we will check it from Gordon model. Here it is. Here we will take both the models, right? This is the problem you see. The following information given, QB limited, earning per share is how much? 12. Cost of capital is 18%. Internal rate of return. Internal rate of return is R, 12%. Retention ratio is 40%. Calculate market price as per what is it? Walter model, Gordon model. Right? As per Walter model formula. D plus E minus D into R divided by KE whole divided by KE. In such a case, Walter model formula, market price, here it is, where it is? Here it is. Estimation of market price as per Walter. D 7.5, EPS 12, KE 18, R 12%. Market price equal to D plus E minus D, R divided by KE whole divided by KE. That means 7.2 plus 12 minus 7.2, 22 divided by 0.18 divided by 0.18. That is how much it is? 72.58. What about Walter? Gordon. Gordon equal to DPS1 divided by KE minus growth rate. So market price 7.1 divided by KE 18%. Growth rate, how do you got it? Growth rate equal to retaining ratio into rate of return on reinvestment. So retaining ratio is a 40% into 0.22 into 100 is nothing but 8.8%. So market price equal to 78.22. Got it, ma? This is the Walter and Gordon. Then the most important point, here, see, this is the model. Another one is Graham-Dodd model. See, Graham-Dodd model, his argument is that which would be the least risk one? See, if a company has a two choices to pay dividend, here it is. What is the time now, ma? See, Graham-Dodd, here it is. Graham-Dodd model argument is M into multiplier of D plus E divided by 3. It means that if the company has a two choices, what is that? Either company has to declare a dividend or a retaining. Let us take. These are the 2 points, right? Dividend to retaining. If now tell me, if the market value of the share to be increased means investor has to buy. Do you agree? Investor, when we will buy, when he feels very, very happy to buy the share. Now the question is, Graham Dodd argument is, if company wants to say whether R is greater or less or secondary issue. But the only point is, if the company says, I am going to retain your funds or I am going to pay dividend. So if it is a situation, if you take the investor, ultimate intention is, investor always gives much preference to those companies which pay dividend. Graham Dodd practically identified, he made a social experiment with what? Various equity shareholders. Finally, he developed a formula. For example, the formula you decode like this. D plus E minus D, right? Then D into 3. How much you will get it? 3D. 3D plus E divided by 3 is a common. You take it here. 3D plus EPS can be written like this, right? D plus E. Hello? Kya Maji? Can I write like this? EPS can be dividend plus retained earnings. Hello? Dividend plus here retained earnings equal to, can I write EPS? So already if I multiply 3, you got the 3D, right? So 3D plus D plus R. In such a case, if you make a simplification, equation would be like this. 3D plus 1R. 4D plus 1R. It means that 4 times or 1 person. If you observe it, 5 members, if the Graham Dodd asked, out of that 4 people gave a priority to what? Those company which pays a dividend, and 1 person will give what? Retained earnings. Here M indicates multiplier. Multiplier means all the people will show the same reaction, but intention may varies from person to person. So according to Graham Dodd model, it is also relevant model. This model conveys that equity shareholders are not interested to take risk. If the company declares that I am going to retain, automatically the risk level what happen? Increases. Hello? That is the reason they will give much priority to those companies which pays dividends. So that is the argument of which one ma? Graham Dodd model. Graham Dodd model final logic is nothing but 4D plus 1R. And thereafter Modigliani model. Modigliani Miller argument is that is a relevant model or irrelevant model? Means it is a irrelevant model. Modigliani Miller argument is that if the company declare or not to declare a dividend, the market value of firm will remain same. It does not make any effect. Why, sir? Once company declares a dividend, automatically his wealth goes from the balance sheet to outside. Do you agree? With effect to wealth of the company what happened? Decreases. Means market price of the share decreases. But the company has to undertake an investment decision. Walter Modigliani Miller argument is that it is based on certain assumption. Assumption number 1 is company has fixed investment policy. What is that? Every year company has to undertake a fixed investment policy. If the company declares a dividend, in order to make investment, it has to raise funds from outside. Once whatever the profit it has, if it declares, automatically market value of equity what happen? Decreases. In order to undertake investment, if it wants to raise the funds, it has to raise more number of equity shares. Once the shares increases, with that increased shares, if you raise the funds, and with that if you make investment, in asset side investment increases, in liability side number of shares increases. So thus there is a what effect? Set of effect takes place. So market value will remain same. But if the company don't want to raise equity shares, means you do one thing. Whatever the earnings you have, with that earnings what you do? You can make what is that? Investment. Whatever the earnings you have, you can make that investment so that you can comfortably handle the organization. Here I will give you what is this model is, what is this? Modigliani Miller approach. Modigliani Miller approach is relevant or irrelevant? Irrelevant model. Irrelevant model. According to this irrelevant model, this company argument is either you pay dividend, not to pay dividend, market value will remain what is that? Same. Let us take here the argument is this. If company, what happened? Company has fixed investment policy. What is that? Fixed investment policy. when company has fixed investment policy, if the company wants to pay fixed investment policy, for that purpose it need money. Company has a earnings. If the company has a earnings, company has a two choices, either to declare or retain. If the company retains amount, what happen? It will make, what is that, reinvest. In such a case, there is no need to raise, what is that, new funds. If not, if the company declares a dividend, in such a case, what happen? When company declares a dividend, automatically what happen? When company declares a dividend, market price of the share, what happen? Decreases, and company has to issue, what is that, new number of shares. With that new number of shares, it has to raise the funds. With that funds, it has to undertake. But in such a situation, what happen? When it company issues a new shares, automatically liability side increases. Hello? At the same time, with the liability side raised amount, which will make investment in the asset side. In such a case, assets also will increase. Both will happen, what is it? Same effect. So either you declare a dividend, not to declare a dividend does not make. Then how, sir? How the market value will increase? The market value of the equity share is depends upon how effectively you are going to take, what is that, investment policy of the company. What effect, what the commodity you are going to produce, that is the most important point. Here he projected market value of share is nothing but, in order to make this value to prove, he projected MP0, market price MP0 equal to DPS1 plus MP1 divided by 1 plus KE. This is the formula. MP0 equal to market price as on today is nothing but DPS1 plus MP1. And one most important point is, here the valuation for this market value would be considered only 1 year. You are going to get the cash inflows at the end of first year itself, only 1 year. So that is the reason DPS1 plus MP1 divided by 1 plus KE. 1 plus KE is nothing but investor expected rate of return. Now basing on that, MP1 equal to, can you say like this, MP0 into 1 plus KE minus DPS1. This is the first formula. This is the second formula. And number of new shares to be issued. Number of new shares is would be like this. Investment minus earnings minus dividend to be paid divided by number of equity shares. This is the number of equity shares. And finally, market value of firm would be like this. Existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus K. So these are the certain most important formula to be proved. Either company declare a dividend, not to declare. MP0 equal to, most important point ikkada, fixed what policy? Fixed investment policy company have. Number 2, what is that? Fixed investment policy. Life is how many years? 1 year. So with the fixed investment policy 1 year, you can undertake Modigliani-Miller theory. This theory is based on certain assumption. Assumptions are no capital market perfect, no taxes. Here it is, what is it? Fixed investment policy, no flotation cost, risk of uncertainty. Market value of firm, whatever the formula I gave, it's the same thing only. But here I changed existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus KE. So this is the problem. Modigliani-Miller argument is that dividend is not at all relevant one. Here, let me save this one. We had a problem. Let us see in this problem. ABC Limited is outstanding shares. Here I made it some PPT for you. Well, time is getting up, right? Working capital also is there. ఒక కాన్సెప్ట్ టచ్ చేసాం అనుకో, actually we used to plan, actually I made it a judgment, this for each and every chapter is how much But sometimes MM theory where it will takes a lot of time. Within 10-15 minutes means kaise Baluji? Here you see it, ma. This is the problem which would be useful. Mr. M Limited belongs to risk class. Capitalization rate is right. Mr. M Limited belongs to a risk class for which the capitalization rate is how much? 10% KE. It has how many shares? 25,000 outstanding shares. Means existing shares is 25,000. Current market price is 100. It expects that net profit is how much? 2,50,000 for the year. Board is considering dividend per share is 5. M Limited requires to raise how much money? 5 lakhs for approved investment. Show the how MM approach affects the value of firm. Dividend are paid or not to pay. Now the company has a proposal to declare what is a dividend. If they declare a dividend, not to declare a dividend, market value does not make any effect. You see, estimation of market value of firm when dividend is paid, when dividend is not paid. For example, number of existing shares. How many shares? 25,000. Here also 25,000. MP1 means market price at the end of the period equal to MP0 into 1 plus KE minus D1. So MP0, how much it is MP0? This is nothing but 100. Present share price. ఇప్పుడు చూడండి మీరు మార్కెట్లో MP1 అంటే ఏంటి? మార్కెట్ ప్రైస్ ఎట్ ద ఎండ్ ఆఫ్ ఫస్ట్ ఇయర్. ఇప్పుడు మార్కెట్ ప్రైస్ అనేది మీరు డిక్లేర్ చేయాలంటే ఫ్యూచర్లో వచ్చే వాల్యూ మొత్తం ఏం చేయాలి? ప్రెజెంట్లో తీసుకురావాలి. మార్కెట్ వాల్యూ ఇస్ నథింగ్ బట్ ప్రెజెంట్ వాల్యూ ఆఫ్ ఫ్యూచర్ బెనిఫిట్స్. బట్ ఇక్కడ వచ్చేది నాట్ ఎ పర్పెచుటీ, ఓన్లీ 1 year. Modigliani-Miller argument. What is that Modigliani-Miller argument? Market value of firm would be estimated. Whatever the benefit you are going to get it in future, you have to bring into present. First year, what I am going to get it? First year, I am going to scrap all the existing shares, new shares. How many existing shares I have? 25,000. Then how much new shares I have? New shares means how many shares I am going to issue. That depends upon my investment. That depends upon my earnings. That depends upon my number of shares to be issued. Here you try to understand MP1. Why I need MP1? Because at the end of the period, I may issue the shares. Hello? When I want to issue the share means what I need? MP1 I need. MP0 already given. So MP1 equal to MP0 into 1 plus KE minus D1. That is nothing but how much? 105. Here I got it 110. Number of new shares I need. Number of new shares depends upon investment minus earnings minus dividend. I need 5 lakhs rupees, but I have a 2.5 lakhs earnings. Out of that, I am going to declare 1.5 lakhs as a dividend. So 5 lakhs, 2.5 minus 1.5 minus 5 lakhs divided by 105 means you will get it how much? 3,571. Calculate it. I need how much? 5 lakhs of investment. I need 5 lakhs of investment, right? 5 lakhs. Actually, I should issue the share price at 105. But the thing is, I have how much? 2.5. So, but 2.5, I have a earnings. Earnings I have. But out of that, I am going to declare dividend. Now tell me, in that case, net amount I realized. I need to net amount. How much? 2.5 minus 1.25 minus 5 divided by 105 equal to 3,571. Yes or no? These are the shares I should issue if my dividend is declared. If dividend is not declared, in such a case, 5 lakhs, earnings I have 2.5 lakhs, dividend place is 0. Do you agree? Dividend is declared cheyan kada. In such a case, number of new shares would be 2,272. Next, now investment required is 5 lakhs, 5 lakhs. Earnings are 2,50,000, 2,50,000. Next, market value of firm, what I told. N means existing firm and new firms. Existing shares, new shares. Existing shares how many? 2,50,000. New shares how many? 371 into MP1. I have to calculate MP1, right? So MP1 end lo calculate chestan kada. So into MP1 105 plus earnings are how much? 5 lakhs. Investment is 2.5. Investor expected at 1.1. How much it is? 25 lakhs. What about here? 25 lakhs. Here also 25 lakhs existing shares plus new shares into 110. Sir, ఇక్కడ 105 తీసుకున్నారు సార్. అక్కడ డివిడెండ్ డిక్లేర్ చేయకపోతే మార్కెట్ వాల్యూ ఏమవుతుంది? ఇంక్రీజ్ అవుతుంది కదా. So that is the point 110 minus 5 lakhs plus 2.5 divided by 1.1. Now you try to understand, this is a practical problem. Even your new CMA material also, this problem is not there. Because they asked a number of new shares, how much investment is required. But to the end, market value of firm, practically, in order to prove this problem will be best problem. Okay, ma? This is. There is one more point, residual theory is there. Not is that we see. Here, no. These three things are important, ma, just for this. What are they? Walter theory, Gordon, MM. Walter theory formula, D plus E minus D into R divided by KE whole divided by KE. Gordon model, DPS1 divided by KE minus growth rate. Modigliani-Miller theory, market value of firm, existing shares plus new shares into MP1 minus earnings minus investment plus earning divided by 1 plus KE. Right? This model indicates that market value of equity is not depends upon either dividend declaration, dividend policy, but market value of equity market value of equity or market value of equity is depends upon what is that? Investment decision. నువ్వు డివిడెండ్ ఎంత డిక్లేర్ చేసావు, డిక్లేర్ చేయకపోవడం అదిగా సమస్య. నువ్వు ఎందులో ఇన్వెస్ట్మెంట్ చేస్తున్నావు అది సమస్య. రేపు ఎగ్జామ్లో ఫెయిల్ అయ్యావు అనుకో, అందరూ పిలిచి ఏంటి ఫెయిల్ అయ్యావు అంటే, ఫెయిల్ అయ్యాం కాదు, ఎందులో ఫెయిల్ అయ్యామో తెలుసుకో. బిఏలో కాదు ఫెయిల్ అయింది, సిఎంఏలో ఫెయిల్ అయ్యాం, కొద్దిగా టఫ్గా ఉంటుంది అని చెప్పేంత స్థాయిలో ఉంటుంది. అదే ఏ థీరీ? ఎంఎం థీరీ అమ్మా. మనకు వద్దులే, మనం ఎందుకు ఫెయిల్ అవుతామమ్మా? ఎసాను యా. అండ్ లెట్ us take what is the concept is, you are expecting working capital, right? Thereafter, next chapter, whatever it may be, I will take working capital. This is the working capital. Arey, what is the working capital? See, working capital, I will write here exactly. कितना रे टाइम अभी? 9 వరకు అయినా తీసుకోవచ్చు, నో ప్రాబ్లం. मैं जाके क्या करेंगे, मैं खाना खाएंगे बस. वर्किंग कैपिटल. अरे वर्किंग कैपिटल, नोट इट डाउन माजी. वर्किंग कैपिटल, it is the amount of capital. See, every company need a capital. This capital being classified into two types. One is to make investment on what asset? Fixed assets. To investment on what is that? Current asset. Amount which is allocated to make investment on fixed asset is called what is that? Fixed capital. Hello? The amount which is allocated to make investment on what asset? Current assets is called what is that? Working capital. So this, if you observe this one, two words are there. Number one working W, another one is capital. Working capital. Working capital means smooth working capital. It is amount required to the company for the sake of what is that? Day-to-day business. What is that? Day-to-day business operation. It is amount of capital allocated by the company to run what is that? Day-to-day business operation. Okay? And it is the amount invested for what assets? Investment on what is that? Current assets. This is the two lines. Entirely I cannot give it, right? You can make it a simple note like this. Day-to-day business operation, investment on current assets is called what is that? Working capital. The title itself, Balu sir told 1, 2, working capital. Working capital means what working? Day-to-day. But now working means what working? Smooth working. Got it now? If business has to work means smooth working means you need a capital, that is called working capital. Significance of working capital, what is that? Smooth running of business, do you agree? Smooth running of business. And this is the first one. When any working capital or any payments you have to pay, you will pay what is that? In time. With effect your goodwill what happen? Increases. And automatically your credit worthiness what happen? Credit worthiness, goodwill also increases, and business runs without any hindrances. Risk would be low or higher? Low. So these are the observations with respect to what is that? Working capital. What is a working capital management? Working capital management means systematic management of what, Maji? Working capital. Systematic management of working capital means you should maintain working capital in such a ways it should is not over, it should not what is under. So when working capital is over, what happen? So it may have high liquidity, yes or no? Liquidity may increase, but what is that cost? What happen? Increases. Do you agree? When company cannot manage చేయకపోతే ఏమవుద్ది? ఇప్పుడు మీ పేరెంట్స్ వచ్చారనుకో, రేపు సండే వచ్చాడు, డాడీ ఖర్చులకు డబ్బులు కావాలంటే ఎంత కావాలమ్మా? ఒక 30 లక్షలు ఇవ్వనా అంటే ఎక్స్ట్రా కదా, చూసావు 30 లక్షలు అంటే కడుపు మండిందా? 30 లక్షలు ఇది మంచిది కదమ్మా, పెన్ను కొనుక్కోవచ్చు అంటే ఎందుకు డాడీ ఎక్స్ట్రా ఎందుకు ఎక్స్ట్రా చేస్తున్నారు? అప్పుడు దాన్ని ఏమంటారంటే, డాడీ బాలు సార్ ఏం చెప్పాడు దాన్ని? ఓవర్ యాక్షన్ కాదు, దాన్ని ఏమంటారు? ఓవర్ క్యాపిటల్ అంటారు. ఎస్ఆర్ నో? అప్పుడు లిక్విడిటీ ఎక్కువ ఉంటుందా తక్కువ ఉంటుందా? ఎక్కువ ఉంటుంది. కానీ ఆ 30 lakhsకి వడ్డీ కట్టాలి కదమ్మా, ఫైనాన్స్ యూ హ్యావ్ టు పే, దట్ వుడ్ బి వాట్ ఇస్ దట్ కాస్ట్. వాట్ అబౌట్ ఇప్పుడు అదే డాడీ వచ్చి 20 రూపాయలు కావాలంటే అండర్ క్యాపిటలైజేషన్ అంటారు. 20 రూపీస్ పెట్టుకుంటే స్కేర్ సిటీ ఎలా ఉంటుంది? దారుణంగా ఉంటుందా? వెన్ స్కేర్ సిటీ ఈజ్ హై, ఆటోమేటిక్లీ రిస్క్ ఎలిమెంట్ ఆఫ్ ద కంపెనీ ఆల్సో వాట్ హ్యాపెన్? Increases. Yes or no? Risk would be high. So a company has to maintain what is that? Cost it has to take, as well as what is it? Risk it has to take. For that purpose, it need what is that? Management. Working capital management balances what is that? Liquidity come risk. Got the point, ma? So that is the most important point. Thereafter, what is that? Estimation of working capital of the company. Corporate companies estimates working capital on the basis of different method. First method, specific percentage of, so specific percentage on what asset? Fixed assets. Because according to this method, every company need a current assets in order to generate a return from what is it? Fixed assets. So current assets of the company is depends upon fixed assets. If the company wants to estimate working capital, what the matter they do? They will take what is that? Total fixed asset, right? And with the percentage they will multiply it. Hello? That percentage is nothing but specific percentage on fixed asset. Second one is specific percentage on expected sales. Expected sales. This is the second thing. Here working capital of the company or current assets depend upon what is it? Sales made by the company. And third one, basing on our working capital estimation is working capital estimation basing on what, Maji? Operating cycle or operating cycle period. That is the most important point. This is the very important point. Which one? Working capital estimation basing on what is that? Operating cycle. Okay, now estimation of working capital basing on operating cycle. In order to calculate estimation of working capital operating cycle, first you have to understand various inventory norms. What are they? Inventory norms or operating cycle period. Operating cycle periods. Out of this inventory norms, what are they? Raw material holding period, sir? No? Work in progress holding period and finished goods holding period, thereafter debtors collection period, and thereafter creditor payment period, yes or no? Thereafter time lag. So all these things you have to understand, and basing on this you have to calculate what is that? Working capital. These are the various holding period, and basing on this holding period, how do you calculate statement showing working capital? Means very simple. To calculate statement showing working capital, you have to understand how to compute the working capital. You have to take current assets. In order to estimate what is the holding period is there, For this sake, what is that? Stock of raw material equal to what do you say? Raw material consumed during the year divided by 12 months into raw material holding period. Hello, Maji? Okay, this is the another first one. Thereafter, work in progress holding period. Work in progress would be 3 elements would be there. What are they? Raw material, wages, overheads. Okay. Under that, what happens? First, stock of raw material equal to raw material consumed during the year divided by 12 months into raw work in progress holding period. You know that conversion cost for raw material always to take 100%. Thereafter, what is that? Wages. For wages incurred during the year, wages incurred divided by 12 months into work in progress holding period into 50% conversion cost, always 50% you have to take it. Thereafter, overheads. Yes, ma? Overheads, what do you say? Overheads incurred during the year divided by 12 into work in progress holding period into 50%. So, this is the work in progress, you got it. Another one, third one is finished goods holding period is there. Finished goods holding period, it indicates it is the time period in which even after commodity production, they won't, what is that? Sell in the market, they will hold the product in office in order to sustainably maintain demand. So stock of finished goods formula, do you remember? Stock of finished goods, cost of production or cash cost of production. What is it? Cost of production divided by cash cost of production divided by 12 months into finished goods holding period. Most important point in estimation of stock of finished goods, you should understand what is the treatment of depreciation. Sometimes what happen, while calculating cost of production, we may ignore depreciation. Ignoring means we are considering cash cost basis. Hello, we are considering means we will take what is it, total cost basis. So cost of production divided by 12 months into finished goods holding period. Right, thereafter you have debtors. So debtors could be calculated. Debtors equal to, you have credit sales or cost of credit sale. Hello, credit sales divided by 12 months into debtors collection period. Right, you may get it. Or you may also calculate like this: cash cost of sales divided by 12 into debtors collection period. So what is the difference between these two, ma? That is nothing but profit. Hello, you keep it in mind. You need 3 steps to skip. One is profit, number 2 depreciation, and number 3 conversion cost. Hello, conversion. While calculating work in progress, what is the treatment with respect to conversion cost? While calculating stock of finished goods, what is the treatment with respect to depreciation? While calculating debtors, what is the treatment of profit? అంతే, 10 మార్క్స్ వచ్చేస్తాయి. తిప్పి అడిగినా ఇందులో నుంచి అడుగుతాడు. ఇంతకు మించి వాడు అడిగింది లేదు ఏ ప్రాబ్లమ్ కూడా. సో కన్వర్షన్ కాస్ట్ హౌ మచ్ ఐ టేక్, profit I should, whether should I take or not. This is the point. Thereafter you have cash balance, any cash balance. So cash and any advance, you can add all these things. If you add all these things, you will get is what is a total current assets. Yes or no, ma? From the total current assets, you have to deduct what is it, current liabilities. So current liabilities would be creditors. So current liability, you have creditors. Creditor formula, trade creditors. Trade creditors formula would be credit purchases divided by 12 months into creditor payment period. Thereafter any time lag also is there, you can take it. Right, time lag means wages. So wages incurred during the year divided by 12 months into time lag. From this current assets, current liability, if you sum it up, you will get it a total current liability. Right, from C you will find it out working capital, that is A minus B, you will get the working capital. From this working capital, what you have to do, you have to deduct what is that, margin of safety would be there. Right, that margin of safety should be added back. So this would be the working capital, format to be considered. And finally add margin, that would be margin would be added, then you will find what is that, working capital. So this is the way the corporate companies estimate working capital. Are you getting? So this is the statement showing working capital requirement of the company. So basing on this, I identified here what working capital. See, this is the one problem. for working capital estimation. You see, this is the one of the small problem. On 1st January, Managing Director of Naurin Limited wishes to know amount of working capital that will require during the year. From the following information, prepare the working capital requirement. Production during the previous year, how many year? Last year, how many units they produced? 60,000. It is planned that the level of activity would be maintained during the present year. It means that how many units? 60,000. The expected ratio of cost to selling price of raw material is how much? 60%, direct wages 10%, overhead is 20%. Raw materials are expected to remain store as a how many months? 2 months. What is this 2 months is? Raw material holding period before issue the production. Each unit is expected to be processed for 1 month. What is this? Work in progress holding period. Raw material being fed into the pipeline immediately. Labor and overhead cost accruing evenly during the month. Nothing but the point is what they're conveying. If the raw material takes into the factory, hello, so it will makes a journey to produce the product. Raw material to convert the final product, it need what is it? 1 month. Here once again, the material being fed into pipeline. Pipeline is process. Polavaram process still in pipeline. Still Balu sir marathon classes in pipeline. Hello. So still in pipeline. Any work is in process indicates what is it? Pipeline. So their pipeline, the raw material would be in pipeline for how many months? 1 month. Finished goods stay in warehouse awaiting dispatch to customer approximately how many months? 3 months. Credit allowed to creditor is how much? 2 months. The date of delivery. Credit allowed to debtors is 3 months from the month of date of dispatch. So selling price is how many? 5 per unit. There is a regular production and sales cycle. Wages and overheads are paid first of each month for the previous month. It means for during the 12 months, January we will pay when? February. But we will pay in the same year itself. అంతే కదా, అప్పుడు జనవరిలో పే చేస్తాం, అంటే ఆ ఇయర్లోనే పే చేస్తాం. బట్ ఇయర్ డిసెంబర్ది నెక్స్ట్ ఇయర్ పే చేస్తాం, అంటే టైం లాగ్ ఎంత ఇయర్లో? 1 month you got it, okay? 1 month. So the company keeps cash in hand is how much? 20,000. How much the cash? 20,000. In this problem in public exam, what they will expect means margin of safety they will expect. Hello? What total working capital you calculated, that working capital you have to add what is that? Margin. Number 2, in this problem, what is not given exactly is he may give advances. Hello? Advance is not given. In the public exam, we can expect this problem as an advance. Now tell me, what are the various holding periods? Here, you see, Naurin Limited Company, unit production, how many? Selling price, 5 rupees. Raw material, 60%. Wages is 10%. Overhead is 20%. Raw material holding period is 2 months. Work in progress period is 1 month. Finished goods holding period 3 months. Creditor payment period is 2 months. Once again, వీటిలన్నిటిని గుర్తు చేసుకుంటున్నాను నేను, ఓకేనా? మీకు అర్థం అవ్వాలని. మీ దగ్గర మెటీరియల్ లేదు కదా, వాట్ మాజీ, దట్ ఈస్ ద రీజన్. Debtors collection period is 3 months. Cash is 20,000. Time lag of is nothing but 1 month. This is the problem. Abhi karo. Raw material holding period 2 months. Work in progress 1 month. Finished goods 3 months. Debtors collection period 3 months. Creditor payment period 2 months. Time lag. Wages overhead 1 month kada. In such a case, raw material how much? 3 ఎలా వచ్చింది సార్ 3? 5 into 60%. Direct labor 5 into 10%. Overheads 5 into 20%. So total cost is how much? 4.5. Profit is 0.50. Sales price is 5, right? So now you got the stock of raw material. What is the formula of stock of raw material? Raw material consumed during the year divided by 12 months into raw material holding period. How many units you are producing? 60,000. Per unit price 3 rupees. Yes or no ma? 60,000 into 3 divided by 12 into 2. Check it. 30,000. Calculator sound రావట్లా. ఎక్కడుంది క్యాల్కులేటర్? ఇంట్లో ఉంది కదా, పర్సులో ఉంది కదా, జాయింట్ బాక్స్లో ఉంటుంది చూడు. $30,000. Work in progress. Work in progress you have 3 things, right? Estimation of work in progress. Stock of raw material 60,000 into 3 divided by 12 into 1. Raw material how much I took? 100%. Wages 60,000 into 0.50 divided by 12 into 1. How much? 50%. 1,250. Overheads 60,000 into 1 divided by 12. 1.5 50%. Yes or no? 2,500. Is it right, ma? So total 18,750. I took this 18,750. Stock of finished goods formula. In the problems, depreciation is not given. Hello? In such a case, you can take stock of finished goods equal to cost of production divided by 12 months into finished goods holding period. So 60,000 into 4.5 divided by 12 into 3. How much? 67,500. Debtors equal to, directly I took the cost of credit sales. 60,000 into 4.50 divided by 12 into 3. How much? 67,500. Cash is 20,000. So total 2,03,750. What about the current liability? Trade creditors formula: credit purchases divided by 12 months into creditor payment period. Balu sir, credit purchases not given, sir. In such a case, you take an assumption. How much consumption you done it, that much of commodity you might have purchased. So trade creditors equal to 60,000 into 3 divided by 12 into 2. How much? 30,000. Wages incurred during the year. Wages incurred during the year divided by 12 months into time lag. 60,000 is the units into 0.5 divided by 12 into 1. 2,500. Overheads 60,000 into 1 divided by 12 into 1. How much? 5,000. So total 37,500. Net working capital. Current assets 2,03,750. Current liability 37,500. You got it? 1,66,250. Got it? This is the problem. Margin of safety given in such a case, what to do? We have to add. So this is the first basic model problem to estimation of, what is it? Working capital, right? So that working capital. Now another topic is operating cycle. Next most important point is operating cycle. Balu sir, what is the operating cycle? It is a time period in which raw materials are converted into what is that? Cash. So it is the time period in which raw materials are converted into cash. Thus it is also called, it is also known as what cycle? Cash cycle period. What is that? Cash cycle period or working capital cycle period. Okay. Whereas what are the various operating cycle period to be needed, and what are the various holding periods? Operating cycle includes, just now I told you, this operating cycle includes various holding period. What are they? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, and creditor payment period. Hello? This is, all these things are your current assets oriented. This would be current liability. In such a case, how do you estimate operating cycle period? So net operating cycle period equal to, you added all these things: raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditor payment period. You will get it, the net operating cycle. For example, 150 days. What is this 150 days? Can you tell me? So it indicates that a company takes cash. With that cash, it takes the raw material. This raw material, it will convert into work in progress to finished goods to debtors to cash. In order to generate this cash, it takes time of how many days? 150 days. If the company smoothly runs, what is it? This 150 days comfortably, what is the benefit it is going to do? If it invests 15 lakhs rupees, if cycle it gets completes, it will get 15 crores. అంతే కదమ్మా. రా మెటీరియల్ని ఫినిష్డ్ ప్రోడక్ట్ అమ్మేస్తే డబ్బులు వస్తాయి కదా. ఈ ప్రాసెస్ మొత్తం స్మూత్గా రన్ అవ్వాలంటే వాళ్ళకి మనీ కావాలి. ఈ ప్రాసెస్ స్మూత్గా రన్ చేయడం కోసం వాట్ ఎవర్ ద అమౌంట్ వీ విల్ ఇన్వెస్ట్, దట్ ఈస్ కాల్డ్, వాట్ ఈస్ దట్? వర్కింగ్ క్యాపిటల్. Why we used to hold this working capital? भैया अगर ये साइकिल कंप्लीट हो गया ना, देखो 15 लाख से 15 करोड़ आएगा. उसके लिए we are ready to spend 5 lakhs. 5 lakhs కూడా కక్కుర్తి పెట్టిన భయ్యా. అరే 15 లక్షలు పెట్టుబడి పెట్టావు, 15 కోట్లు వస్తుంది. ఏదైనా తేడా వచ్చిందనుకో మొత్తం పోద్ది. ఆ 15 కోట్లు రావడం కోసం ఎంత ఇన్వెస్ట్మెంట్ చేస్తావు?
5 lakhs అంటే ఖర్చుగా సార్ అంటే దాన్ని అండర్ క్యాపిటలైజేషన్ అంటారు. అవునా? మరీ ఎక్కువ కాదు, తక్కువ కాదు. యూ హ్యావ్ టు మెయింటైన్ వాట్ ఇస్ దట్ అడిక్వేట్ సూటబుల్ అమౌంట్. గాట్ ఇట్ మా? రైట్. ఐఎమ్ సేవింగ్. ఫాలోయింగ్ కదా? రైట్. నెక్స్ట్ వన్, ఎస్టిమేషన్ ఆఫ్ క్యాష్ సైకిల్స్. క్యాష్ సైకిల్స్ మీన్స్ నెంబర్ ఆఫ్ క్యాష్ సైకిల్స్. నెంబర్ ఆఫ్ ఇన్ ఏ ఇయర్లో ఎన్ని క్యాష్ సైకిల్స్ వస్తాయంటే నెంబర్ ఆఫ్ క్యాష్ సైకిల్స్ ఈక్వల్ టు, ఫర్ ఎగ్జాంపుల్ యువర్ ఆపరేటింగ్ సైకిల్ ఈజ్ హౌ మెనీ డేస్? ఇంతకుముందు అనుకున్నాం ఎన్ని డేస్? 150 days. ఇన్ ఏ ఇయర్కి హౌ మెనీ డేస్? 360. 360లో నువ్వు 150 days అన్నావు అనుకో, అప్పుడు ఎన్ని సైకిల్ వస్తాయి? 2 cycles. దీని ఫార్ములా ఏంటప్పుడు? నెంబర్ ఆఫ్ క్యాష్ సైకిల్స్ ఈక్వల్ టు వాట్ ఇస్ దట్? 365 డివైడెడ్ బై నెట్ ఆపరేటింగ్ సైకిల్ పీరియడ్. అంటే ఇండైరెక్ట్గా అంతకుముందు ఎంత ఉంది? 365 కదా. 365 డివైడెడ్ బై 150 అనుకునింది. 150 ఈజ్ నథింగ్ బట్ వాట్ ఇస్ దట్? 2.43. Maji, what do you mean by 2.43? Times क्यों आएगा रे? That cash cycle period is 150 days. 150 days means 2.43 means 2 point. Let us do 43 kill it. Take a 2. What do you mean of this 2? It indicates that because they are converting raw material into finished product, for that purpose they are spending 150. It means that they are generating 2 cycles. Now, if you make it a 50 days in net operating cycle period, appudu 50 days aithe 50 days aithe sir 365 divided by 50. Now tell me, each and every company ultimate objective is to 7 point. Ippudu cheppandi, all the companies ultimate objective is to what? Cycles to be increased, decreased? Number of cycles. నెంబర్ ఆఫ్ సైకిల్స్, ఇంకా క్లారిటీ రాలి. నెంబర్ ఆఫ్ సైకిల్స్ ఇంక్రీజ్ చేయాలా, డిక్రీజ్ చేయాలి? మాజీ డబ్బులు ఆ గుండె నేను చెప్తున్నా, రోజు డబ్బులు ఊరికే రాదు అంటాడు కదా. డబ్బులు ఊరికే రాదు. ఇప్పుడు నేను చెప్తున్నా, డబ్బులు ఫాస్ట్గా కావాలి. నాకు ఫాస్ట్గా కావాలా, లేట్గా కావాలా? ఫాస్ట్గా కావాలి. అంటే ఎన్ని టైమ్స్ రావాలి? 2.4 times. నచ్చలే నాకు. పర్ మంత్ 12 times వస్తుంది. అస్సలు కడుపు మండిపోద్దు నాకు. ఏదో 12 months అసలు 12 నెలలు పని చేస్తే 12 సార్లు డబ్బులు రావడం ఏంటి? కనీసం ఒక 3000 సార్లు వస్తాయి. అదొక ఆనందం ఉంటుంది. మరి అటువంటిప్పుడు ఏం చేయాలి? టీ అంగడి పెట్టుకోవాలి. వాడి దగ్గర అయితే 10 నిమిషాలకు ఒకడు వస్తుంటాడు కదా. హలో, కానీ దానికి ఒక ప్రొఫెషన్ ఉంటుంది కదా. బట్ వీ షుడ్ నాట్ టేక్ ఆల్ దిస్ థింగ్స్. బట్ ద థింగ్ ఈస్, ఇన్ ఏ మంత్ శాలరీ 5 times ఇస్తే హౌ బ్యూటిఫుల్ ఇట్ ఈస్ కదా. నేను ఎంప్లాయీగా ఉన్నప్పుడు హ్యాపీగా ఉంది. అదే నేనే ఓనర్ అయినప్పుడు కడుపు మండిపోద్ది. హూ told this to pet అంటాం అప్పుడు. సో నెంబర్ ఆఫ్ క్యాష్ సైకిల్స్ వుడ్ బి, నెంబర్ ఆఫ్ క్యాష్ సైకిల్స్ డిపెండ్స్ అపాన్ యువర్ నెట్ ఆపరేటింగ్ సైకిల్ పీరియడ్. ఆర్ యు గెటింగ్ రైట్? ఎస్టిమేషన్ ఆఫ్ వర్కింగ్ క్యాపిటల్ బేసింగ్ ఆన్ ఆపరేటింగ్ సైకిల్. యు సీ నౌ వర్కింగ్ క్యాపిటల్ మీన్స్, యూ ట్రై టు అండర్స్టాండ్, యు ఆర్ గోయింగ్ టు మెయింటైన్. ఐ మేడ్ ఇట్ దిస్ ఎల్లో హియర్. ఇట్ ఇస్ ఇది ఎల్లో, ఇదే కదా వర్కింగ్ క్యాపిటల్ అన్నాను. హలో, ఈ ఎల్లో అంటే ఏంటి? ఒక సైకిల్ కోసమే కదా. Working capital is nothing but to maintain one cycle. Here, company has how many cycles? Let us take 2 cycle. మరి వర్కింగ్ క్యాపిటల్ కావాలంటే పర్ ఇయర్ కా, పర్ సైకిల్ కా? ఇంకా అక్కడ ఉంది, అక్కడ ఇమేజ్. పర్ సైకిల్ కా, పర్ ఇయర్ కా? ఇఫ్ ఆపరేటింగ్ సైకిల్ పీరియడ్ ఆఫ్ ద కన్సర్న్ కంపెనీ 365 days అనుకో, అప్పుడు పర్ ఇయర్. పర్ ఇయర్ ఇస్ నథింగ్ బట్ వర్కింగ్ క్యాపిటల్. హలో, కాదు. Operating cycle period in a year, the company generates what is that? 6 cycles means. In such a case, you should not take a total annual cost. Hello, you have to take working capital per cycle. You try to understand, working capital estimation basing on operating cycle means working capital equal to total cost incurred. Total cost incurred per annum divided by number of cash cycles into, we need how many cycles? Only 1 cycle only, no? Entamma, working capital always we required what is that? 1 cycle. So this is the point to be estimated. Operating cycle, you need total cost, what is a given, divided by number of cash cycles. Okay, then automatically amount you will get it. You need how much? 1 cycle, right? This is the way to calculation of working capital. Now, basing on this, shall we take one problem? Now tell me, what are the various holding periods?
Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period. Yes or no? So net operating cycle period equal to add all, deduct a creditor payment period. So number of cash cycles equal to 365 divided by working capital if you want to find it out. Total cost divided by number of, yes. Now basing on this, we can solve a problem. Here it is, let it save to be. This would be here. This problem is very, very important problem. This problem cainter, CMA also is there. Old practice manual, this problem is asked. Very easy to find it out, okay. An average debtors collection period is how many days? Lens cut. An average debtors collection period is how many days? 45 days. Inventories have an emerged holding period is how many? 75 days. Why I choose this problem is, even in your material also not is given, what is it? Inventory holding period. Even whatever my material I wrote it, I used raw material holding period, work in progress, finished goods, but I could not use what is it? Inventory. Inventory holding period includes raw material holding period, raw material holding period, work in progress holding period, finished goods holding period. These three collectively called what is it? Inventory holding period. And creditor payment period is 30 days. Total amount spent is how much? 120 lakhs. It can earn opportunity cost of how much? 10%. Balu sir, why they giving a 10%? Very simple. Because they came to your office with your suggestion. If they reduce working capital, reduced amount they will invest outside. If they invest outside, they may generate how much? 10%. Adi what point. వర్కింగ్ క్యాపిటల్ మీరు తగ్గిస్తే తగ్గిన అమౌంట్ తీసుకెళ్ళి బయట ఇన్వెస్ట్మెంట్ చేస్తే దాని మీద నాకు బెనిఫిట్ వస్తే బెనిఫిట్ ఎంత అంటాడు. ఆ బెనిఫిట్ ఎంత వాడు? 10%, రైట్? ఫ్రమ్ ద అబవ్ ఇన్ఫర్మేషన్ యు ఆర్ రిక్వైర్డ్ టు క్యాల్కులేట్ వాట్ ఇస్ దట్? క్యాష్ సైకిల్, క్యాష్ టర్న్ ఓవర్. దిస్ ఇస్ నథింగ్ బట్ క్యాష్ సైకిల్ పీరియడ్. వాట్ ఇస్ దట్? Cash cycle period. This is the cash turnover means number of cash cycles. What is that? Number of cash cycles. Minimum amount of cash to be required to meet the become due. That is nothing but working capital ఎంత కావాలి? Savings by reducing the average inventory holding period by 30 days. By chance if the holding period is reduced to how much? 30 days. How much you are going to get it? ఇప్పుడు చెప్పండి, first what we have to do? Cash cycle period. Cash cycle period also called operating cycle period. Maji, terminology I changed. Their operating cycle period. But here they used word cash cycle period. Here you see. Given information. Inventory conversion period how much? Debtors collection period how much? Creditor payment period is how much? 30 days. So estimation of cash cycle period. Cash cycle period also called operating cycle period. Cash cycle period equal to inventory conversion period plus debtors collection period plus minus creditor payment period. 75 plus 45 minus 30. How many days? 90 days. Number of cash cycles. Number of cash cycles equal to 360 divided by net operating cycle period. 360 into divided by 90. How many cycles? 4 cycles. 4 cycles, right? Ipudu estimation of number of operating cycles in a year. Number of operating cycles in a year kavalante 360 divided by how many? 4. Here I made it. Here I wrote it, 4 cycles, right? Now minimum estimation of minimum amount of due per cycle or working capital per cycle equal to working capital equal to total cost divided by number of cash cycles. So 1 lakh, 1 crore 20 lakhs are given. 120 lakhs divided by 4. How much it is? 30. So working capital would be 30. Now last bit what they asked is estimation of savings by reducing inventory conversion period by 30 days. Here working note, estimation of proposed net operating cycle period if they reduced 30. In such a case net operating cycle period equal to inventory conversion period previously how much? 75. We are going to reduce 30 plus debtors collection period is 45 minus creditor period is 30. In total how much it is? 60 days. So working capital estimation of proposed number of cash cycles. So it is a working note actually. Number of cash cycles equal to 360 divided by 60. How much? 3. 6 cycles. Now estimation of proposed working capital per cycle. Isar enta indi. So working capital equal to total cost 120 lakhs divided by 6. How much? 20 lakhs. Estimation of savings by reducing inventory conversion period by 30 days. 30 days. Inside again, savings actually how much previously? 30 lakhs. Now 20. 30 minus 20, 10 lakhs. But if you opportunity cost ichadaga, when opportunity cost is given means what do you mean of that? If they would have invested outside, you might have got it this. How much it is? 1 lakh. What is that 1 lakh is? If you at any cost, if you reduce, what is that? Holding period by how much? 30, then automatically your amount will reduce to 1 lakh. 30 days reduce aithe మీ amount ఏమైపోద్ది? 1 lakh consideration అవుతుంది. This is the operating cycle period. Got it, ma? Right. This is the another important, very, very important model. Then, very, very important, only this. Then maximum permissible bank finance. Is there no? This maximum permissible bank finance recommended by Tandon committee. What committee? Tandon committee. So Tandon committee recommended the methods, 3 methods. Method 1. So method 1 equal to, what is that? 75% of current assets minus current liability. Method 2, what they projected is, method 2 is 75% of current assets minus current liability. Method 3 equal to 75% of current assets minus core current assets. What is that? Core current assets minus current liability. Core current assets means, see, current assets, there are certain assets must be financed by who? Company. Got it? First of all, you should understand, Balu sir, what is maximum permissible bank finance? Maximum permissible bank finance means at one point of time there is a contradiction between banks and business. Business people need a working capital. Banks are reluctant to give, what is that? Working capital. So that is the why, because you know, if the company cannot pay loans which are taken on current assets, if they cannot pay means, if the assets loans are given on fixed asset, then company can easily scrap the fixed asset. If the loan is given on what asset? Current asset, it would be difficult to the banks. Hello. Number 2, current assets could not generate a return, but whereas fixed assets generate a return. That would be the reason they said that sorry, we cannot. But the banks said already, sir, we are already taken loan from you. If you can't provide loan for working capital, whatever the loan we have taken, that loan also we may not pay, sir. మేము అసలు పే చేయలేమన్నారు. సో లోన్ ఇవ్వాలి అని బిజినెస్లు, ఇవ్వలేమో అని బ్యాంక్స్, వీళ్ళిద్దరి మధ్య వచ్చిన కాంట్రడిక్షన్, ఇన్ ఆర్డర్ టు రిజాల్వ్ దే అపాయింటెడ్ ఏ కమిటీ. దట్ కమిటీ is called Tandon committee. This committee recommended 3 approaches. What are they? 75% of current assets minus current liability. Method 2, 75% of current assets minus current liability. Method 3, 75% of current assets minus core current assets. So this is the way to find it out, this one. And basing on this also, I done a problem. I want to, here this is the working capital maximum permissible bank finance. What is the method 1? 75% of current assets minus current liability. You see, maximum bank borrowings, here maximum bank borrowings permissible bank method under 1 and 2. This is the problem. We have to calculate raw material is 400, work in progress 40, finished goods 160, receivable holding period is 100, other current assets 20, total is 170. Whereas creditors 200, current liability is 100, bank borrowings is nothing but 400. Here is how much? 700. Assume core current assets are 190. Balu sir, what is mean by core current assets? Core current assets means those assets which would be, there won't be any type of loan to be provided for that core current assets. చూడు, ఒక ఎక్స్ ఇస్ అ డాక్టర్, ఒక డాక్టర్ ఉన్నాడు అనుకో, వాడు ఒక హాస్పిటల్ పెట్టుకోవాలి, వాడికి వర్కింగ్ క్యాపిటల్ కావాలి. హలో, వర్కింగ్ క్యాపిటల్ ఎంత కావాలి అంటే 40 lakhs కావాలి, లోన్ ఎంత కావాలి అంటే 40 lakhs కావాలి అన్నాడు. ఈ वर्किंग कैपिटल कितना चाहिए भैया आपको? 40 lakhs. भैया वर्किंग कैपिटल कितना चाहिए? 40 lakhs. लोन कितना चाहिए? 40 lakhs. भैया आपका कंट्रीब्यूशन क्या है? नहीं है सर, आप लोन दीजिए सर, मैं बिजनेस रन करता हूँ. मीन्स व्हाट द बैंक से, అరే డాక్టర్ అయిన తర్వాత రూపాయినా ఖర్చు పెట్టుకోవాలరా అంటారా లేదా? ఆ రూపాయినా ఏమంటారు? కోర్ రూపాయి అంటే రూపాయి అంటారా? దట్ ఈస్ కాల్డ్, వాట్ ఇస్ ఇట్? core current assets means that minimum proportionate amount that should be financed by the business from its own pocket. Okay, that is, here you have to consider method 1. What is the point of method 1? 75% of current assets minus current liability. 75%. Current assets is how much? 740. Current liability, you should exclude what is that? Bank borrowings. Why? Because we are going to calculate which one? Bank borrowing itself. In such a case, 740, here current assets is how much, Maji? Here it is. 740 minus current liabilities 300. How much it is to be? 330. But already here 330. So net amount maximum permissible bank finance వాడికి ఇవ్వాల్సిన ఎంత 330. బట్ ఆల్రెడీ తీసుకున్న లోన్ ఎంత 400. సో హౌ మచ్ నెట్ అమౌంట్ టు బి గివెన్ మైనస్ ఇట్ ఈస్ నాట్ ఆల్రెడీ ఎక్సెస్ కదా. ఎలిజిబుల్ అమౌంట్ ఈస్ హౌ మచ్ 330. బట్ దిస్ మ్యాన్ ఆల్రెడీ టేకెన్ 440. So could they provide? Not possible to provide. This is the first method. Second method, 75% of current assets minus current liability. 75% of 740 minus 300. How much? 225. So net amount already 225 he has to eligible, but already he has taken loan amount of how much? 400. So could they provide loan? Not possible. Are you getting? Next one, 75% of current assets minus core current assets minus current liability. 75%, 740 minus 190 minus 300. How much to be given? 112.5. But already has taken 400. So scarcity would be 287.5. So it is not at all possible to provide. Are you getting? So this is the procedures to calculate, what is it? Maximum permissible bank finance. Next, you have to understand what is it? Double shift. So double shift means completing an additional work, right? See, double shift means undertaking an additional work within given time period. So is nothing but double shift. For example, Polavaram, all this project comes under what is that? Double shift itself. There is a biggest project should be completed. Here you see double. You will take a sugar industries. Have you seen sugar industry? This is sugar industry. When sugar canes are extraction, you see he is the manager. How many sugar vehicles are there here? If they will continue every day one means, could it possible? Immediately what happened? You have to undertake what shift? Double shift. This is the China, one of the dam they constructed. You see how much of big wheel they used. And here it is our Polavaram. Here you see how much big wheel we are using. Okay. Within how many days it may complete? మీరేం కంగారు పడద్దు. మీరు CMA అయ్యి అకౌంటెంట్లు అయ్యేంత వరకు అది ఉంటుంది. ఇక్కడ చూసారు ఎంత పెద్ద వీలో అలా మూవ్ అయితే ఇంత వర్క్ కంప్లీట్ అయిపోద్ది. మన వాళ్ళు మాత్రం ప్రశాంతంగా చేసుకుంటున్నాం. మనం ఎందుకు సార్ తొందర? See how much of big wheel they will be using. Okay. Okay. Yeah. Nidaname pradhanam. That is, but once they undertake a double shift, what happen? They have to spend much amount. So double shift, when we undertake double shift, what is the impact will happen, right? Why the corporate company go for double shift means they complete the task within the given time frame. And to produce what is it? More number of units. And sometimes when you undertake any activity at a large scale, we will get what is it? Economies. And sometimes we will get what? Fixed cost advantage. So if you undertake any activity at a large scale, what are the benefits we are going to get it? Cost per raw material is going to be what happen? Decreases. Hello? Here you see. Can you tell me what is the impact? Raw material price, what happens? Raw material price. Comparing to single shift raw material price, double shift raw material price, what happen? Decreases because you are buying, what is it? More, right? Another one is work in progress will remain same, because whatever the time period in which you are going to complete a task, within the given task you are completing, within the given time period you are undertaking one more task. That means whatever the work in progress will applicable to the given time period, right? That would be applicable for another shift. In such a case, there is no additional work in progress should be required if you undertake what is that? Additional. Are you getting? That is the work in progress. See, no change in what is that? Quantity of work in progress. Why? Because within the given time frame you are undertaking the same. Next, finished goods. Finished goods may increase, right? ఎందుకు increase అవుతుంది? When you undertake double shift, you will produce more number of units. When you produce more number of units, your stock of finished goods may increase. Then sundry debtors also increase. When you produce more, you have to sell more. Hello? When you want to sell more, automatically your investment on debtors also increases. Creditors also increases, because when you are producing more means they will provide you more credit period. Theoretically in CMA they used to ask this one. Then coming to the next point, double shift period. Thereafter, optimum cash management models. Hello? Optimum cash management models. How many models? Baumol model. What is the optimum cash? Optimum cash means sufficient cash. What is that? Sufficient or required cash balance. Required. Okay. So sufficient or required cash balance is optimum, needed, required, sufficient. Such a cash is called optimum cash balance. So in order to maintain this optimum cash balance, there are two models came. What are they? Baumol's model, Miller model. Baumol's model is based on assumption that future annual cash requirement is well known in advance. Here Baumol model should identify every company has to maintain cash in such a way that where transaction cost equal to opportunity cost, with effect the total cost would be least. So they identified optimum cash balance equal to square root of 2ft divided by r. At this balance, what is it? Transaction cost equal to what cost? Opportunity cost. With effect total cost would be very, very low. So every company should maintain only this balance. For example, here optimum cash balance is 40 lakhs. What do you mean of this 40 lakhs? Tell me. If company maintains more than 40 lakhs, is it favorable, unfavorable? Unfavorable. If the company maintains only 40 lakhs, favorable. So if the company maintains more than 40 lakhs, in such a case, what happen? Opportunity cost increases, transaction cost decreases, with effect the total cost increases. Whereas if the company maintains less than this, transaction cost increases, opportunity cost decreases, with effect the total cost increases. So company has to maintain sufficient required cash, that is called optimum cash balance. Optimum cash balance equal to square root of 2ft divided by r. This theory is based on assumption that future annual cash requirement is well known. And another one is Miller cash model. Miller cash model assumption that future annual cash requirement never be known in advance, where the company has to maintain cash like a levels of cash. What is it? Levels of cash. If any business starts its transaction, then automatically his cash balance what happens? Changes. For example, X is a person who started a business and he commenced with a ML, means minimum level. What is that? Minimum level of cash balance. With a minimum level, he undertook the transactions. So cash balance what happened? Increases. At one point of it touches highest level. This is called highest level. Then automatically he has to recognize that we have a more cash. Then he has to sell or not sell. He has to invest in marketable securities. Unna dabbuni em cheyali? Marketable securities lo investment cheyali. So that the cash balance should reach to what level? Return level and inkoka level better. What level ma? Return level. Are you getting? This is the highest level. This is minimum level. This is the return level. 3 levels. ఏం లేదు, వెరీ సింపుల్. మన టీవీలో అప్పుడు స్టెబిలైజర్ ఉంటుంది కదా, స్టెబిలైజర్ ఉంటుందా లేదా? స్టెబిలైజర్ నథింగ్ బట్ హై వచ్చినప్పుడు ఏం చేస్తాడు? టక్కన ఆగిపోద్ది. అయితే ఇందులో కూడా ఆగిపోయింది కదా, అదే బొమ్మలు తెరి. అదే తక్కువ ఉన్నప్పుడు అరుస్తూ మెయింటైన్ చేసింది కదా. సో హియర్ యూ హ్యావ్ టు మెయింటైన్ క్యాష్ లైక్ ఎ హై లెవెల్, low level and minimum level, like a circuits. If cash balance touches highest level, you recognize that what happened? Your cash balance is very, very high. Immediately what happened? You have to reduce. If the cash balance, how much to reduce? Again you need it, because so that your cash balance should reach to return level. Thereafter, if the cash balance comes to what level? Minimum level, you have to sell the security so that you should reach to return level. Sir, highest level, lowest level touch cheyakunda unte sir, you has to hold the cash balance. Are you getting? This is Baumol theory. Baumol theory ki Miller theory ki difference. Baumol theory is based on future annual cash requirement is well known in advance. Miller theory, future annual cash requirement never be known in advance. Baumol theory expresses that optimum cash balance in amount. Miller theory expresses that optimum cash balance not in amount, it is in levels. There he projected three costs: transaction cost, opportunity cost, total cost. Here he projected three levels: minimum level, return level, highest level. Hello? Highest level equal to 3Z plus L. What is it? 3Z plus L. Return level equal to Z plus L. Minimum level generally used to hold. Sir, what is a Z? Optimum transfer of cash balance. What is it? Optimum transfer of cash balance. Optimum transfer of cash balance equal to cube root of 3TV divided by 4I. What is it? 3TV divided by 4I, where T represents transaction cost, V represents daily cash variance, I represents what is it? Rate of interest. Theory marks ki 2 to 3 marks ki compulsoryga theory point adugutunnadu. That is the reason I hold it. Okay. Then you have another one is what is it? Debtors management. What is the debtors management? Debtors management means systematic management of book debts. Systematic management of what is it? Book debts. Book debts. So debtors management is a systematic management of book debts. Why a company has to provide what is that? Book debts. So if a company wants to market leader, or if you want to make more profit, company has to do what is it? More sales. Yes or no? More sales. More sales if you want to make it means you have to provide more credit period. Yes or no? More credit period if you give it, there is a problem of what is that? Bad debts. Hello? There is a problem of collection cost. There is a problem of what is that? Opportunity cost loss. So if you want to enjoy the profit, you have to ready to face what are they? Opportunity cost, collection cost. By considering this, what happened? You have to manage this one. ఎక్కువ ఉండడం తక్కువ కాదు, తక్కువ ఉండడం. సార్ అయితే ఓ పని చేద్దాం, మనకి ఎందుకు సార్ క్రెడిట్ సేల్ వదిలేద్దాం అన్నా మనకు అప్పుడు ఆటోమేటిక్లీ యూ నెవర్ గెట్ వాట్? ప్రాఫిట్. సార్ నాకు మోర్ ప్రాఫిట్ కావాలి, అప్పుడు ఎక్కువ క్రెడిట్ పెడు. అమ్మ బ్యాడ్ డెట్స్ కలెక్షన్ కాస్ట్ అయితే అరే అతి వద్దు. అరే గట్టి. సో ఎక్కువ క్రెడిట్ పెడు వద్దు, తక్కువ క్రెడిట్ పెడు వద్దు. యూ షుడ్ ఏబుల్ టు మేనేజ్. దట్ ఈస్ కాల్డ్ వాట్ మేనేజ్మెంట్? Debtors management. Okay, debtors management is what is the credit policy of the company. In debtors management, every client comes to your office whether it is worthwhile to offer credit period or not, right? Credit policy means to know whether is it beneficial to offer credit period or not. Credit period or not. This is the most important point every corporate company wants to evaluate. So whether if you give credit period, what happens? Whether if you can't give credit period, what happens? You should able to identify this one. You see, credit period. This man is worrying. He is Mr. Subbarao. He came to my office and Subbarao is worrying a lot that what to do. And I asked Subbarao, what is your problem? Benefit for offering credit period. So business has object to make what is it? More profit. More profit if you want to get it, more sales. More sales if you want to get it, more credit sales. More credit sales you want to get it, more credit period. More credit period leads to more debtors. More sales leads to more credit period leads to more debtors leads to more profit. Sir, thank you sir. Thank you very much. ఒక్క పక్క ఇంకొక పక్క కూడా ఉంది, అది కూడా చూడు. ఏంటది? If you give credit period, what cost? Collection cost, administration cost, bad debts, cash discount, opportunity cost. ఇప్పుడు సోలు. This is the problem. Sale చేద్దాం వద్దా? More profit, more cost. More profit, more cost. More profit, more cost. So that is the reason we expect that sir, ప్రాఫిట్ ఇస్ దేర్, కాస్ట్ ఇస్ దేర్. సార్ దాన్ని ఎలా సార్ అడ్జస్ట్ చేసేది అని చెప్తాడు. దానికోసం మనం క్యాలిక్యులేట్ చేసేదే ఇవాల్యుయేషన్ ఆఫ్ credit policy of the company. This would be two types. For example, if a client asks only 30 days credit period, we will evaluate. Hello? If the client asks, iddar ravachu. For example, if you people, intavaraku meeku nenu, so far I could not give any credit to you, but you people came, you are expecting only how many days? 30 days. So 30 days credit period అడిగారు అనుకో, 30 days కి ఇచ్చారు అనుకోండి, దాన్ని ఏమంటారు? 30 days. అదే ప్రపోజ్డ్ 60 days అడిగితే 60 days. Ante if you ask 30 days, I have to evaluate 30 days. There would be another client, they may come, what is that? 30 days I already offered and expecting, what is that? 60 days. In such a case, what happen? I should expect more, right? For that purpose, what happen? We have to take a expected credit period. 30 days ki enta benefit to, 60 days ki enta benefit to, I will compare the both. For example, sales, less, what is it? Variable cost, we will get the contribution, less, what is it? Fixed cost, less bad debts, cash discount, you will get it, less collection and administration cost. Next you will get, what is it? PBT. దీంట్లోంచి tax పోతే how much you will get it? Profit after tax. You take the sales, once again tell me, sales minus variable cost, you will get the contribution, less fixed cost, bad debts, cash discount, less collection cost, PBT, less tax, then you will get the PAT. PAT would be here 40k, here 80k అనుకోండి, then it would be good kada. But directly we cannot give an approval now itself. We have to find it out what? Opportunity cost. Opportunity cost can be calculated on what basis? Sales based and cost based. Sales based means credit sales divided by 360 into debtors collection period into opportunity cost rate. Cost based means total cost divided by 360 into debtors collection period. In such a case, present policy 30 days, 60 days. Let us take net benefit. You got it how much? 150 lakhs. Here you got it 5 lakhs. Now incremental benefit would be 3,50,000. In such a case, what to do? It is beneficial to what? 60 days could be provided. Are you getting my point? ఇప్పుడు అడిషనల్గా ఇక్కడైతే 1,50,000 days, ఇక్కడ 5 lakhs ఎక్స్ట్రా బెనిఫిట్ ఎంత వచ్చింది? 3,50,000. ఇప్పుడు ఏం చేయొచ్చు? క్రెడిట్ పీరియడ్ ఇవ్వచ్చా లేదా? ఇలా కన్సిడర్ చేయాల్సి ఉంటుంది. ఓకే, వాట్ ఎలా తీసుకోవాలి? ఫస్ట్ ఎక్స్పెక్టెడ్ ప్రాఫిట్ తీసుకోండి, తర్వాత ఆపర్చునిటీ కాస్ట్. ఫ్రమ్ దట్ ఏ ఇఫ్ యూ డిడక్ట్ బి యూ విల్ గెట్ ద సి నెట్ బెనిఫిట్. నెట్ బెనిఫిట్ ఈస్ పాజిటివ్, that you can go with, what is it? Suppose here 1,50,000 came. In such a case, ఏదైనా ఒకటే కదా. No 30 days 1,50,000, 60 days 1,50,000 means both are giving, what is it? Same. If it is a 50,000, at a present by 30 days you are getting 1,50,000. By offering 60 days, how much you are going to get it? 30 days, right? It is a better to give 30 days if the company able to generate how much? 1,50,000. Got it, ma? Right. Basing on this, we have a problem to be solved. Let us, where is our material? Here you see. Simple problem. XYZ Corporation considering relaxing present policy and the process of evaluating two proposed policy. Currently the firm has annual credit sales of how much? 50 lakhs and accounts receivable turnover is 4 times. 4 times means in a year they are generating sales how many times? 4. Up to 12 divided by 4. Current credit period is how much? 3. ఒకవేళ 3 అయితే 4 months కదా. 4 times means how much of credit period you are giving? माजी 4 times means 4 months. कैसे आएगा? 12 divided by 4 कितना months होगा? 3 months. 12 divided by 3, 4 months. 12 divided by 2.4, 5 months, right? Bad debt loss 1,50,000, 3 lakhs, 4,50,000. Now you can evaluate. You see present proposed policy. Present how many months? 3 months. Proposed policy 1, 4 months. Policy 2, 5 months. Expected profit sales how much? 50 lakhs. Here 50 lakhs, 60 lakhs, 67 lakh 50,000. Less variable cost. How much percentage? 75%. So 35 lakhs, 75% means 50 into 70, 35 lakhs, 60 into 70, 42 lakhs, 67 lakh 50,000 into 70, 47 lakh 25,000. Contribution would be 15 lakhs, 18 lakhs, 20 lakh 25,000. Less bad debts 1 lakh 50, 3 lakhs, 4 lakh 50,000. Now you got the PBT 13 lakh 50,000, 15 lakhs, 15 lakh 75,000. Next opportunity cost. Opportunity cost can be calculated in 2 ways. What are they? Sales based, cost based. Here total cost. Total cost divided by 12 into debtors collection period. Total cost. In the problem, what cost is not given? Fixed cost is not given. So fixed cost is not given. That is the reason you can take 35 lakhs. Variable cost is the total cost. Hello, Maji. So variable cost 35 lakhs divided by 35 lakhs into opportunity cost rate is how much? Maji, debtors collection period how many months? First policy 3 months, you know. So total cost into 25% divided by 12 into 3. Actually, they should not write like this. What they have to write? 35 lakh divided by 12 into 3 into 25%. 2 lakh 18,750. What about here? This would be. Arey, kya re? Here, Maji. 42 lakhs into 4 months divided by 12 into 25%. 3 lakh 50,000. 47.25 lakhs into 5 into 12 divided by 5 into 25%. How much? 4 lakh 92,188. So net benefit would be 11 lakh 31,250 here, 11 lakh 50,000 here, 10 lakh 32. But comparing to present policy, you have a benefit of how much? 18 lakh 70,000. Comparing to second policy, it is negative. So what is your observation? It is beneficial to, since proposed policy 1 must be implemented because it gives incremental net benefit amounted to 18,750. So this is the way to understand what is that? Factory means a debtors management. Okay, debtors management is a systematic management of book debts. Okay, with this working capital major areas, debtors management, working capital estimation, operating cycle is completed. 1 minute. Have you brought a hard copy of this material? You have any? Well, what is the next chapter left, ma? Risk is there, you know. Risk and return. See, risk and return. Risk analysis in capital budgeting. You see, this man is walking on rope, right? And walking on rope, but he is taking risk, right? But having a stick, he is balancing risk, right? So risk we should not worry. Risk what we have to do? We have to manage. That is called risk analysis in investment decision, or technically called what? Risk and return. What is the generally risk indicates? It indicates that every business has, where is our material here? CMA, here it is. Risk return. Here, risk and uncertainty. It indicates, you see, risk and uncertainty. There are 3 decisions. Simply, every financial, while taking investment decision, we people believe that, see, while taking any investment decision, we people believe that there is no risk. But actually, without risk, we will estimate any project, then it would be very, very risky one. Generally, any corporate company undertakes decisions would be in 3 ways. What are they? Decision making under certainty, decision making involve risk, and decision making under certainty, uncertainty involving risk. Certainty, ante, for example, X is a person, she came to my office. Nulema. She is a CMA specialist. I went to office and I said that, madam, I need this project to be evaluated. She calculated and said NPV positive. Go, let's celebrate. Then I said, ma'am, you are calculating E, means now, hello, execution would be 1 time, hello. So T is not, means evaluation time is different from execution time. Hey, try to understand. E is not E, hello. E is not E. At the time when you are evaluating, this time is different. When I am going to execute, another time is different. Meanwhile, cash flows will change, you know, ma'am. If I ask means, if she says that no, then it is that she is taking everything, what is it? Certain. Then next time I never go to his office. Why? Because I know that she is bluffing. Are you getting? Are you getting? So no. Assala inte jarugud sir. Anindanuko assal namo danne emantaru certainty antaru. ఇంకొకరు ఏంటంటే ఐ డోంట్ నో సార్ అంటే ఇంకెప్పుడు వెళ్ళను, ఎందుకంటే తెలియదు కాబట్టి. ఫస్ట్ అయితే నాకు తెలుసు అంటే నమ్మను, ఎందుకంటే నాకే తెలుసు అంటే నేను నమ్మను కాబట్టి. నాకు తెలియదు అంటే ఈసారి కూడా అనలేం, ఎందుకంటే నీకు తెలియదు కాబట్టి. దెన్ రిస్క్ మీన్స్ వాట్ ఇస్ దట్? ఓకే బాలు సార్, వీ విల్ మేక్ ఇవాల్యుయేషన్ మీన్స్ we will take the data, whatever the business you are doing, we will collect all the information and we will measure that risk, and basing on we will take a decision అన్నాం అనుకోండి, that is nothing but involving risk. So whatever the cash flow we will expect, if certainly it is going to arise means a certainty, it's wrong. It is never happens uncertainty, whereas it may chances to have to generate or not to generate, it includes what is that? Risk. Risk ante enti? What is a risk? Risk indicate uncertainty of return. What is that? Uncertainty of return. You should understand risk is what is that? Measurable uncertainty. Uncertainty is unmeasurable risk. Are you getting? This is the point. Here a project you have to estimate various types of risk. Project specific risk, competitors risk, market risk, risk due to economic condition, company specific risk, international risk, industry risk. These are the certain points which make you to understand what is that risk. వీటి వల్ల రిస్క్ వస్తుంది. కాంపిటీషన్ రిస్క్, జియో ఆయా, టాటా డోకోమో గయా, వాట్ రిస్క్ ఇట్ ఈస్? కాంపిటీషన్ రిస్క్. జియో రాకముందు ఎన్ని కంపెనీలు ఉన్నాయి? జియో వచ్చింది, సబ్ కుచ్ చలా గయా, విచ్ ఈస్ కాల్డ్ వాట్ ఇస్ దట్? కాంపిటీషన్ రిస్క్. మార్కెట్ రిస్క్. మార్కెట్ రిస్క్ మీన్స్ in the market you cannot sell in that product. Such a risk is called what is that? Market risk. Risk due to economic conditions. Risk due to economic conditions means because of corona pandemic, income level of the people what happened? Decreased. They cannot spend much money on what is that? Sophisticated or cosmetic products. That would be economic condition. Industry specific risk. Film industry has the biggest risk because of OTT. Hello? OTT వల్ల ఈరోజు ఈ రిస్క్ ఉందా లేదా? అలాగే ఇంటర్నేషనల్ రిస్క్. చైనాకి మనకి పళ్ళ టిక్టాక్ని బ్యాన్ చేసాం, ఏం రిస్క్ అది? ఇంటర్నేషనల్ రిస్క్. టిక్టాక్ కూడా ఏమనుకుంటాడు, నేనేం చేశాను సార్ అంటాడు. పోరాపో, చైనా వాడికి నాకు పడదు సార్, మీకు చైనాకి ఇంటర్నేషనల్ రిస్క్ సార్, వాట్ షుడ్ ఐ డూ సార్? దట్ రిస్క్ ఈస్ కాల్డ్ వాట్ రిస్క్? ఇంటర్నేషనల్ రిస్క్. Project specific risk. Project specific risk means, for example, a company undertaking multiple projects, one project exclusively may fail. Such a risk is called what is that? Project specific risk. Then company specific risk. Company specific risk means it's not the industry, it belongs to only concerned company. That concerned company, whatever the products it will produce, it may affects. Like this, competition, market risk, risk due to economic condition, industry specific risk, international risk, company risk, all these risks are there. ఇవేమి లేకుండా సర్టనిటీ సార్ అంటే ఎలా కుదురుద్ది? సర్టనిటీ అంటే ఏమని అర్థం? వీటి గురించి నీకు తెలియదు అని అర్థం. అన్సర్టనిటీ అంటే రాదు అని అర్థం. ఇవన్నీ తెలిస్తే యూ టేక్ పెన్ అండ్ పేపర్ అండ్ యూ విల్ మెజర్. సో వీ హ్యావ్ టు మెజర్ ద రిస్క్. దేర్ ఆర్ డిఫరెంట్ టైప్స్ ఆఫ్ టెక్నిక్స్ వీ కెన్ యూజ్ ఇట్. Risk measurement techniques in our material. What are the various risk measurement given? Probability, here they given. Expected cash flows. First one they given variance, standard deviation. What is that? Risk adjusted discount rate. Thereafter, what the method? Certainty equivalency approach and total return. This is the general return to be generated. Average annual return, expected rate of return, then risk and return. This is the points which is given. First you should understand first method what they given ma. Ikkada em methods ledu. I will tell you this methods. I made it some little bit notes. Here you have to understand risk method measurement techniques being classified into how many types? 3 types. One is statistical techniques, probability, variance, standard deviation, coefficients of variance. Conventional techniques, risk adjusted discount rate, certainty. Other techniques are there. These are what is that? Eliminated. This is called what is that? Sensitivity analysis, scenario analysis, simulation, decision tree. Sir, even this is risk. Very simple. ఇప్పుడు మా ఫ్రెండ్ ఒకడు ఉన్నాడు, వాడు వందే భారత్ ట్రైన్ ఉంది కదా, దానికి ఆ ట్రైన్ డ్రైవర్గా సెలెక్ట్ అయ్యాడు అనుకో. సెలెక్ట్ అయ్యాడు యాక్చువల్గా. వాడికి ఒక ట్రిప్ ఇవ్వాలి, వాడికి ఇస్తారు. ఇప్పుడు వాడు పరిగెత్తుకుంటూ వెళ్ళి వాడితో పాటు 8 మంది సెలెక్ట్ అయ్యారు. వాళ్ళందరూ వెళ్ళి సార్ నాకు ఒక ట్రైన్ ఇవ్వరా, ప్రాక్టీస్ చేసుకుంటానంటే ఏం మాట్లాడుతున్నావు సార్, నాకు ఒక ట్రైన్ ఇవ్వండి సార్, నేను ప్రాక్టీస్ చేసుకోవాలి కదా సార్ అంటే, చూడు ఒక ప్లేయరు ఒక బ్యాట్ ఇవ్వండి సార్ ప్రాక్టీస్ చేసుకుంటామంటే ఇవ్వచ్చు. మా పాప కీబోర్డ్ వాడిస్తుంది, డాడీ కీబోర్డ్ ఇవ్వండి ప్రాక్టీస్ చేసుకుంటామంటే ఇవ్వచ్చు. సార్ నాకు వందే భారత్ ట్రైన్ ఇవ్వరా, ఒకసారి తెనాల నుంచి గుంటూరు దాకా అలా వెళ్ళి ఇలా వచ్చేస్తాను అంటే, ఒకడు 10 మంది వస్తే 10 మందికి 10 వందే భారత్ ట్రైన్లు ఇవ్వాలంటే కుడ్ ఇట్ పాసిబుల్? ఇంకా నయం వాళ్ళు పైలట్ లేవాలా,
ఒకడో కూడా వచ్చి సార్ నాకు ఒక విమానం ఇవ్వండి, అరంగల్ పెడదాకా పోయేసి వస్తాను అని అనుకో, కుడ్ ఇట్ పాసిబుల్? మరి దెన్ వీ హ్యావ్ టు సాల్వ్ దట్ ఇష్యూ, రైట్? That problem also you have to issue. Then how they will make a simulation. That is the last technique. And the decision tree, scenario analysis, all these things are wonderful here. We will identify probability. First of all, we will understand what is a probability. Probability means chance of occurrence of an event. What is that? Chance of occurrence an event. We will take 10 data and we will identify 10 times how much happened. For example, today, Chennai match, Chennai Super Kings versus Mumbai Indian match is there. Somebody, okay lera, నాకు తెలియదు అసలు, నేను చూడనటువంటిది. Chennai and Mumbai Indians are playing. If somebody asks, sir, who is going to win means, so నువ్వు చెప్పింది అనాలిసిస్, ఎమోషన్ చెప్పావు. ఎమోషన్ నెవర్ బి గివ్స్ వాట్ ఇస్ దట్ మనీ. ఫర్ ఎగ్జాంపుల్, ఐఎమ్ గోయింగ్ టు మేక్ ఎ బెట్టింగ్ ఆన్ చెన్నై వర్త్ ఆఫ్ 40 crores. నేను నీ దగ్గరకు వచ్చి నువ్వు ఇంత ఫాస్ట్గా చెప్పావు అనుకో, నేను సర్వనాశనమేగా. అప్పుడు నువ్వు నాకు ఏం చెప్పాలి? నేను ఇన్వెస్ట్మెంట్ చేస్తున్నాను నువ్వు మాట మీద, ఎవరు గెలుస్తాడు టక్కని చెప్పేసావు. నీ దగ్గర బేస్ ఉందా? ఏం లేదు. వాయిస్ ఉంది, ఎందుకు పనికిరాని వాయిస్? అవునా? ఇన్ఫర్మేషన్ ఓరియంటెడ్ బేస్ వాయిస్తో చెప్తే ఎస్ వర్త్. హౌ డూ యూ ఫైండ్ ఇట్ అవుట్ మీన్స్, సార్ 1 minute సార్, India versus Mumbai versus Chennai from past 10 years, 10 matches data we will take, sir. From the 10 match, what happened, who won, who toss evaru, batting evaru, by considering all these things, if you expect, that would be called, what is that? Probability. The probability means chance of occurrence of an event. Here, basing on this, you have first thing, most important point is, you have to consider first one, expected NPV. What is that? Expected NPV. What is expected NPV means? Morning class we discussed NPV, right? Here we used to discuss what is that? Expected NPV. Here it is the NPV which is estimated basing on expected cash flows, but not cash flows. Balu sir, what is the difference between cash flows and expected cash flows? Cash flows multiplied with the probability is called, what is it? Expected cash flows. By taking that expected cash flow, if you calculate NPV, then it is called, what is that? Expected NPV. Are you getting ma? Here, certainty, risk adjusted variance is given, probability. Here expected cash flow, up to here they given expected cash flow, but they could not give, what is that? NPV. What is the expected cash flow? How do you calculate expected cash flow? The cash flows into probability is called, what is it? Expected. By taking that cash flows, if you calculate NPV, such a NPV is called expected NPV. You see, it is the NPV which is estimated from what cash flow? Expected cash flow. This NPV is considers risk impact of the project. You see here, there is a problem. Here events are there, A, B, C, D, E. Cash flows the company able to generate. Cash flows into probability. If you multiply, you will get it, what is that? Expected cash flow. Basing on that expected cash flow, if you calculate NPV, such a NPV is called what NPV? Expected NPV. Actually, it is not in your syllabus, okay? But I am explaining what is I explained what is a expected NPV. Tell me what is expected NPV? It is the NPV which is estimated from expected cash flow. Are you getting? Right. Here, and another method which is given in your material is standard deviation coefficients of variance. We will come. Here, risk adjusted discounting rate. What is that? Risk adjusted discounting rate. See, risk adjusted discounting rate, profit is reward of what taking? One of the basic identity. Profit is reward of risk taking. When you take more risk, more. You see, maximum, my standard is nothing but I identified there are certain chapters are core important. For that complete information I gave it. These are what is that? Very, very less weightage. Hello? You cannot expect even question from this area. But the thing is, for this purpose only I am identifying. Because time is very, very less. That's why I am not writing. Okay? But I alternatively made it all these things. Now you see, risk adjusted discounting rate. What is a golden rule? Profit is reward of what taking? Risk taking. A person who takes more risk, he deserves to get what? More profit. That is the point. For example, let me share you one information. Mr. Subbarao, he took the loan from Bradipet. So here SBI Bradipeta, he took the loan, and with the loan he took the flight, and he took the, what is that? He went to South Africa,
From South Africa to, from here to, from there to, with the ship he came to, you are doing business here. By chance అనుకోండి. ఇప్పుడు SBI బ్యాంక్లో వాడు తీసుకున్న లోన్ 10% అనుకోండి. NPV at a 10% valuation is not good. Why? Because he is taking this much of risk, right? He should expect more than 10%. This 10% is called, what is that? Risk-free rate. Plus you have to add what? Risk premium, at least 5%. 10% actually he has to pay, 5% he has to take in a risk. 10 plus 5, how much? 15%. By taking 15%, if you evaluate the project, that project is called, what is it? If that project is positive at the concern rate, that is called, what is it? Risk adjusted discount rate based NPV. What is that? Risk adjusted discount rate based NPV. Morning class we took the NPV, but we took 10%. But here we have to take, what is it? Risk adjusted discount rate NPV. For example, I want to do business at Iceland. ఇక్కడ వెళ్ళి ఒక ఇండస్ట్రీ ఎస్టాబ్లిష్ చేయాలనుకోండి. ఐ టుక్ ద లోన్ ఫ్రమ్ ఎస్బీఐ నుంచి ఒక ఫ్లైట్ వేసుకొని అంటార్కిటికాకి వెళ్ళి ఇక్కడ ల్యాండ్ అయ్యి ఇక్కడ నుంచి నడుచుకుంటూ వచ్చి ఇటు ఇక్కడికి వచ్చి ఇక్కడ దిగి ఇక్కడ వచ్చి కాఫీ తాగి ఈ బిజినెస్ స్టార్ట్ చేయాలనుకో. ఇఫ్ 10% NPV అనుకో, కుడ్ ఇట్ పాసిబుల్? ఐ షుడ్ ఎక్స్పెక్ట్, వాట్ ఇస్ దట్? మోర్. ఐ షుడ్ ఎక్స్పెక్ట్ ప్లస్, ఎంతకు మించి ఎక్స్పెక్ట్ చేయాలి. దాన్ని రిస్క్ అడ్జస్టెడ్ డిస్కౌంటింగ్ రేట్ అంటారు. ఫర్ ఎగ్జాంపుల్, ఇఫ్ యు ఆర్ స్టూడెంట్ ఆఫ్ BA, నో నీడ్ టు టేక్ దిస్ మచ్ ఆఫ్ రిస్క్. సమస్య అంతా ఏమైంది? ఇక్కడ CMA చదువుతున్నాం, మార్నింగ్ వచ్చావు, ఇప్పటిదాకా నాన్ స్టాప్గా చదువుతున్నావా? ఎస్ఆర్ నో, యు ఆర్ టేకింగ్ రిస్క్. మరి ఫ్యూచర్లో మీకేం రావాలి? రిటర్న్ కావాలి కదా. CMA కంప్లీట్ చేయండి, పర్ మంత్ 15,000 అంటే ఈ రోజున పోసి తగలు పెడదాం అని చెప్తాను. ఎంతసేపు చదివామరా? అవునా? 15,000 అడుగుతాం అంటే రస్కెల్ అంటాం. సో దట్ ఈస్ యు ఆర్ టేకింగ్ మోర్ రిస్క్, యూ డిజర్వ్ టు గెట్ వాట్? మోర్ రిటర్న్. దట్ ఈస్ a risk adjusted discounting rate. Here risk adjusted discounting rate, if you observe the problem, there is a small problem is given. Here you see, we can take, here is very simple problem, we took it. In this problem, this is the problem number 5. Here you see, simple one problem. DLF company this is the problem, I took it from not CMA, CA. That's directly I took it towards CA final, because this problem gives best indication. Okay. So cost of this project is how much? 15 lakhs. Year 1 is how much? 6 lakhs. Year 2 6 lakhs. Year 3 6 lakhs. Year 4 6 lakhs. Here what is that? Risk index. Risk index means beta. Beta is 1.80. Already morning class we discussed the CAPM approach. As a beta is greater than 1, risk element also huge. Hello? Now you tell me, minimum required rate of return is 15%. Applicable tax rate is 40%. Risk free rate of interest is 10%. Find out risk adjusted discounting rate. Risk adjusted discount rate indicate risk adjusted discount rate or KE equal to, what is the formula? RF plus beta into, this is nothing but RM minus RF. In such a case, you see here is beta is how much? 1.5. Risk free rate is 10%. RM is 15%. According to CAPM approach, KE equal to risk adjusted discount rate RF plus beta RM minus RF. So risk adjusted risk free rate is 0.10, 1.8, 0.15 minus 0.10 into 100. How much percentage? 19%. Now this time compute risk adjusted NPV. Now you have to calculate NPV, means by taking what rate? That risk adjusted discount rate of how much? 15%. Now if the project is good at 15%, 19%, then only this project is worthable to undertake. Now cash flows, initial investment 15 lakhs, 1 to 4 years 6 lakhs. Every year same cash inflow, same cash inflow means we will take, what is it? Annuity. So 19%, 4 years. So 2.639 into 6 lakhs, you will get it how much? 15 lakhs 83,400. NPV equal to how much? 83,400. Now tell me, since NPV is positive, this project should be accepted. What is the highlight of this project? Here we could not take just risk rate. Hello? We took, what is it? Risk adjusted discounting rate. We evaluated project basing on risk adjusted rate. At that risk adjusted rate also NPV is positive. So project should be accepted. Right. The next one in our material, what is the point is given is, where it is, here it is. risk adjusted discount rate. Thereafter, what is it? Certainty equivalent approach. What is it? Certainty equivalent approach. You see, just now I discussed expected cash flow. Expected cash flow equal to cash flow into probability. If you multiply, you will get it. What is it? Expected cash flow. Okay, cash flow into CE factor is there. What is it? CE factor. CE factor means certainty equivalent factor. What is it? Certainty equivalent factor. Certainty equivalent factor means for every 1 rupee, certainly how much cash inflow you are going to generate is called, what is it? Certainty equivalent factor. For example, 0.50. 0.50 is a CE factor, means if you expect 1 rupee as an uncertainty, 0.50 means this uncertainty cash flow multiplied with CE factor. It means how much you are going to get it. చూడండి, CE factor is 0.50 అంటే ఏమని అర్థం అంటే for every 1 rupee of uncertain cash inflow, you are going to get certainly how much? 0.50. That is called, what is that? CE factor. అంటే 1 rupee uncertainty కి 0.50 వచ్చింది అనుకో, దీన్ని ఏమంటారు? CE factors అంటారు. Some corporation company, when they used to make more crores of rupees of investment, they never bother about probability. They will bother about, what is that? Certain. నాకు ఎంత కావాలి? సర్టెన్గా కావాలి అంటే, సర్టెన్గా ఒక ప్రాజెక్ట్లో నువ్వు ఇన్వెస్ట్మెంట్ చేసావు అనుకో, సర్టెన్గా ఎంత వస్తుంది? దట్ ఈస్ ద మోస్ట్ ఇంపార్టెంట్. ఫర్ ఎగ్జాంపుల్, ఐ వాజ్ ఇన్ రెస్టారెంట్, మై అంకుల్ కిడ్ స్మాల్ బాయ్ ఇస్ దేర్, వాడిని కూడా తీసుకెళ్ళాను. సో వీ గేవ్ వాట్ యూ వాంట్, బ్రేక్ఫాస్ట్ ఏమో కావాలంటే పూరి కావాలని అడిగాడు. పూరి వాడు తీసుకొస్తున్నాడు. ఏం పూరి కావాలంటే, సార్ మాస్టర్ పూరి కావాలి. మాస్టర్ పూరి ఇస్ బిగ్గెస్ట్ సార్, నో ప్రాబ్లం, బ్రింగ్ ఇట్ అన్న. వాడు మాస్టర్ పూరి అని తీసుకొచ్చి, ఇంత పెద్ద పూరి, ఇంత పెద్ద ఉంది. దాని వాడు ఉండి, బాలు అక్కడ చూడండి ఇంత పెద్ద పూరి ఉందంటే, నో ప్రాబ్లం, అది అన్సర్టనిటీ పూరి. వచ్చిన తర్వాత చేస్తే సర్టనిటీ పూరి వస్తుంది. అవునా? అక్కడి నుంచి చూడకో, ఇక్కడి నుంచి వచ్చిన తర్వాత చూడు. మరి ఏం చేయాలి? దాన్ని అన్సర్టనిటీ అంటారా? CE ఫ్యాక్టర్తో మల్టిప్లై చేసాం అనుకో, ఏమొస్తుంది? సర్టన్ పూరి వస్తుంది. చేస్తే ఎక్కడికి వస్తుంది? కిందకు వచ్చేస్తుంది. అప్పుడప్పుడు మమ్మీని అడిగాం అనుకో, ఏంది కర్రీ ఇంత ఇచ్చావు అంటే, ఏమైంది? వండితే ఇంత అయింది అంటది. అంటే వండక ముందు ఎంత ఉందిగా? హలో, అంతే కదమ్మా. కర్రీ ఏది అంటే ఎంత ఉంది, వండిన తర్వాత ఇంత అయింది అంటది. అంటే వండక ముందు అన్సర్టనిటీ ఇంత, వండిన తర్వాత ఎంత అయింది? ఇంత. దీన్ని ఏమంటారు? సర్టనిటీ అంటారు. అదేంటది? అన్సర్టనిటీ అంటారు. అన్సర్టనిటీ ఎంత వస్తుంది? 1000 కోట్లు వస్తుంది. సర్టన్గా చెప్పు, 100 రూపాయలు వస్తుంది. ఇదేంటిది? సర్టన్. సో హౌ డూ యూ గెట్ ద సర్టన్ క్యాష్ ఇన్ఫ్లో? Uncertain cash inflow, when you multiply, what is that? Certain cash inflow, you will get, what is that? Certain cash inflow. By taking that certain cash inflow, if you calculate NPV, such a NPV is called, what is that? What NPV, Maji? Certain NPV. Are you getting, ma? So certain NPV means it is a NPV which is estimated from certain cash inflow. Now you tell me, there is a problem, I took it here. Gaurav Limited is using certainty equivalent approach in the evaluation of risk proposals. The following information regarding new project is expected. So you see how much year? 0, 1, 2, 3, 4, 5. Expected cash flow 40,000, 3,20,000, 2,80,000, 2,60,000, 2,40,000, 1,60,000. What is this? What are these cash flow? CE factor. CE factor 1 ante even ardham. 1 is certain. 0.80 ante, for every 1 rupee of uncertain cash inflow, you are going to get it how much? 0.8. For every 1 rupee I am getting 0.8 means for 3,20,000 how much I will get? 3,20,000 into 0.8. How much it is? So now to calculate NPV, should I calculate cash flows or certain cash flow? Certain cash flow. In such a case, what happened? You see, these are the cash flows. I took the CE factors. I multiplied this one. I got the certain cash inflow. 3,20,000 into 0.80. How much? 2,56,000. 2,80,000 into 0.70. 1,96,000. 2,60,000 into 0.60. 1,56,000. 2,40,000 into 0.40. 96,000. 1,60,000 into 0.30. 48,000. Then the rate is given is 6%. Again, by multiplying this, I calculated cash inflow minus cash outflow. We got the NPV. This NPV is called, what is it? Certain NPV. This certain NPV positive. What is the decision you can take? NPV should be accepted. Are you getting, ma? This is called, what is it? Certain cash inflow. Certain NPV. Now I discussed with risk adjusted NPV, expected NPV, certain NPV. Among these three, which would be the best one అనుకుంటున్నారు? సర్టెన్. ఖచ్చితంగా ఎంత కావాలో నాకు చెప్పు. 1000 కోట్లు పెట్టాడు,
కంపెనీ మన ఆఫీస్కి వచ్చాడు, సార్ ఐఎమ్ గోయింగ్ టు ప్లాన్ టు మేక్ ఇన్వెస్ట్మెంట్ ఇన్ అమరావతి 1000 crores చెప్పండి అంటే, సార్ యాక్చువల్లీ అంటే, సార్ నో యాక్చువల్లీ బేసికలీ స్టాప్ యువర్ కథాకళి ఇన్వెస్ట్మెంట్ చేసేది ఎంత 1000 కోట్లు ఇన్వెస్ట్మెంట్ చేస్తే నువ్వేంది యాక్చువల్లీ బేసికలీ నార్మలీ వాట్ ఈస్ దిస్ మ్యాన్, ఐ డోంట్ వాంట్ దిస్ స్టూపిడ్ కథాకళి, ఓకే టెల్ మీ ఎగ్జాక్ట్లీ అంటాడు. సార్ యాక్చువల్లీ కాదురా, ఏం చెప్తావు, ఎగ్జాక్ట్లీ టెల్ మీ ఎగ్జాక్ట్లీ. ఓకే, దట్ ఈస్ ద మోస్ట్ ఇంపార్టెంట్ పాయింట్. సిఎంఏకి ప్రిపేర్ అవుతున్నారు, ఎలా చదువుతున్నావు అంటే యాక్చువల్లీ అని చెప్పు. అది డిస్ట్రిక్ట్ ఎడిషన్లో వస్తుంది ఫోటోగ్రాఫ్. సో దిస్ is the 3 NPVs. Among this, certainly one problem we can expect. Another one is statistical technique, variance, standard deviation, coefficients of variance. That method also another important. What this problem, variance, standard deviation, coefficients of variance. Here it is, standard deviation, coefficients of variance. It is a very simple statistical technique. In the already you calculated, you might have understood this one. Standard deviation, variance, coefficients of variance. What do you mean of this? Let us we understand standard deviation, coefficients of variance. Here not this topic is finished. Here you see standard deviation, coefficients of variance, all these things which speaks about the risk. Here 2 topics we are going to discuss. With this we can conclude this one. What is that? One is what is that? Standard deviation. Another one is variance. Another one is coefficient of what is that? Variance. Okay, you tell me any health issue. All right, standard deviation, variance. You see sometimes standard deviation, variance, coefficients of variance, all these things speaks about what is that? Risk element only. But standard deviation, variance key, what is the difference? Most important point is standard deviation. What is the standard deviation means? Suppose standard deviation of the company is 40,000. Let us take, what is this? 40,000. What is the 40,000 means? Whatever the cash flow you expected, there is a chance to have what is it? Plus or minus of how much? 40,000. And for example, you try to understand, you estimated the cash flow. Hello? You calculated everything. You identified what is that? The cash flow you are going to generate. That is called 40,000 you expected. But the standard deviation of the company is how much? 40,000. 40,000 standard deviation means whatever the cash flow you expected, okay? From that, what is that? 40,000 plus or minus. So deviation may takes place. So 40,000 మీరు ఎక్స్పెక్ట్ చేసిన దగ్గర నుంచి డీవియేషన్ ఎక్కువ ఉందనుకో, రిస్క్ ఎక్కువ అవుతుందిగా. బాల్, నో బాల్, వైట్ బాల్, వాట్ ఏ బాల్. ఓకే, దీస్ ఆర్ 3 రైట్. బాల్, వాట్ ఏ బాల్ ఇట్ ఈస్ అంటే ఏమని అర్థం? ఎక్స్ట్రా చేస్తున్నారండి సార్, క్రికెట్లో వాట్ ఏ బాల్, ఫుట్బాల్ వస్తుందా? క్రికెట్ బాలే కదా అంటే దాని మీనింగ్ వాట్ ఏ బాల్ అంటే వికెట్స్ ఆర్ దేర్, బౌలర్ వేస్తే మిడ్ వికెట్ ఎగిరిపోయింది, ఎస్ ఆర్ నో అంటే నో డీవియేషన్. డూ అగ్రీ? సచ్ ఎ బాల్ ఈస్ కాల్డ్ వాట్ ఇస్ దట్? వాట్ ఏ బాల్. వైట్ బాల్, వాడు అక్కడ ఉన్నాడు, నువ్వు ఇక్కడ వేసావు, అప్పుడు ఆ బాల్ని ఏమంటారు? ఎక్కడున్నావురా నువ్వు అంటాం. నో బాల్, అసలు బాలే కాదు సార్, ఇట్స్ వై నాట్, ఇట్స్ ఎ క్రికెట్ బాల్ సార్. మీనింగ్ అది కాదు, వాడు ఎక్కడున్నాడు, నువ్వు ఇక్కడ వేసావు అనుకో, అప్పుడు దాన్ని ఏమంటారు? అది నో బాల్ అంటారు. నో బాల్ అన్నప్పుడు ఏం చెప్తారు? ఫ్రీ హిట్ అన్నీ ఇస్తారు కదా. మీన్స్ మోర్ డీవియేషన్, మోర్ రిస్క్. అప్పుడప్పుడు మా డాడీకి ఎవరైనా ఫ్రెండ్స్ వచ్చి చెప్పారంటే, మీ అబ్బాయి చేయి దాటిపోయాడు అంటారు. మా అబ్బాయి చేయి దాటిపోయాడు అంటే మా డాడీ చేయి పెట్టాడు, నేను ఎగిరి దూకి వెళ్ళిపోయానా? ఏం చెప్తున్నావు సార్? ఆయన ప్రశాంతంగా, ఆయన హ్యాపీగా ఉన్నాడు. ఆయన దగ్గరకు వచ్చి మీ అబ్బాయి చేయి దాటిపోయాడు, ఎప్పుడో చేయి దాటిపోయాడు. అంకుల్ కుడ్ యూ ప్లీజ్ టెల్ మీ వాట్ ఈస్ చేయి దాటిపోయాడు? హీ సెడ్ మై సేయింగ్ స్టాండర్డ్ డీవియేషన్. ఓకే, స్టాండర్డ్ డీవియేషన్ అంటే ఏంటి? మీరు ఏం చెప్పినా ఆ మాటలు ఎండని దాటి వెళ్ళిపోయాడని కాదు. ఓకే, సో 40,000 మీన్స్ 40,000 indicates whatever the cash flow you will expect, what happened? 40,000 plus or minus takes place. That is called standard deviation. Coefficients of variance means for every 1 rupee, how much of deviation will take place? What is that? For every 1 rupee, how much of what is that? Variance you are going to identify. That is called coefficients of variance. Variance is a middle tool to find it out. What is that? Standard deviation, coefficients of variance. That is the point. For example, you see
We have a problem here. Simple one problem we will take. A possible event cash flows, you have 8 lakhs, 8,000, 10,000, 12,000, 14,000, 16,000. Whereas project B 24,000, 20,000, 16,000, 12,000, 8,000. Possible event 0.10, 0.20, 0.40, 0.20, 0.10. Probability 0.1, 0.15, 0.50, 0.1, 0.10. Now you see how we have to find it out. First we took the possible event, yes or no? Then we took, what is that? Cash flows. Cash flows into probability we multiplied. We got it, what is it? Expected cash flow. Expected cash flow, we got it how much? 12,000. Now actually we got the 12,000 is the expected cash flow. Actual cash flow is this, right? Then we will find it out deviation. Deviation is a risk. నువ్వు అనుకున్న దగ్గర నుంచి ఎంత డీవియేషన్ అయింది అదే కదా రిస్క్. నువ్వు 25 మార్క్స్ ఎగ్జామ్ రాసావు, 1 మార్క్ డీవియేట్ అయ్యి 24 వచ్చింది, రిస్కా? రిస్క్ ఏం లేదు, ఎగ్జాక్ట్లీ రాలేదు కదా, 1 మార్కే కదా. 25 రాసావు, 1 మార్క్ వచ్చి 24, అప్పుడు ఏమైంది పరిస్థితి? తీవ్రంగా ఉందని అర్థం, పెద్ద ఆపరేషనే. 25కి 1 మార్క్ వచ్చిందంటే డీవియేషన్ ఎంత? 24. 25కి 24 వచ్చి 1 మార్క్ డీవియేషన్ అయింది అనుకో, నో రిస్క్. సో డీవియేషన్ ఈజ్ వెరీ వెరీ లెస్, then risk also very very less. Now you have to find it out deviation. Deviation means this is x, this is called x bar enter. So 8,000 minus 12,000, how much? Minus 10,000 minus 12,000 minus 2,000. 12,000, 12,000 nil. 14,000 minus 12,000 plus 2,000. 16,000 minus 12,000 plus 4,000. Now this deviation you have a plus or minus. Hello, plus minus ఉన్నప్పుడు you cannot make an identity. In order to exactly to determine risk, you have to eliminate what is that, these zeros. ఈ ప్లస్ ఆర్ మైనస్ తీయాలంటే what happen, you have to make a square root of this. So square root and with the probability you have to multiply d square into pi. 4,000 into 4,000 into 0.10. check చేయండి ఒకసారి. 4,000 into 4,000, when you square it, zeros goes out and 0.10 will come. How much? 16. 0.20, 2,000 into 2,000 into 0.20, 8 lakhs. So this is nil. 2,800, 2,000 into 2,000 into 0.20, 8 lakhs. 4,000 into 4,000 into 0.10, how much? 16 lakhs. So finally how much you got it? 48. This 48 is the variance. Variance means it fluctuates. ఎగ్జాక్ట్లీ మీరు దాంట్లోంచి స్టాండర్డ్ డీవియేషన్ తీసుకురావాలంటే వేరియన్స్ ఈక్వల్ టు స్టాండర్డ్ డీవియేషన్ ఈక్వల్ టు స్క్వేర్ రూట్ ఆఫ్ వేరియన్స్. సో 48,000 డివైడెడ్ బై స్క్వేర్ రూట్, హౌ మచ్ ఇట్ ఈస్? 2,181. 2,181 మీనింగ్ ఏంటి? యూ ఎక్స్పెక్టెడ్ హౌ మచ్? 12,000. ఫర్ 12,000 వాట్ హ్యాపెన్స్? ప్లస్ ఆర్ మైనస్ హౌ మచ్? 2,191. You may get a 12,000 plus 2,191 or 12,000 minus 2,191 may happens. For example, if it is a 2,191 means risk deviation path is very very less. Suppose if it is a 20,000 means, sir 20,000 better కదా సార్? ఎలా సార్? 12,000 plus 20,000 సార్ ఎంత వస్తుంది? 32,000. మనం అనుకున్నది ఎంత? 12,000 వచ్చింది ఎంత? 32,000. ఫేవరబుల్ కదా? ఇటు చూడు, ఇప్పుడు నువ్వు ఎక్స్పెక్ట్ చేసింది ఎంత? 12,000. చేతికి వచ్చేది మైనస్, ఎస్ ఆర్ నో? 12,000 minus 20,000 means you will get it how much? How much? 8,000 negative. Yes or no? That is called, this is called expected cash flow. This is called standard deviation. Now coefficients of variance equal to standard deviation divided by expected cash flow. Standard deviation how much? 12,000 divided by expected cash flow 2,000, sorry 12,000, right? No, standard deviation equal to 2,191. Expected cash flow would be 12,000. Is Sarma? 0.1825. What do you mean of this? If you are expecting for 1 rupee, every 1 rupee deviation is 0.182. It means that whatever standard deviation conveys at aggregate level, coefficients of variance conveys at by taking what is a parameter of 1 rupee. Are you getting? So this is the coefficients of variance equal to standard deviation, sum of expected cash flow. Project A ki 2,191 divided by 12,000. Project B ki kuda same procedure calculation 0.2621. So this is the stand risk element of this project. Whereas one more point is there, you can generate what is it? Written. In the material you have given a written. Written is nothing but what is that? Generally whenever you do the business, whatever the written you used to get it. Written concept already covered in cost of capital. You can you can identify realized yield annam kada. For example, I purchased a stock. Simple. I purchased a stock. Initially I got 40 rupees dividend. At the end of 5th year, I purchased stock 50 rupees. 50 rupees. Dividend I got 10 rupees. At the end of 4th year, I sold this share for 60 rupees. What is the return I got it? Maji, my investment is how much? 50 rupees. 10 rupees I got it in the form of dividend. I sold this share for 60. 60 means there I got it a gain of 10 rupees. 10 plus 10, 20. 20 rupees I got it. What is my investment? 50. For 50 I got it 20. So 20 divided by 40. What is this? 40%. This is called return on equity. Hello? Return on equity. Return on asset, you know that. EBIT divided by capital employed. Whereas IRR also you can calculate average annual rate of return. Every year if you get the same rate of return, what happen? You have to make it what? Average. Here most important is risk return. This is the theory part is given. Whereas dividend price approach. This model also we discussed the realized yield approach. Do you remember? Realized yield approach. KE equal to return earned by whom? Equity shareholders. I purchased a share. I hold it for 10 years. 10th year ending I sold. In such a case what I do? I will calculate IRR. Are you getting? Beginning లో నేను ఇన్వెస్ట్మెంట్ చేశాను. డ్యూరింగ్ ద పీరియడ్ నాకు 10 years dividend వచ్చింది. 10th year ending లో I got the net sale proceeds. Now I used to calculate IRR. That IRR is at 20% means this is the maximum return I made it investment in this project and I generated return. So that is called return. Risk is the most important point. Return means once you invest, whatever the gain used to get it called, what is that? Return. Okay, ma? So this is the point with respect to return. And what is the one more? You have advanced concept in capital budgeting. One point is there. Advanced concept lo okay oka concept that is called replacement decision. What is that? Just I will give an idea. Capital budgeting already I covered that point. Only oka replacement point చెప్పలేదు. నేను ఇంత చెప్పిన మెట్లు దిగిపోయేటప్పుడు చెప్పకుండా పోయానని ఫీలింగ్ వస్తున్నా. అవునా? ఇంత వర్క్ చేసిన దాని మీద లెట్ మీ డూ దిస్. మీరు అడిగారని చెప్పట్లే, నేను చెప్పాలనుకున్నా కాబట్టి చెప్తున్నా. వెళ్ళిపోవడానికి 199 రీజన్స్ ఉన్నాయి ఇప్పుడు. ఓకే, బట్ యు నో ఫర్ యూ మే గెట్ ఇట్ దిస్ వన్. You see, advanced capital budgeting means there are certain costs. Extra hardly you can spend 5 minutes means weekend. Because morning class 15 minutes technical problem. Afternoon again technical problem. So your time approximately mic problem, you know that. Sometimes even pen also not cooperating. Okay? Live lo chustunaru kada meeru? Adi. Right here, there are certain costs you must understand theory part. What cost it is? Sunk cost. Advanced concept means sunk cost. Sunk cost means before commencement of the project, whatever the cost you incurred, that cost should be ignored. That cost is called what cost? Gatam Gataha. Baba. Before commencement of the project, whatever the cost you incurred, that cost should not be considered. You have to consider the cost which is supposed to be paid. Are you getting? This is the sunk cost. Opportunity cost. Opportunity cost means whenever you will undertake any project, you will generate revenue from the project. Okay? But because of your investment, any cost, any benefit, you are going to get it. That benefit is called opportunity cost benefit. Any loss may happen. That is called opportunity cost loss. Benefit అయితే యాడ్ చేయాలి, లాస్ అయితే డిడక్ట్ చేయాలి, కానీ ఆపర్చునిటీ కాస్ట్ని కన్సిడర్ చేయాలి. దిస్ ఈస్ కాల్డ్ వాట్ కాస్ట్? కామన్ కాస్ట్. కామన్ కాస్ట్ మీన్స్ బిఫోర్ కమెన్స్మెంట్ ఆఫ్ ద ప్రాజెక్ట్, ఇఫ్ ఎట్ ఆల్ ఎనీ కాస్ట్. ఫర్ ఎగ్జాంపుల్, వాచ్మెన్ salary is there. Hello? Today, marathon class went in this class. Because of marathon class, will he get a salary? If no marathon class, will he won't get the salary? ఈ క్లాస్ ఈ మారథాన్ క్లాస్ జరిగినా వాడికి శాలరీ వస్తుంది, జరగకపోయినా శాలరీ వస్తుంది. సచ్ ఎ కాస్ట్ ఈస్ కాల్డ్ వాట్ ఇస్ దట్? కామన్ కాస్ట్. కామన్ కాస్ట్ మీన్స్ వెన్ ఎవర్ యూ ఆర్ ఇవాల్యుయేటింగ్ ప్రాజెక్ట్, ఓకే, if such a cost, whether you undertake a project, such a cost exists. If you won't undertake such a cost, if you won't undertake a project, such a cost exists. Such a cost is called what is it? Common cost. Common cost should be ignored. Are you getting? These are the certain advanced concept. And the most important point is replacement decision. What is that? What is a replacement decision? A company may replace its existing machine with what? New machine. For two reasons. Number one, to increase output, to decrease maintenance cost. Yes or no? Today you see artificial intelligence came. Because of artificial intelligence, there are a lot of changes are coming. Hello? In such a situation, what happened? Each and every company think about replacement. For example, X is a client who came to my office 2 years back. Sir, he said, sir, I want to invest in this project, sir, tell me. Then I calculated NPV. NPV is positive. For how many years? 10 years. Now you see, he came to my office అనుకుందాం. ఇదే machine, old machine. Then life enta, let us take 10 years. How many years? 10 years. 10 years I evaluated NPV positive. What might have I told? Sir, since NPV positive, you can buy this machine. Situation is 1, 2, 3, 4 years is finished. How many years left? 6 years. Again he came today. He said that, sir, 4 years back you evaluated project, sir. 10 years. Okay. Then I said 10 years, right? That project is good, Good only, sir. Sir, 4 years is finished. Remaining year is 6 years. In market, a new machine came, sir. I have a small doubt. Could I sell this machine with that amount? Can I buy new machine? For how many years? For remaining 6 years. It means that for remaining 6 years, investor has a dilemma that should I continue with the old machine or shall I replace with new machine? Such a decision is called, what is that? Replacement decision. So this is called replacement, right? Replacement. A company may replace its existing machine with what? New machine to increase its value or wealth is called replacement decision. Reasons for replacement: to increase output, to decrease maintenance cost, both are replacement decision. Total approach, incremental approach. What is the total approach? Means we will calculate NPV for total machines. It means that, for example, existing machine is there. What is the remaining life of existing machine? 6 years. This is the existing machine, 6 years. What is the new machine life? This is the new machine. How many years? 10 years. But actually the project life is how many years? Total project life 10 4 years finished. How many years left? Even though if I buy new machine, that project life is how many years? 6 years only. Maybe new machine life might be 10 years or 15 years. It is irrelevant to me. Why? Because at the end of 6th year, I am going to scrap. Hello? Now the question is, in total approach, what I am going to do, 6 years operating cash flow is going to get it, plus 6 year terminal cash flow is going to get it. Do you agree? Old machine ki 4 years అయిపోయిందిగా. This is the total 10. Are you getting? 4 years is finished. I am standing here. How many years left? Now he came to my office for the sake of replacement. Means what is his opinion? For the 6 years, should I run with what? Old machine? Shall I sell this security and shall I buy the new machine or not? This is the question, right? ఇప్పుడు చెప్పండి, ఇప్పుడు నేను ఏమంటాను, ఈ 6 years కి I will calculate NPV. Hello? 6 years కి NPV. 6 years NPV అంటే no need to incur cash outflow there. ఎందుకు? వెరీ గుడ్. ఆల్రెడీ వాడు ఇన్కర్ చేశాడు. ఇప్పుడు ఏమంటావు అన్న, దీన్నే కంటిన్యూ చేయంటాం. ఎస్ ఆర్ నో? దీంతోనే కంటిన్యూ. యూ కంటిన్యూ విత్ దిస్ బికాస్ యూ నో నీడ్ టు స్పెండ్ ఎనీ cash outflow. Why? Because already you invested. In such a situation, NPV equals to, what is it? Operating cash inflow, terminal cash inflow is the NPV. Hello? Sir, minus cash outflow, sir. No need to spend because already we spent. What about the new machine? New machine you have to spend, what is that? PV of cash outflow. Hello? And you have PV of operating cash inflow plus terminal cash inflow. So operating cash inflow plus terminal cash inflow of how many years? 6 years. Minus you have to make, what is that? Cash outflow. You will get NPV. For existing machine, no need of to consider which one? Cash outflow. Only new machine you have to consider. Here it is 24 lakhs. How much? 24 lakhs. Here 30 lakhs. Now tell me what is opinion. It is a better to go with the new machine or old machine? Old machine NPV is how much? 24 lakh. New machine 30 lakhs. Which machine is giving highest NPV? New machine. So which would be the better one? New machine. Got it? So this is the total approach. Incremental approach is, this is a different story. For example, I have my bike right in down. If I want to replace my existing bike with a new bike means step number 1. I have to sell my old bike. Yes or no? I have to sell my old bike and I have to take the net sale proceeds. Thereafter, I go to the shop. I want to buy the new bike. Hello? Step number 1, what I do? I have to net sale proceeds of existing machine. Do you agree? If I want to replace means what I do? I have to sell old machine. I have to take the cash. Then I have to buy the new machine. For buying new machine, I need to spend total cash outflow because already what amount I have? Old machine sold amount is there, you know. So I have to find it out only incremental cash outflow. What is that? Incremental cash outflow. Incremental cash outflow means cost of new machine minus NSP of what is that? Old machine. So step number 1, what to do? First of all, what I do? Scrap. Which one? Old machine. Take the money. Then go to the market. Then buy what is that? New machine. That is called what is that? Incremental cash outflow. Thereafter, I have to find it out. Incremental operating cash inflow. Balu sir, you've been using incremental. Why? Because in order to acquire new machine, I'm spending certain additional amount, right? Because of spending that additional amount, could I able to get additional NPV or not? If I am getting additional NPV positive, then I will go for replacement. If additional NPV is negative, no need. Additional NPV is 0. Either I may replace or not. For this purpose, you see, estimation of, first my job is to estimation of what asset? See, estimation of net sale proceeds of old machine. What I do? Gross sale proceeds of old machine. Then if I sell this machine, immediately income tax people may come, In that purpose, what happen? For that purpose, I used to calculate what is it? Written down value. I will compare. I may get what is it? Capital gain or capital loss. Capital gain is there, I pay tax. Hello? Capital loss is there, I may take tax shield. So this is net sale proceeds. Are you getting? Thereafter, what I do? I will go to the market to buy what is it? New machine. Cost of new machine less net sale proceeds of old machine. Add any working capital is there, I will add it. This is nothing but incremental cash outflow. Thereafter, I have to find it out. Incremental what cash inflow? Operating cash inflow. If incremental PBDT is given, I will compare both the machine PBDT. I will get what? Incremental PBDT. From incremental PBDT, I have to deduct incremental depreciation. Incremental depreciation means what depreciation? Old machine depreciation, new machine depreciation. Condition applies. When you want to consider depreciation means there must be a tax. So incremental depreciation you deduct. You will get what? PBT less tax, PAT. Add back to depreciation. You will get the incremental CFAT. Then you have to bring into present. Then you will get the PV of incremental operating cash inflow. Then last you have left incremental terminal cash inflow. Net sale proceeds of new machine at the end of life and the net sale proceeds of old machine at the end of the life. You compare both. You will get it incremental net sale proceeds. And if at all working capital is there, recovery of working capital you take it. Finally you will get it. What is that? Terminal cash inflow. Are you getting? This terminal cash inflow also you have to bring into present. Many of the students, they will have a doubt that with respect to old machine. Sir, మీరు స్టెప్ 1లో అమ్మేశారు కదా మరి ఇక్కడ ఎందుకు తీసుకున్నారు అంటారు. ఈ ఒక్క పాయింట్ కోసం ఇంతసేపు చెప్పడం మీకు. యాక్చువల్గా నేను అమ్మానా? I never purchased, I never sold. I been what is that? Thinking that what might be there. For example, I go to the showroom to buy a bike. ఈ బైక్ ఎంత సార్ అంటే 1.2 lakhs అన్నాడు అనుకో. 1.2 lakhs ఎక్కువగా సార్ అంటే సార్ దీనికి రీసేల్ వాల్యూ ఉంటుంది సార్ అంటే. రీసేల్ వాల్యూ అంటే ఏంటి? మీరు అమ్ముకుంటే డబ్బులు వస్తాయి. ఇంతవరకు కొనలా కానీ వాడు మనకి ఏం గైడెన్స్ ఇస్తాడు? కొనలే కానీ అమ్మితే ఎంత వస్తుందో చెప్తాడు. ఇప్పుడు నీ ఏదో క్యాలిక్యులేషన్ ఏంటి చెప్పు. వాడు 1,20,000 అన్నాడు అనుకో, కక్కుర్తి యాక్టివేట్ అవుద్ది మనకి. అప్పుడు ఏమనిపిస్తుంది అంటే అరే ఈ బైక్ను 1,20,000 కదా, లాస్ట్లో అమ్మితే ఎంత వస్తుంది? 50 వస్తుంది కదా. 1,20,000లోంచి 50 పోతే ఎంత అయింది? 70,000 అయింది. ఇప్పుడు ఆ బైక్ ఎంత మన దృష్టిలో? వాడు సార్ ఇట్ హ్యాస్ అ రీసేల్ వాల్యూ అనగానే ఆ బైక్ సడన్గా 70,000 కనిపిస్తుంది. దిస్ ఇస్ మార్కెటింగ్ స్ట్రాటజీ. ఎఫ్ఎంలో వన్ ఆఫ్ ద స్ట్రాటజీ. వచ్చిన వెంటనే కస్టమర్కి అది చెప్పేస్తారు, సరే బైక్ తీసుకోండి, రీసేల్ వాల్యూ 1 lakh వస్తుంది. ఇప్పుడు ఎంత? 1,20,000 అంటే 20,000 20,000 బిల్లు కట్టేటప్పుడు ఎంత తీసుకుంటాడు? 1 lakh తీసుకుంటాడు. కానీ బైక్ వచ్చేటప్పుడు మాత్రం నీకు చాలా కాన్ఫిడెంట్గా ఉంటుంది. ఎందుకంటే నువ్వు పెట్టింది ఎంతనే? 20,000. ఆర్ గెట్టింగ్? ఇంత కాదు, నిజంగానే కన్సిడర్ చేయాలి. ఇక్కడ మనం బై చేయలేదు, సెల్ చేయలేదు, యు బీన్ థింకింగ్. incremental net sale proceeds, then recovery of working capital, then you will find what is that? Terminal cash inflow, and you have to bring into present. If the both incremental NPV equal to incremental operating cash inflow plus PV of incremental terminal cash inflow minus PV of incremental cash outflow. If NPV positive, accept. Replace the existing mission with what? New mission. Otherwise, no. This is called what NPV? Incremental NPV. Decision is called what is that? Replacement decision. Here with an example, I will conclude. Exactly 5 minutes I will take. See, an existing company has machine life of how many years? 2 years. It being remaining life is how many years? 10 years. And in total, what is the life of the machine? 12 years. In 12, how many years has gone? 2. How many years left? 10 years. Okay. Now the replacement for how many years? 12 years kadamma. Ekkunar sir 12 years. 2 years అయిపోయిందిగా. ఇంకా how many years? 10 years. Right? What would be the cost of new machine, sir? 6 years, sir? Maximum 10 years. Yes or no? Might be more than 10 also might be. But it should not be less than 10 years. The salvage value at the end is nil. Current market value. Current market value of what machine? Old machine is 1 lakh. The machine considering proposal to purchase improved model of similar machine, which gives increased output. What is the reason why they are going for replacement? Already I told you just now, either to reduce the cost, increase output. In the problem they are clearly mentioning that increased output. The relevant cash flows. Purchase price. How much you purchased? 2,40,000 for how many years? 12 years. Cost of new machine is 4 lakh. 4 lakh here how much it is? 10 years. Salvage value is nil. Annual operating hours. Existing machine hours works how many hours? 2,000. This is also 2,000 hours. Selling per unit. Selling price per unit is 10. Output per hour. This is 15. But this is what is why new machine is preferred? Because you know output per hour it can produce how many units? 15. But this can produce 30. Material cost 2 rupees, 2 rupees. Labor cost per hour 2,000, 5,000. Repairs and maintenance how much? 9,000, 6,000. Working capital required. Existing machine working capital already is there. How much? 25. But new machine you need how much? 40. Means additionally you need to spend how much? 15,000. Right? Company follows straight line method of depreciation. Tax is how much? 50%. Should the existing machine should be replaced, assuming required rate of return is how much? 15%. Now this is the problem. Step number 1. What we have to do? Sale. Before sale means income tax people will come, Better to calculate what is that? Depreciation. What Maji? Depreciation. Because tax is there. Depreciation is what method? See, evaluation of replacement decision basing on incremental NPV. Estimation of depreciation for each of the machine. Depreciation. Cost minus scrap divided by life. New machine cost how much? 4 lakh minus 0 divided by 10. How much? 40,000. So old machine is 2 lakh 40 minus 0 divided by 12. How much? 20,000. So new machine ఎంతమ్మా? 40. Old machine ఎంత? 20,000. సార్ ఇక్కడ ఎందుకు సార్ 12 తీసుకున్నారు? 12 is per years కే కదా, ఇది 10. రైట్, ఓకే. ఇప్పుడు ఏం చేయాలి? I have to sell old machine, right? So here calculate net sale proceeds from old machine. Gross sale proceeds of old machine ఎంత కమ్మాం? 1 lakh. కానీ actually we purchased for this asset for how much? 2,40,000. Every year asset getting depreciation by 20,000. 20 into 4 means no. అంతే కదా, 20, 40. 2,40,000, 40 gone. So how much worth of asset? Are 2 lakh worth of asset I am scrapping how much? 1 lakh. Then certainly I got the gain or loss? Loss of how much? 1 lakh. Next I will try to take what? Tax shield. Tax shield 50% means 1 lakh into 50%. How much? 50,000. Now tell me net sale proceeds. Net sale proceeds how much I will get it? Already I sold for 1 lakh. Government gave 50,000. So total net sale proceeds I got it 1,50,000. Assumption that if company income government gives 50,000. Are you getting? Next what is that? You have to calculate incremental cash outflow. Cost of new machine how much? You went to market to buy. Cost of new machine 4 lakhs. But NSP of old machine as on today how much? 1,50,000. In total how much? 2,50,000. You need to add additional working capital. Hello? Already you want to 40 lakhs but old machine working capital is there. extra 15 lakhs, 15,000. Now total incremental cash outflow would be 2,45,000, 65,000. Next, what you have to do is incremental PBDT. How should I calculate incremental PBDT? Means you see sales revenue of the machine, hours into output per hours into selling price. Yes or no? Hours into output per hours into selling price. You will get the 6 lakhs. Here 3 lakhs. Less material cost 1,20,000, 60,000. Less labor cost 80,000, 40,000. Less consumable stores 5,000, 2,000. Less repairs and maintenance 6,000, 9,000. PBDT I will get it 3 lakh 89,000, 1 lakh 89,000. New machine PBDT is 3 lakh 89,000. Old machine PBDT is 1 lakh 89. Now incremental PBDT is how much? 2 lakhs. Because of going for replacement, I will get the incremental PBDT of 2 lakhs. Less I will deduct the incremental depreciation. New machine depreciation is 40. Old machine depreciation is 20. If you deduct a 20, 2 lakhs plus 20, 1 lakh 80,000. Less 50% tax 90. PAT 90. Add incremental depreciation is 20. Incremental CFAT is 1,10,000. Every year you are going to get the same cash inflow over the period of 10 years means by using annuity factor, if you bring into present 5,52,090. What about the terminal cash inflow? Gross sale proceeds, new machine is nil. Gross sale proceeds, old machine is nil. But incremental net sale proceeds is nil. But recovery of working capital is there, no? How much? 15,000. That this 15,000 is the what cash inflow? Terminal cash inflow. This is I am going to get it at the end of 5th year. If I use present value factor, if I bring into present 3,705, now you calculate incremental NPV. Incremental NPV, PV of incremental NPV, PV of incremental operating cash inflow, terminal cash inflow minus cash outflow. Incremental NPV equal to 2,90,795. What is your observation? Since incremental NPV positive amounted to 2,90,795, so it is beneficial to replace the existing machine with new machine. Assumption. It is assumed that company may get what is it? Tax shield on its capital loss. Okay. So this is the incremental approach and what decision? Replacement decision with respect to this. Right, ma? So because of a time constraint, we done this. Right. So this slides, whatever the PPTs, I done it, right? So I will keep this system with the permission of management. You can take it, right? Because no need of this. Just if you observe whatever the concept I explained, you put it effort. Only 2 important chapters. Remaining chapters, don't worry. Capital budgeting, working capital, cost of capital, capital structure, leverages, dividend decision. Only these are the chapters they've been giving much priority. Okay, you pay attention for these chapters because we have to give a priority, but the most important point is which area is so important. Right, ma? Thank you.